Surfin with ways of digital financial technologies. With the rapid development of digitalization and globalization of financial markets, Surfin has always been driven by digital technologies to invest globally. Surfin Group specializes on two major areas: digital finance and technology empowerment. Since 2017, Surfin Group has invested across 3 continents, which are Asia, Latin America, and Africa, with 20 million users in 8 countries and a total transaction volume of over $2 billion. Surfin invests digitally. Surfin Group focuses on digital investing to empower financial services and asset management globally. Surfin Group processes and develops tens of terabytes of data, hundreds of big data models, millions of feature vectors, millions of effective product models, and asset allocation portfolios. Surfin has global risk management experience. Surfin Group delivers risk management expertise in global asset allocation and investment. The investment and technology can be efficiently married by individually matching of dynamic asset allocation portfolio based on big data and personalized efficient frontiers, integrated with multi-asset classes, multi-trading frequencies, and multi-strategies through risk parity allocation. Personalized and diversified portfolios can be constructed to provide scalable asset allocations and across various market cycles. Surfin Group also develops a fully functional and convenient digital integrated wealth management platform across borders and different markets, which can provide middle-class customers with digital smart financial services, including news and information, user forums, investor education, investment advisory, and financial planning services to enhance global investment experiences. Surfin Group develops 4 proprietary core technology systems that enables real-time online accessing, multi-ethnic group matching, and global multi-country servicing. Intelligent Risk Appetite System, EKYC System, Big Data Behavior Analytics System, AI Smart Voice System. Surfin Group looks forward to seeking mutual benefit and win-win cooperation with various partners to develop an ecosystem to invest in emerging markets. Surfin Group has always been persevered.
Good morning, good morning. Hey, good morning, everybody. We're going to try to get started, so if you can come on in and sit down. If you're outside having breakfast, I know it's beautiful out there, but I'm sure our speakers would love to have you inside here with us. There'll be plenty of time for that. We've got a cocktail party later this evening out on the deck. Thank you, Andy. Thank you. So, folks, if you can hear my voice, come on in, try to take a seat. So good morning, everybody. Bruce McGuire again, here with you, co-chair, co-founder. Welcome to day 2 of the Greenwich Economic Forum, our 5th year celebration. Our first panel this morning, well, before we get to our first panel, today we've got some really interesting speakers. Bryant Corbett from the MFA is going to be coming up next. We also have Sam Zell, that's going to be here around 10 a.m. today. And then Andrew Yang is going to be joining us this afternoon, so please try to stick around for Mr. Yang, and a lot of great stuff in between. I'm going to introduce Bryant. Bryant is the CEO of the Managed Funds Association, the MFA. The MFA is the trade association for the alternative investment industry here in the United States. I am the president of the Connecticut Hedge Fund Association. That's a group that I've been leading since 2004. And about a year ago, the MFA asked the Connecticut Hedge Fund Association to partner with them. So we're now a happy partner of the MFA and looking forward to doing a lot of collaboration with them this year and next, and then going forward into the future. There's a lot of things going on in Washington. The SEC is paying a lot of attention to the alternative investment industry, and Brian's on the front lines of all that, and he's going to share his insights and tell you a little bit about his day-to-day, with us this morning. So very proud to have MFA as a partner, and very proud to have Bryant Corbett with us this morning. He was here last year. Sorry, my shoulder is still injured, Brian. Otherwise, we'd be playing tennis at some point over the next couple of days, but I'm glad you're here anyway. So please help me to welcome Brian Corbett.
Oh, yeah. Yeah, why don't you got it? Good morning.
Good morning. Thank you all for joining us, the early bird special. So we appreciate it.
Yeah, so I'm impressed with how many people have gotten up for this early run. So you've probably all read in the background, so we don't need to go through our backgrounds. I'm really pleased and privileged to be here with Brian to talk about what's been happening on the regulatory front, particularly with the SEC. It's a little bit interesting that you have the former CFTC chairman now the head of the SEC and taking as aggressive a posture as he has. So I wonder if I could just start by asking you, as you look at the landscape and you think about what's affecting the industry, what are your priorities as the MFA? How are you thinking about these, and what are your top priorities in terms of response?
Yeah, so again, thank you all for joining. Barry, thank you for moderating the discussion. For those who don't know, and Bruce mentioned this briefly, MFA, we're a global trade group. We represent alternative asset managers. Think of us as representing funds that have strategies ranging from traditional hedge to now private markets, crypto. Generally, our members don't do leverage buyout. Is sort of where the line is drawn. It is an incredibly volatile time for alternative asset managers right now in Washington. We will get to sort of the macro environment, I think, a little bit later in the conversation. But right now with the SEC, all of us remember 2008, the global financial crisis, when there was a big market precipitating event that was the triggering point for a backlash in Washington. The Dodd-Frank Act followed, what happened in 2008. What you're seeing now in DC, it's very hard to pin it on one particular event. And there's certainly been no legislation that is driving the agenda that Chair Gensler is implementing. It really is sort of his own motivation to come out with over 17 to 20 different rules targeting alternative asset managers. So it is a challenging time. Everyone in this room, anyone who manages money, your business will be different in the next 2 years as a result of what he is doing. It will be harder for new funds to launch, which I know a number of the allocators are very focused on emerging manager programs. Very hard to start a new fund when you're looking at hundreds of thousands to if not millions of dollars in increased compliance cost before you launch a vehicle. So a very challenging time across the board for managers.
Yeah, no, I think that it is creating this major barrier to entry for new funds. I think it's a great point. So, you've described his aggressive posture as being an attack on the active management fund industry. Elaborate on that a little bit.
As from our seat, it really does seem like Chair Gensler has an agenda focused on making it very difficult for managers to employ active investment strategies, particularly if you're using a private fund vehicle to do that. So I think of it really in three categories. Rules affecting your book, rules affecting your LP relationships, and then lastly, your operations. So starting with your book, a whole raft of new requirements around what you have to disclose to the public and when. Whether it's equities, swaps, shorts, you will have to disclose more of your intellectual capital and trading strategies to market participants in shorter time frames. So harder to build a book. Second, your investor relationships. One of the key fundamental tenets of running a private fund is your ability to negotiate terms with your limited partners. GP, LP contractual relationships encompass many different dynamics, and there are both sophisticated parties negotiating terms. The SEC, for the first time ever, is inserting itself in the middle of those negotiations and prohibiting certain terms. in many ways through the back door trying to limit fees. And so we see that as a major overreach and something that the SEC is simply not authorized to do. And this is going to be an issue that will play out not only in the regulatory forum, but potentially in the courts as well. The last issue is your operations. Of the 20 different rules I mentioned he's put out, there are probably 7 or 8 of them that affect how you run your business. Things like ESG, things like cyber disclosures. There's a filing called Form PF, which goes to the regulators, and it's focused on trying to assess whether there's a systemic risk potential at a fund. The SEC has just put out a new version of that Form PF with over 200 new questions for managers to answer. I mean, it is not just a slight amendment of an existing document. It is an entirely new set of disclosures. So your book, your LP relationships, and your operations will be fundamentally changed as a result of what's happening.
So you mentioned that this doesn't really have a legislative impetus that seems to be welling up from within the administrative regulatory function itself. What do you think the motivation is? What do you think is driving his desire to engage in this part of the market?
Yeah, it's a good question because regulators are usually very careful in terms of asserting their jurisdiction. They usually look to anchor their action in a congressional mandate. Here, we don't see that. So it leaves us trying to do some armchair quarterbacking in terms of what's really driving them. And it does seem like Chair Gensler has a vision in his mind for what markets should look like and what, in an ideal world, market participants should face in terms of the playing field. And he's trying to push things in the direction of sort of his view of how things should operate. And it doesn't really match up with the reality of how markets operate today. So it's very much driven, I think, by politics as well. I think it's clear that, and we can get to this sort of the changing congressional dynamics, he answers to President Biden and to probably a slightly more progressive political audience, and that's really where a lot of these rules seemed guided.
Yeah, it's interesting. It is a real stretch away from what had been 40 Act focus, moms and pops, fair capital markets, which all seem, I think everyone likes to have a level playing field, but this is a brand new extension.
And it's a good point, Barry, because the SEC for years has dealt with mutual funds. They know what a 40 Act company looks like, and they're trying to bring that thinking and that rubric to the private capital markets and to private funds, which have grown very significantly. But the SEC doesn't quite have the experience or expertise with private funds, so they're trying to force, in many ways, sort of a mutual fund-like disclosure reporting framework on private funds.
That's really interesting. Do you think the market turmoil around Archegos was a motivator for them in terms of some of their disclosure rules?
I think there's one rule. Dodd-Frank gave the SEC authority to put in place a security-based swaps regime, which the SEC never implemented. Archegos happened, lots of different factors. You could see that being the impetus for putting out a swaps disclosure regime, but that doesn't explain the other 19 or 20 rules that are out there.
Fair enough. How's MFA addressing this? How are you trying to push back maybe to the wrong? How are you trying to address their concerns and deal with the legislators and the comment periods, et cetera?
Yeah, for many years, alternative investor community sort of was in the shadows. The thinking was, look, if we just keep our heads down, we go about our business, the media, Congress, policymakers will focus on someone else. And those days are over. And certainly now with what Gensler's doing, the industry's really forced to engage in a much more proactive way. So there's a handful of things that we do to try and advocate on behalf of the industry. The first is really smart, thoughtful, strategic engagement with the SEC itself. Sending letters, sending analysis of the rules, and making those intellectual arguments for why what they're doing doesn't make sense. Second is you build congressional relationships. You want to be able to go to members of Congress, build allies who can then submit letters and engage with the SEC on your behalf, reiterating your comments and trying to exert some influence over the SEC. Third, we've launched a major communications campaign around explaining what alternative managers do and who they serve. Many people in Washington read headlines. They read about people buying sports teams or the top floor of condo buildings in desirable areas, but what they don't connect the dots on is that managers do well when their funds do well, and the funds serve the end beneficiaries, foundations, endowments, and pension funds. Those are the people who benefit from what private fund investors do, and we make that argument, and we communicate very strategically with the media, all levels of media, state, federal, as internationally as well. Fourth, we're very focused on research. So a big part of the game in Washington around regulation is cost-benefit analysis. Each time the SEC puts out a rule, they have to explain why this rule is worth it in terms of the cost it's going to impose on market participants. So we do a lot of analysis showing how their cost-benefit analysis is out of whack for the rules that they're proposing. And in many ways, it sets the groundwork for the fifth tool that we have, which is litigation. Ultimately, this is not a tool that one wants to use. You want to work through the regulatory process and try to affect an outcome that your members can live with, but sometimes you can't get there. And at this point, we are very focused on the regulatory process, trying to get the right outcomes, but we haven't ruled out litigating with the SEC if the rules ultimately come out in a way that are just too punitive for the industry and don't allow managers to do their jobs.
Yeah, it's hard when you think about the output of regulation. Often the unintended consequences completely overwhelm the intended consequences.
Yes.
So it's great that you guys put the work into that. Let's shift gears to ESG a little bit. ESG was certainly a hot flavor for a couple of years. There's a bit of a rush to be able to identify yourself as an ESG manager or having ESG products. I think in the last 6 months to a year, that's cooled off a little bit as people have faced accusations of greenwashing and have tried to establish some boundaries around the ambiguity of what does that mean precisely and how do you measure that, et cetera. So what's the state of play there now?
Yeah, this issue, as many of you read in the press, has become very politicized. It was an issue that DC policymakers were focused on for some time. President Biden made it a top-tier agenda. The financial regulatory community made climate, sustainability, and digital assets their top two issues. And on the climate piece, the regulators continue to move forward. But you also see ESG now being discussed at the state levels, right? With the Florida pension funds, the Texas pension funds. You're soon going to see situations where managers are answering to allocators that have divergent sets of ESG views. And how do managers begin to navigate through that thicket? That's going to be very, very challenging. In terms of what the SEC is doing, they have put out a rule, as you noted, very focused on funds that call themselves impact funds that have ESG as their driving mission. They want to make sure people are doing what they're marketing. And we understand that and think that if you're holding yourselves as an impact fund, there are certain criteria you should meet. But the rule as proposed is way too broad, and it actually sweeps in any manager who looks at ESG just as part of their due diligence.
Right.
So if you're investing in an insurance company and you're looking at how they manage weather risk as part of their portfolio, that's ESG now, as the SEC's defined it. You have to file a whole additional set of disclosures just because ESG is part of your diligence. We were talking to a manager yesterday that was thinking of launching a new fund that would have ESG just as part of its investment criteria, not an impact fund, and they were estimating upwards of like 500 to 750,000 just to comply with this one regulation alone. So if they can't raise a new fund of a certain scale, they just can't launch the product. So it's a challenging time And then when you weave in the international dynamics around ESG too, where Europe has been a little bit out in front of where the US has been, in some ways, I think Gensler feels like they're playing catch up.
Right. It is a complicated area because there is so much ambiguity about what is the carbon footprint, how is that measured, is that accurate, can you how do you actually do that, and the overlapping regimes. We've got CFTC and SEC here, but when you throw in the Europeans, you throw in the whole mix, it becomes a really complicated thing to accurately assess that, and almost any calculation you do will run afoul of one of the competing jurisdictions.
So how about from your seat at Taconic? I mean, you're sitting watching all of this happening in Washington, all of this coming. How do you, as the COO of Taconic, sort of think about all of this?
Well, I'd say I'm fortunate we have a really robust compliance function with General Counsel Peyton, who I know you know, and Florine, is our CCO, and so they're seasoned pros, but as you point out, it's an expensive process to have half a dozen people who think about this and make all the regulatory filings. So it's complex and it's expensive. I think that at an industry level, it is a major barrier to entry. And so one of the great things about this industry is it's pretty Darwinian, and so you have survivorship bias towards people who figure it out and do well, but you also have always had this robust entry level emerging manager ecosystem that people would get, and now the barrier to entry, the threshold to actually start a fund to generate enough fees that your hair is not on fire from day one is pretty high. I would also say that echo your point that there's a huge amount of market friction that results from this. As you're describing your member who was adding up the $500,000 to $750,000 to have those sorts of compliance in place, that will drive people out of places that they would otherwise be. A place where you see that now, Jamie Dimon mentioned it in his congressional testimony, is the lack of CapEx in the energy space. And so in a country where we have too little refining capacity, we have a incomplete and incoherent pipeline system, et cetera, it's a place that is begging for some capital expenditure, yet the cost of capital in that space is so high. And I think those sorts of market efficiencies come from well-meaning but probably misguided regulation. So let's shift gears a little bit and go to the political side of this, because that's obviously going to have an impact on both the administration and the regulatory agency. How do you think the upcoming midterm is going to affect the regulatory topography?
So our working assumption is that there will be divided government after the midterms. I'm not an election prognosticator, just seeing a lot of the data that all of you are. It does seem like the House will likely flip by some number of seats, and the Senate, who knows. So assuming that one chamber does flip, there are a couple of significant ramifications from that. First is less likelihood of tax legislation moving through Congress. Not to say it won't happen, but the probability goes down. So for those of you who care about carried interest, lower threat level after the midterms, but not gone. Second, I think a continued focus in Congress on China. I think there's one area that Republicans and Democrats support, that is punishing China. And so I think you'll continue to see a lot of legislation, a lot of discussion around limiting investment into and out of China as much as we can. Third, in terms of congressional dynamics, all of us have followed over years the efforts to fund the government. Are they going to come to a deal to fund the government and keep things going? They have to raise the debt ceiling again. That is going to become incredibly difficult. As the parties become more partisan on the extremes, and the moderates who have long negotiated the government funding deals, avoiding the government shutdowns, those people are retiring and they're being replaced by more progressive and more populist people on both sides of the spectrum. Those deals become a lot harder to get in a new Congress. In terms of our issue set, what we've talked about earlier with the SEC, not much is going to change in terms of Chair Gensler's ability to keep marching ahead. He will have the 3-2 votes inside the SEC to pass his agenda. A Republican House can certainly exert more scrutiny over him. There can be more hearings, more public pressure on him, but there are few tools available to actually stop him. Some people have said, look, you could cut funding to the SEC. Very difficult to do unless you control all of the levers of government, because you would need the Senate, the House, and then the President to sign something that would restrict funding to the SEC. So that's challenging. I'd say the third dynamic for our industry as a result of the midterms will be a lot of new members of Congress coming in. When you look at the makeup of the Senate today, there are a number of members retiring, Toomey's and Portman's and Blunt's and Shelby's, people who have been around the investment industry for a long time and understand what we do. They're being replaced most likely by people who aren't as experienced and aren't as sensitive to the dynamics in the investment industry, and we as an industry group will have a lot of education to do with a number of these new members of Congress. So it will be a challenging time for our industry.
Yeah, that's a pretty full plate.
Yes.
That's quite a lot. As we think about government impact on markets, let me ask you a little bit about digital assets. I know that's been high profile. It's been a little less high profile as Bitcoin's worked its way from 63,000 down to 19 yesterday. But how do you think the government is going to continue to exert its influence in that space? Regulation, do you think it lands in SEC or CFTC or Treasury, Comptroller Currency? What do you think the path is for digital?
So I've been in and around Washington policy for many years, and I see Director Jim Lockhart here. Jim and I worked at one point on unwinding the mortgage markets when I was in the White House, and Jim worked for the regulator Fannie and Freddie. And trying to explain MBS to government officials was challenging. You multiply that 10 times by crypto and all of the technologies involved, and the experience and understanding gap in Washington right now between where the industry is and where policymakers are is enormous. And so I think you will see over the next 2 years more and more of an effort to pass legislation. I think the regulators have signaled that they don't want to own this. Like, they definitely want some congressional mandate for what they should do. So I think this will play out well into 2024. You'll see some continued enforcement by the SEC. You'll see some rulemakings, but I think ultimately there will likely be congressional legislation here, but it's going to take time. It is a very challenging industry, and I think the politics are still sorting themselves out. Are Elizabeth Warren and Ted Cruz going to be able to kind of align on crypto legislation? Maybe. They might be able to. It depends on sort of how that industry gets organized, how they begin to build their political relationships. So it'll be a fascinating space to watch as it plays out, and just a dynamic industry. But I want to ask you a question, Barry, with our remaining time. We've talked a lot about what's happening regulatory in Washington. Let's zoom out a bit and focus on sort of broader policy impacts with respect to inflation, with respect to markets more broadly. We saw what just happened in the UK over the past week. From your seat, how are you thinking about a lot of these policy tools that the government is either using now or soon may use?
Well, I think the clear thing is that the Fed has been boxed into a pro-cyclical policy, and they're tightening financial conditions as best they can into what's clearly I think a slowing economy, likely peaked inflation. And I have a lot of sympathy for them. I think that it was hard to estimate the fiscal potency of the enhanced unemployment, et cetera. It's very different to build a building, and that works its way into people's pockets over time, versus just injecting cash into a checking account. It was much more potent than people thought it would be. And I think that they were dealing with a lot of pandemic uncertainty, but with the benefit of hindsight, they clearly should have listened to Larry Summers in the middle of 2021 and begun to withdraw liquidity. At that point, he made the observation that we had a $2.5 trillion output gap, and we'd filled it at least 2 and probably 3 times over, and that just going to Milton Friedman's monetary phenomena, that was going to push through. So now we're in a spot where rates are higher, QT, stronger dollar, global CBs central banks are all tightening at the same time, and I think we haven't seen yet the impact of the wealth effect. The idea that the stock market is down 25% since Jan 4 of this year is something that's going to have a negative effect on consumption for sure. The general rule is the Fed raises rates until they break something, and the question is, have they yet? And you referenced Bank of England. Bank of England had their 10-year gilt rate go up 150 basis points in 3 days, and they have a lot of contradictory policy right now. They've intervened in the market at about 5% on the 10-year gilt. They've tried to stabilize the sterling, and it's been 115 was sort of the 25-year floor, and it got as low as 103. It's about 110 this morning. So clearly they're having some distress. They have distress in the pension system. Again, this is a regulatory unintended consequence. The pensioners have to ALM asset liability match, and so they love those 30-year gilts. There's just not enough of them, and so there's a lot of 30-year gilt-based swaps. And the crisis was caused by need to meet margin calls there and selling gilts to meet the margin calls. Bank of Japan has been unlimited purchaser of 10-year JGBs at 25 basis points. Dollar yen they've intervened already in the market. It's at 145 where they intervened last time in 1998. Last week, Schultz made the comment that he was in favor of EU joint bonds to meet the energy crisis. For people who have followed European politics and economics for any period of time, the idea that a German would suggest a joint fiscal debt program is pretty anomalous, which tells you how bad he thinks it's going to be this upcoming winter. Unfortunately, I think the trigger to stop will be unemployment, and unemployment lags. So in the last month, we've had JP Morgan, Citibank, HSBC, Walmart, Amazon, Facebook, Intel this morning, all having gone 3 months ago saying we're desperate for new workers, we can't fill our jobs. They've all announced job cuts in the last 45 days. So the idea that we should be focusing on the headline unemployment rate is probably a little bit too much rearview mirror. Anyway, I think they're stuck. I think they need 2 or 3 months of declining month-to-month CPI, PCE. They apparently care about the University of Michigan inflation expectations now as well. And they're not going to pause till then. And the argument is, do they pivot and go to an ease, or do they just stop? I think they've probably done enough here in and about 4 3/8, 4.5 year end. Right now, peak rates are set to be 470 in March of this year, and only falling 20 basis points until December of next year, using the Fed Fund futures this morning. So the market thinks they're going to go to 4 5/8 and stay there. I don't know if you get enough of a rebound out of that, but I think they've done enough. They can take a breath and see how it flows through the market.
Well, certainly no shortage of challenges for investors and managers to navigate through. Thank you all for your time this morning. Hopefully you just have a better flavor of what is happening in Washington, and depending on what happens in the midterms, everything I said may go out the window. So, but anyway, thank you for your time. Enjoy the rest of the conference, and thanks to Bruce.
Thank you, everybody.
Good morning, everyone. Now we're going to shift gears a bit to talk about blockchain. Blockchain crossroads, where do we go from here? So we're going to welcome up our moderator, Stephen Ehrlich, who's Director of Research for Digital Assets at Forbes, and he'll be speaking with Patrick Corker, the treasurer from Circle. Please welcome them.
All right. Sorry, this is digging into my hip. Yeah, good morning, everybody. Here to talk about crypto and blockchain. Obviously, the market has struggled along with the rest of the macro picture, especially since November or so this year. But I was talking to a few people yesterday, and they said, "Well, at least we're not Peloton." So I guess that's something. But I think we want to kind of get a better idea of exactly what's happening and what investors can expect moving forward. So Patrick, what do you think are 2 to 3 themes that have really sort of helped set the table for crypto this year?
So, and we touched on a few of things. Circle had an inaugural conference a few weeks ago in San Francisco. We made a number of announcements, but I think thematically, institutional adoption of crypto is a really big deal. Mm-hmm. And we're seeing that in a number of places. Some of them touch on Circle, some of them don't. In terms of those that don't, I think most of you, or at least those who are following the crypto space, may have seen that Boney Mellon, one of the oldest, stodgiest banks in the financial universe, announced they're doing digital asset custody, which is a really big deal. We've known about that for some time. They worked with regulators for a couple of years to make that true. We announced relationships with Robinhood. We've announced relationships with MoneyGram, with Stripe, with WorldPay to talk about how businesses in their everyday workings can start using crypto to improve how they do what they do. So I think that's a huge theme. I also think regulatory scheme changes are going to be a big deal. And so in particular, stablecoin regulation is one of the top agenda items for currently the US government, and we look forward to regulation coming forth in the next, we hope, 3 to 6 months.
What's your assessment of the regulatory picture? Because it's very hodgepodge, especially here in the US, where there's multiple different federal regulators that seem to have overlapping jurisdictions. There's several bills now being pushed through Congress, one of which specifically relates to stablecoins. And it can be very confusing for some to kind of get a sense of what the government's actually trying to do and what's likely to come to fruition in the next, say, like 6 to 12 months. So how do you see the regulatory picture developing?
I think it's very positive and very constructive, quite frankly, for stablecoins and for the way that Circle has built their company. We, as you might imagine, have been closely involved in conversations around what form of regulation might take place. And I think a higher form of regulation is necessary, and the government has embraced that. Currently, Circle is regulated as a money transmitter in all states that offer MTL licenses in the same way that PayPal is regulated today. But I think now that stablecoins have gotten a lot bigger, particularly in the US, and taking note of some of the events that have happened with stablecoin blow-ups, if you will, over the last 6 to 12 months, the US government has stepped forward in a really positive way and said, we need to embrace this, we need to regulate this in a really powerful, constructive way, and I think we expect that to come to fruition sooner than later.
Okay, so just stepping back briefly from regulation and from stablecoins, and actually just quickly, does everybody here know what a stablecoin is? That we're talking about it. Do you know, or are you looking for would it be helpful to provide a definition? Okay.
Okay.
All right. Why don't you go ahead and just make sure we're all on the same page here.
Absolutely, we can do that. So a stablecoin is just a digital dollar on the internet, and the stablecoin that Circle has built, USDC, is a little bit different from other stablecoins out there. It is actually backed dollar for dollar with cash and US Treasuries, roughly 20-80% respectively. And we work with the largest banks and asset managers in the world. And so, for example, BlackRock is our sole asset manager. We do all of our asset management and treasuries through them. Boney Mellon is our custodian. And we have a smattering of banks that we work with to hold cash deposits. So backed one for one at all times. That's a stable coin.
Okay. And for what it's worth, this differs from, I know there's a lot of talk about a digital dollar, central bank digital currencies here. Obviously China with the yuan, and I've seen reports that over 100 countries around the world are at least kicking the tires or doing a pilot in some shape or form related to digital assets. That's different than USDC or other stablecoins that run on top of blockchains, because for one, they're collateralized by cash equivalents, and CBDCs typically are not or will not be, and I think you would agree they are going to run on separate types of platforms other than blockchains. USDC runs on what, like 8 or 9 different blockchains at this point?
Correct. Blockchains just being effectively operating systems. And so you can think of it as a decentralized database where people can do transactions, store information, settle things, et cetera, et cetera. But yes, that's exactly right.
And I know that the rise of stablecoins, I mean, USDC Tether as well, the largest by market cap, you guys are second, I think a touch under $50 billion right now. I mean, that's really helped drive crypto growth over the last couple of years, notwithstanding the last few months. I mean, how do you see Circle going hand in hand with the broader crypto market, and how does that help bring institutions into the space?
Sure. So I think first and foremost, it's probably helpful to understand why stablecoins have grown as much as they've grown. And so when you think about the idea that retail and institutional players might say, hey, I want to buy a Bitcoin, they have to give fiat for that Bitcoin. And traditionally, the first step is to say, I have fiat money, I need a stablecoin in order to buy that Bitcoin, and they would do that on an exchange or via an OTC counterparty. And so the broader interest and growth of the crypto markets has driven growth in stablecoins. Us being a trusted, regulated, transparent player in that space has fueled all of our growth. And what we've effectively done is we've said, let's take that success and that growth and build products and services that allow people to use USDC and other stablecoins for other things outside of speculation on crypto assets. And we may talk about that a little bit later.
Yeah. And one question that comes up a lot when it comes to companies like Circle, Tether that launch stablecoins is they question why there needs to be so much centralization for an industry that prides itself on decentralization. And so how do you kind of reconcile those two potentially competing ideas? When you're
the centralized versus decentralized.
Yeah, where do you draw the line? Obviously, Circle does because of the nature of your business model and how you operate a centralized stablecoin that runs on top of decentralized platforms. But where do you guys draw the line there?
Right. Maybe for the audience, I'll unpack that a little bit to explain why that's an important question. So Bitcoin, which is typically what most people think of when they think of crypto, is by definition decentralized. And so there's no one government, entity, person, corporation that controls what Bitcoin does. There's many people that do that. So there's an even, so to speak, distribution of authority on how to run that network and how that business operates. There is a strong constituency out there that says if a stablecoin is centralized meaning, for example, Circle operates USDC, and there's a lot of control and support, business and otherwise, that underpin how USDC works today, that's at odds with the idea behind crypto, that it should all be decentralized. And so from my perspective, I think it's okay for both to coexist. And so while there might be very good use cases and appropriate use cases for decentralized platforms and businesses on crypto rails, for purposes of USDC, if you want to be a regulated business and you want to do so in an institutional, transparent way, it's very difficult to do so and not be centralized, at least in any meaningful way. Yeah,
and one area where that did come up recently that I think might be interesting to talk about is when the U.S. Treasury Department sanctioned Tornado Cash. For those of you who don't know, Tornado Cash is what's known in crypto as a mixer. It's essentially a giant blender where multiple people can send in transactions. You get outputs, but it breaks the link between the sender and receiver. So it's kind of designed as a privacy-enhancing tool. And the Treasury took I think the unusual step of actually sanctioning the platform itself as opposed to certain users of it. Circle, I believe, agreed to blacklist all addresses that engaged with Tornado Cash, and you did that. And your CEO, Jeremy Allaire, did that because of your nature as a regulated company. And I know that's very important, especially to this group, because one of the big questions I get from talking to many of you yesterday is you're nervous to invest in crypto because of concerns about being attached to some of these illicit activities. So could you maybe talk a little bit about the decision behind how you address this important Tornado Cash issue?
Sure. So as a function of how we run our regulated business, we onboard every customer that do transactions with Circle. And so if you want to buy USDC or you want to give USDC back to us and we'll give you your fiat money back, you have to go through a robust AML KYC onboarding process in the same way that a bank would onboard you. And so for that reason, we work with entities like OFAC, in this instance, the relevant party that said, hey, there's bad things going on here. We need you guys to make sure that people are not able to use this value anymore. So we have the ability with our partners at Coinbase, who we launched USDC with, to say for a particular address, you can no longer use the value contained in that blockchain address, right? Which is like an email address on the blockchain. And so we did that. OFAC said, hey, look, here's the addresses that we are highly suspicious or have confirmed that there's nefarious activity associated with, and we did that. And so that is part and parcel our responsibility as a regulated business. And yes, it was controversial given some of the themes I mentioned earlier that exist in the crypto space, but it was absolutely the right thing to do.
Okay. Just a couple more questions related to Circle, and then I want to kind of go back to the broader macro picture. But for one, this question comes up a lot. There's almost $50 billion worth of USDC in the world today. Where is it? What are people using it for?
So there's probably a handful of things that people are using it for. Most notably, people are using it to buy and sell cryptocurrencies in the broader market today. The other thing that's really important and quite prevalent and growing is borrowing and lending in the crypto space. And so when you think about people needing to borrow Bitcoin or any other currency that exists within the crypto ecosystem, people typically use one leg of that denominated in USDC. And so,
could you maybe just walk through an example for the audience in case they don't quite follow that?
Sure, absolutely. We operate a platform today, I'll just use a Circle example, a regulated platform called Circle Yield. And so people can borrow and lend USDC for a variety of different reasons and pledge Bitcoin as collateral against that. And so maybe not as true with some of the recent market events and where crypto is today, but for a long time there was a structural arbitrage opportunity between the spot and the future price of Bitcoin. And so people who were structurally long Bitcoin as a function of their balance sheet in crypto would say, I'm going to pledge that as collateral, and then I'm going to go use the USDC to go pursue this trade. And so that's a very common use case. There are different permutations of that right now, again, given the market conditions, but that's probably a good example.
Okay. And I also just want to kind of get a sense from you. The events back in May when Terra Luna collapsed really were very dynamic for the stablecoin space. I mean, this, again, is, I'm sure all of you read about it in some shape or form when essentially, I think it was about a $55 billion ecosystem of a stablecoin, a dollar-based stablecoin called Terra USD, and then a token called Luna that sort of backed it, all famously just pretty much went to zero. And there were a lot of concerns in the market, a flight to safety, where Tether briefly depegged, and there was a big surge in USDC, which from people I spoke with, happened because a lot of investors saw USDC as sort of the safer, the more institutionally, the regulated flavor of stablecoin. What was it like inside Circle during that time?
I think it was disappointment and also affirmation. Disappointment that, look, the reality is with the growth of stablecoins and how prevalent they've become on a global scale, there's a lot of folks who've launched businesses that are stable in name only. And so there's very few stablecoins, if any, today that operate the way that we do. I personally believe that there are not. With that in mind, you're going to have people drum up businesses that allow people to buy what they call a stablecoin, but may not actually be backed by anything, which is the unfortunate truth here. And so with the explosion that happened and the collapse of value relative to that particular series of events, it was disappointing to see something like that happen, which casts, unfortunately, a shadow over the entire industry, and that's something that we deal with a lot. I do think it was affirmation of our model. We believe very deeply that what we're doing is a very simple thing that we do consistently every single day, and that has grown to be quite a large company, quite a large enterprise, and so that's a good thing.
Yeah, and I think, I mean, now to kind of just become a bit broader, because of Circle's kind of relationship with its institutional customers, I think you guys are well suited to answer this question, which is why is crypto so highly correlated with the broader macroeconomy? Why does it trade so closely with NASDAQ and tech stocks? And do you anticipate a time when that may change in the future?
I don't know that I anticipate that changing anytime soon. I think broadly speaking, crypto is just another risk asset class. And so when you have liquidity draining out of the system and risk assets selling off, as is the case in the current environment, I suspect that'll continue as long as it continues. I don't see that decoupling anytime soon.
Yeah, it's really kind of funny. I mean, for the longest period of time, we always heard about Bitcoin as this like asymmetric asset, this uncorrelated asset. And for such a long period of time, it was because most of the people that owned it, that might have been the only thing that they owned. They got into crypto for ideological reasons, and as much as people cheered when MicroStrategy bought hundreds of millions of dollars back in, I think it was August 2020, and then PayPal and Tesla and all sorts of hedge funds, all of a sudden they started treating Bitcoin as any other risk asset, so it trades like a risk asset. So I hear all the time from readers wondering when's this going to end, and I keep saying ask Jerome Powell because that seems to be the only answer that we really have.
Yeah.
What do you think the next 12 months in crypto development is going to look like?
If the current market conditions persist, I think most of the growth and development that's happening in crypto is going to happen on the institutional side. We've, as I said before, made a lot of recent announcements about this, but it's the idea that crypto technology and specifically stablecoins can actually make a big difference in how people run global businesses today that are predicated on global transfer, FX, security settlement. Anywhere where money is changed and high velocity of transactions, high gross notional value, stablecoins can make a big impact because they can settle instantaneously for almost no cost.
Okay. And what do you think the next set of use cases for stablecoins like USDC could be?
I think there are probably 2 or 3 channels where I see a lot of adoption happening, most notably payments. I think also FX is probably a big theme that will play out in the coming months. Global FX markets where you can settle, say, the G10, G15 instantaneously for no cost would be a pretty big development, and I expect to see some traction there. I also think the idea of crypto custody is probably one of the biggest things to happen. And while seemingly innocuous, the idea that, again, large companies like Boney Mellon are offering this service in the same way they offer traditional asset custody today is a really big deal, because simple things like that have been sort of gateways to larger institutional capital injections into crypto. People want to know that what you're doing on the crypto side feels exactly what they feel on the traditional security side as well.
And what will prevent that from happening? What are some of the biggest inhibitors?
I do think regulatory clarity is another one that I didn't just mention, but that would be another important theme to play out over the next year that I think will get more people comfortable with how to transact using crypto more broadly. And I have conversations with current and prospective customers all the time about, well, if I have crypto on my balance sheet, how do I treat that from a balance sheet perspective? What does the accounting look like? What are the capital charges? How do I insure against this? Really, really important questions. Those problems are being solved, but I do think a foray into creating clarity around those questions is going to be regulatory clarity. And I think to the extent that that gets delayed much longer than it's already been, that could potentially inhibit growth as well.
Yeah, and it's hard to know exactly when that may happen. We have midterm elections coming up. Obviously, that will put a wrench in any legislation that's kind of before Congress right now too, and then so much infighting just even within the agencies. I mean, the CFTC and SEC pretty much at loggerheads over who actually gets to claim crypto. It really is kind of amazing to see that. But I think it also speaks to the importance and the seriousness of this industry that everyone's trying to kind of mark their territory in some regard. I mean, I get questions all the time. I'm sure you do too. Like, is crypto going to survive, or what is the future of it? And I think sometimes it's hard to know the exact shape of it because it's still relatively new in its journey. And I think sometimes it's also disadvantaged because it has free floating prices and most private companies don't. But it really shows the power that it unlocked.
I think that's right. I think when you have a new asset class like crypto, and you have a bit of a logjam because of all the major regulatory agencies saying, I want a piece of this, I want to regulate this. It's political in the same way that everything else is political when it comes to regulators. I suspect that'll suss out sooner than later over the coming year, and I do think very specifically stablecoin regulation will be a catalyst for that type of clarity. So I do think it's on the horizon.
So we have about a minute left. I just want to throw it to you if there's anything else that you'd like to share, anything that we didn't get a chance to talk about that you think is important for the audience to know.
Yeah, I think probably the biggest thing I would leave the audience with is that crypto is much more than just crypto speculation, Bitcoin speculation. What is the price of a particular token at a point in time? It's much more about the infrastructure side, which is where Circle is playing a big part. And I will be around after this. We won't have time for Q&A, I don't think today, but to the extent anyone wants to learn more about how crypto is changing the way people do business in terms of the movement of money every single day, I'm very happy to answer questions about that.
Great. All right, well, Patrick, thanks for the time. Thanks to all of you for listening.
Thank you.
Okay, thank you for that conversation. We're going to do a quick furniture shuffle. Leave it. Okay, thank you. Can I have your attention? Sorry, we're going to go to the next panel. We just had to do a little musical chairs there to make room for everybody. Thank you. So now we're going to move to a discussion on real estate, opportunities in real estate investing. And I want to welcome our moderator, David Scappoliti, who is the global head of private debt for Mercer. And I'll let him introduce the rest of the panel. Thank you. Please welcome them.
Morning, everyone. Thank you for being here. I guess we are the opening and warm-up for Sam Zell, so hopefully we'll live up to your expectations. I'll introduce myself, David Scappoliti. I'm a partner at Mercer, global head of private debt. Mercer in alternatives manages about $30 billion under management and about 160 under advisement. We're global. We have about 250 people all around the world. And we have a few of our clients here, Mike and Joe. Nice to see you here today. And we have a very distinguished panel. All the folks on our panel are strategic partners of Mercer. We've made investments in one way, shape, or form with them. And I'm going to turn it over to John McNichols to introduce himself and to the rest of the panel.
Thanks, Dave. My name is John McNichols. I am the head of multi-strategy private investing at Barings Asset Management. Barings is a large multi-strategy public-private firm, fixed income equities. We've got about, on the private side, about 150 billion total in assets, 400 plus professionals, global platform. And I manage our specialty private credit fund, the diversified private credit fund, and oversee the, generally speaking, the broader relative value process within multi-asset private.
Steve?
This turns to me. Good morning, everybody. My name is Stephen Harrop. I'm with Reverence Capital Partners. And I have a very distinguished group here. You probably have not heard of Reverence Capital Partners, so I'll give you a little bit more on that. Reverence Capital Partners was formed in 2013 as a financial services-focused private equity firm. We are now through our third fund and manage approximately $7.5 billion on the private equity side. In 2020, we started to organize a debt fund, and I am the deputy CIO of that process. We now have our first fund pretty much done in the market with our second fund. We invest in a range of assets, really focused on securitized and hard assets, cash flowing assets, very much structured deals is the stuff that we focus on. Everything from transportation to real estate to commodities finance, consumer finance, really goes a large range.
Great.
Good morning. Vittorio Lacagnino, my partner at Apollo Global Management, and responsible for capital formation within infrastructure. Apollo manages around $500+ billion across really the spectrum of investing, all the way from investment grade to some of the more deeply distressed private equity plays. Infrastructure kind of sits in the middle, so we try to kind of borrow a page from the playbook from our yield business as well as our private equity business. So we invest in assets with very strong fundamentals, with very downside protected strategies, and an upside into double digits. Within infrastructure, we've been investing really in the space for a couple of decades through our insurance buckets and other capital buckets that we have. And then since 2018, we actually launched a dedicated strategy. So now we have a dedicated team in place, 2 closed-end funds, and really plans to grow that platform.
Keith?
My name is Keith Ashton. I'm from Ares Management, the other Greek god up here, I guess. Ares today is about $320 billion. We're a global alternatives manager. I manage a group, or help run a group, called Alternative Credit, which is as broad as it sounds. We focus on various types of asset investing, focused on investing in portfolios or pools of assets that generate cash flows. Our team today manages about $20 billion. About 60% of that is in private, directly originated opportunities where we're lending against assets or owning them outright. About 40% of our capital is focused on liquid securities in the asset world, so the whole alphabet soup of structured products. We do that as well. And just really glad to be here. Thanks for having us.
Thanks, Keith. And I think your alphabet soup analogy is a good way to sort of kick off with the first question. Title of obviously the panel is Opportunities Today in Real Asset Investing. And maybe Keith and John, you could take the first question in terms of what is real asset investing, because I think most people think of it as traditional real estate and infrastructure, but it has become much like everything else after the great financial crisis. The banks leaving the market has become a much broader definition. So maybe Keith and then John, if you can talk a little bit about what that encompasses and what we're going to talk about today.
Yeah, it's a great question, because I think a lot of people associate real assets with just real estate, and I think we can appreciate that there's many types of real assets out there that one can invest in. And we take a very broad brush to this as well. So we absolutely invest in pools or portfolios of real estate. We do finance REITs, for example, but we also do a lot in net lease, which is kind of a hybrid transaction between credit and real estate. But I'll give you an example of something a little bit off the radar. We bought about a year ago a portfolio of shipping containers, about 170,000 shipping containers. It's going very well. But there's lots of interesting things you do. And we think of real assets a little broadly. We only care about assets that generate cash flows. So we're looking primarily at hard assets that would be on lease or rent to something else. So it could include single family rental. It can include shipping containers, that sort of thing.
John?
So real asset investing, strictly defined, has to include some inflation component, right? Because the difference between traditional asset investing and real asset investing is that real asset gives you protection against that inflation factor. Most of what we do within our multi-asset strategy is going to be floating rate, which by definition gives you some of that short-term correlation with inflation and higher rates, a little bit of protection there. But like Keith and probably the others on the panel, we do go more broadly and focus on the capital preservation and the presence of assets and well-structured, well-securitized pools of assets. And frankly, anything you can buy that can be financed can be securitized and we can lend against that, whether it's a handset program in the Netherlands or pharmacy loans in France or coding school loans in the US. And it's the diversification of the assets and the presence of the floating rate structure in most of these assets. And that really, I think, gives the portfolio the inflation protection that we define, we associate with real asset investing.
If I may, I think in infrastructure specifically, I think the asset class really has morphed in the last, call it 2 decades. Infrastructure really was a lot around real assets with a hard asset base. We used to say if you kick it, it hurts, and that's I think a good way of defining infrastructure. I think over this cycle of investing, a lot of institutional investors really have pushed that definition, and so now you see probably the creeping in of what we would call infrastructure light or private equity infrastructure. These are businesses, most often they're not assets, but they're businesses that have maybe some contractual characteristics and some contractual qualities. They make them a little bit more resilient, but to the earlier point, there may not be that inflation protection that sits in. There may not be a hard asset behind it, and we'd like to think that you get a lot of your downside protection if you actually have a residual value for that asset. So interesting times we're living in.
Terrific. Stephen, maybe you can address, you talked about reverence and the various types of things that you've been financing from a credit opportunity standpoint. I mean, why invest in these assets now given inflation and a recession? I mean, how are you thinking about those types of assets, both in terms of both supply and demand of capital?
I think what we're seeing right now, specifically in the market, and we kind of covered it at the beginning, banks are pulling back, and they have, right? We're going into recession, and they're doing the right things, right? They're reducing their advance rates, increasing, sort of their coupons, and there's holes in balance sheets. One of the big things we look to do when we're working with a sponsor, and invariably we always work with a sponsor, a platform that is already building something, is sort of solve a problem for them. Right? If you really want to drive value, if you want to drive higher returns for yourself, solve a problem for somebody. And so as we look at this market in the different places that we're investing, it is going in where there is gaps in capital structure and providing capital that's accretive to getting a project done, and in so doing being able to demand terms that are not standard terms. So we have invariably very steep covenant packages associated with the stuff that we do. We have security of assets, not commingled in the corporate entity, but pulled away and separated and segregated. Cash flow wins. Get cash flow often and early. These are the things that we're able to drive today. And so the market is really coming to us. As we go into a recession, we can demand all these terms, receive what we think is very substantial returns for it, and this market moves towards us as we stand today.
Keith, maybe you can address what you're seeing in your market. What's driving the opportunity right now? Is it demand? Is it supply, meaning supply being cut from banks and other places? The public capital markets, which obviously have had the public credit markets have had a rough year this year. So maybe talk a little bit about that too, in terms of what's driving the opportunity, and then maybe we talk a little bit more about what each of the other panelists, sort of each of the sectors that you see the most growth in.
Okay, great. Well, there's been, as you've said, there's been a secular shift generally that's created opportunity, particularly for private capital in this world. I think more recently, though, there's been, I think, pretty significant shifts in the supply and demand of capital, and that's kind of what's been driving kind of recent activity, and I think will continue for the foreseeable future. And I want to try to strike a nice balance here between scaring the hell out of you and being a little overly gleeful about the opportunities. But banks have, as we've been talking about, have withdrawn a little bit, and more recently as a result of pressures on capital. And they would like to be lending, they would like to be in this market, but their capital requirements recently went up, particularly for the large banks. At the same time, their credit loss reserves are going up because of the way they have to account for that. At the same time that the money machine of the mortgage market is shutting down, which is a huge generator of value for them last year in particular. At the same time, deposits are down. So they're selling assets right now, and they're kind of not in a position to use their balance sheet like they were even a year ago. And then we're all reading stories about what's going on with UK pension funds and the margin calls on their interest rate swap book that are gigantic. And that story is far from over. And it's not just in the UK. US pensions use this technology as well. So we're seeing asset disposition. They're selling everything that isn't nailed down. their appetite incrementally in the future for private transactions is materially lower than it was a year ago. And then the household balance sheets are very, very different today. You've got, this is the scaring the hell out of you part. You've had a bunch of households that had excess savings a year ago and now have spent all of that money. You have people buying groceries on credit cards now that weren't last year. I was in Denmark last week, and I had a pension fund manager tell me that he's seeing unexpected withdrawals out of their pension fund from pensioners, retired folks, 60 plus years old or whatever, taking money out of their pension because their utility bill is thousands of dollars. He said he spent $15,000 on utilities alone himself this year to date. It's not even winter yet. So I just think there's been real tectonic shifts in where capital is and where the ability to participate in some of these markets from a traditional perspective, which is now the happy part. This is where the role that private capital can play in these markets. And it's not just one sector, it's many, many sectors, and it's because capital's been disrupted. And that's what kind of gets us a little excited, if I'm trying to be nice about this, about the ability for all of us on this panel to go out and create some value for our investors. And that's kind of right time, right place, right time.
We'll talk about risk in a minute, but maybe one of the other panelists want to just jump on Steve, on Keith's comments. Steve, any thoughts there?
Yeah.
Yeah? Ditto?
Yeah. No, it was, we all spend too much time reading, economic research. I'm sure everyone here does, right? And you'll read all the different banks tell you, how the world's gonna play out, and who knows. I think I probably sit a bit more in Keith's bucket. We're gonna go into some very strange recession, and I'm only calling it strange because the last two, sort of major downturns that we've had have been ones where globally governments have thrown capital at it, and they could do that. They had the room to do that. We're going to go into this weird dynamic now where things have to slow down, and you cannot just then throw money at it when you're trying to pull out of the problem.
They'll try, though.
Right?
They'll try.
And so we're going to be in this weird dynamic for a number of years now. And I'm not an economist, don't even play one on TV. So, but we're gonna have this problem for a while now. And I think this is going to be a slow burn recession. We're going to continue to have commodity expenses going up, oil and gas expenses, energy expenses are going to go up, insurance expenses are going to go up. We have somewhat new categories of insurance, right? You think of things like cyber insurance, which no one had to worry about anymore. That is only going in one direction, and it is only growing, right? This is going to be a major component of firms' expense ratios going forward. We're going to get, corporations are going to have pressure on margins. Funding expenses are going to stay high. This is going to be a long one.
Dogs and cats living together.
Yeah. Keith and I are looking to combine homes. And we just met today.
It's a long one, but it's also a race because we're starting at a very strong level with respect to fundamentals, and we were at a strong place with respect to savings, although that's fading very rapidly. Consumer to saving has gotten us back to 2009 levels. So basically the savings rate, which went up and then went up a lot during the pandemic, has fallen to 2009 levels. We're still in pretty good shape. Underwriting standards historically have not fallen like they do during positive times. And we've had this 10 to 12 year run of, it's hard to tell, this is sort of digressing into manager selection, but managers have all done pretty well because we had a good run. You don't really know who's done a great job, who's done an okay job. But the race is that, I think as inflation comes down and getting down to 3-4% should be fairly easy, straightforward. There's a path there, but whether or not the fiscal and monetary authorities lose their conviction at that point is important. There's nothing magical about 2%, except that's what has been the target forever. But today, everybody's very keen on higher rates, and the Fed's going to do this. But I think as we get closer to that 4% level, and we see distress in the economy, and even though we're starting at a pretty strong level, I think that the political will to keep those standards where they are, get to that 2% will fade. And I think that's that's where you've got inflation. That's where real assets are going to matter, because you're going to want that inflation protection, because it's going to be here with us a little longer than people think, I think.
Let's talk about risk, because this all sounds very risky. We were talking about this sort of on the panel, and what's different today in terms of risk and what's going on in the credit markets and how private credit is playing a role in those markets versus 13, 14 years ago when the GFC hit us. So John, I know you had an interesting comment on our prep call regarding how it's been decentralized. Maybe you could start with that, and then Vittorio, maybe you could comment on that as well.
Well, I think this is part of the good news. Keith is right. It's easy to get really, really anxious as an investor. But one of the things that has happened over the last 15 years is that as capital has spread in a more decentralized fashion away from money center banks, even regional banks, you've got more decision makers, you've got capital flowing to places where the risk can be evaluated more appropriately and priced more appropriately. And I think that's good systematically for the economy. So I think some of the dire consequences of economic recession and default cycles and so forth, I think we'll be able to handle them a little bit better. I mean, I know at Barings, for instance, we have pools of capital with varying rates of required return. So we can go out and price risk based upon capital in the low risk category, the mid risk category, the high risk category, and as Steve said, help investors solve a problem. And the losses can then flow to where the capital can absorb them and where it's been priced appropriately. And I think we're really early in this process, and I think it's going to continue. And that's, each of us on this panel, frankly, that's what our jobs are about, is being part of that process.
It's interesting. Our economist was showing us this, that when you look at debt as a percentage of equity, actually it is still within reasonable ranges. When you look at debt as a percentage of GDP, it's actually quite high. So his deduction was we are in a market where it has become more sophisticated. Obviously, there's more financial engineering in place, but has it really driven a growth in GDP? And so, depending on whether you see the glass half empty or half full, you can make your assumptions. I think with regards to infrastructure, there's probably three risks that are in people's mind, and they're pervasive in the market right now: the inflation risk, the rate risk, and then just the economic cycle and the GDP risk. And what we have found is that when it's real infrastructure, at least, you have some level of pass-through of inflation, whether it's through a contractual structure, just because you have long PPA contracts with an inflation ticker, or whether you have a regulatory agreement where you basically are getting paid on the base of your rate base, on your base of assets. That takes care of a little bit of inflation. I think in terms of rates, you see the market still available for the stronger infrastructure projects. You actually see project financing get it done. I mean, we've seen, projects getting done at SOFR plus, 150, which is in that mid-single-digit returns. So there is an availability of capital. And then from a GDP risk standpoint, when you think of infrastructure as an essential asset or an essential service for the communities, like in Denmark, where they had just last week brownouts and blackouts. So when you think about the essentiality of the service, you should think that infrastructure should be shielded, or at least should be a good way to lean into a market like this. Our personal worry is that within infrastructure, you can probably define a very kind of core set of infrastructure assets that have been underwritten at those mid-single-digit return from an equity standpoint. They're fairly levered. At some point, they're going to come up into a refinancing. That refinancing is going to be higher probably than that 5%. So when you have your equity trading inside where your debt is going to trade at, then you're going to have some issues.
So let's pull on that thread a little bit in terms of how are you then financing in today's market, right? If things are coming up for refinancing, or if there's a new project. I think it's pretty clear globally we need more infrastructure, whether it's renewables or other types of infrastructure from an energy standpoint and other standpoint. But can you talk a little bit about what challenges that you're having in the financing markets and how you are solving those? Because I think the rest of the panelists are here to help.
Sure, and our strategy, really straddles across, pure equity positions and then positions that we call them structured solutions, where you can be kind of senior to equity, taking a senior loan of some type or a pref with some level of equity-like or equity-linked returns. So when we're looking at structured solutions, what we see is that there is a bid-ask spread between buyers and sellers. So if you go with the playbook of, I just want to get a piece of your company, I want to get 100% of your company, they're thinking earnings multiples north of 20. We're thinking purchase price matters. So you really need to be very, very disciplined in how you invest in these transactions, and the transaction just doesn't get done. What you can do is create a solution that is a hybrid. So it's got some equity-like returns. You may give up some of the upside, but you protect the downside, and you protect that to Steve's point. You have a collateral package, you have an asymmetric distribution of cash flows, you have a minimum MOIC returns, and then you don't really sacrifice the governance. Our strategy is, it has to be control oriented. So you get your negative consent right. You may get some seats at the board where you can actually force an exit, or force a strategic move, or force an IPO, force whatever it is. So we find that you need to be more nimbler, and probably, and I can speak for infrastructure more so than real estate, this has been a market where investors have just doubled down on money. They've invested at a certain multiple. They sold at a multiple that was higher than that, and this has been the case really since 2007. So the strategy needs a switch.
And maybe the rest of the panelists, Steve, we'll start with you in terms of helping the audience understand structure. Because I know when we talk to clients, we have a couple things we talk about is a lot of these structured solutions that folks are providing. And I think maybe it'd be great to give some tangible examples of those, what that structure means. Because I think it's, if you're an asset allocator, asset owner, and you're not in the trenches actually doing the deal, and to Vittorio's point, there are various layers in a capital stack, and there are different participants in the market who are willing to take different risk return for being in those places. Whether they're right or wrong, obviously we'll see. But maybe each of the panelists, starting with Steve and then Keith and John, just talk about some of the solutions that you're providing to solve the problems that Vittorio and the other owners are facing.
Sure. And I guess everyone on this panel would love now a whiteboard and a couple hours. Most of the people would then fall asleep, but it'll be good fun. It's the same way my kids treat me. Okay. Solving the problem, right? I used to teach a class at Goldman to the incoming associate group, and it was titled something like, "What is truth?" Right? And I would say, okay, here's a portfolio of T-bills. You know what you own. And then I would say, okay, take those T-bills and contribute them to a C Corp and take back equity. What do you own? Right? Now, economically right there, you might say, I still own T-bills. But then I'm going to ask you, well, you have the equity back, but who runs the company? Can they change the assets? What control rights do you have? What can you do with it? Right? Can they lever the vehicle? How have you thought about each of the next steps in the future? And so we would go down this path, until we wound up in some deep black hole somewhere, just trying to get people to think about the different tools that sit in corporate structure, in structured finance. As John said earlier, there's lots of pools of assets. You're looking at cash flows. You can, dice them up all sorts of different ways. As you're sitting with a platform and they're looking at what they're trying to achieve, maybe they're doing a roll-up strategy and they're trying to acquire a number of businesses. That sounds great. We'd like to be supportive of that. What do we want to see to allow them to draw more capital, our debt capital? What successes, what benchmarks will we have in that process? What growth of their collateral pool do we want to see? This gets into sort of covenants and controls. Like, how are we feeling about the business going forward? One of the industries that we have invested quite a bit in going into the pandemic was specifically around mortgage originators. Mortgage originators, interesting business, highly cyclical, and one of the benefits that we have at Reverence and sort of working as a single unit, they came in actually looking for equity. And we came up with a hybrid structure where we were a mezzanine debt provider against a specific pool of assets. And that was to get them moving again, doing their business again during the pandemic, where things had changed drastically and they had burnt a lot of their equity. So why do I tell you that story? It is sort of now saying, maybe the corporate entity I don't love, but mortgage assets I might really love, right? Especially newly originated assets. That might make an awful lot of sense. And there might be an attachment point where I feel very comfortable lending against those. And then if you tell me, well, those assets are only going to stay on the line for 2 weeks, all right? So now this is a velocity game. That sounds interesting to me. And so where do I want to attach there? And I know I'm going really long-winded, but then you have senior financing on top of you. How do you want to have a relationship with the senior finance provider, right? And this comes into lovely discussions of intercreditor agreements and how they connect to each other. And you have to make it all work. They take time, they take patience, they take experience. But ultimately, the hole can be filled, I guess, is what we would tell you.
We'll get a whiteboard for next time. But it's interesting because I think, and again, when we talk to our investors and our clients, a lot of them are like, the high yield market, the broadly syndicated loan market, covenant light, leverage is up, pricing is down, and you hear all that. And I think, Keith and John, maybe you could address it because Steve just hit on it. In these markets, particularly in these asset-oriented markets, you don't have the same mechanics and the same types of issues or concerns from a risk standpoint you do in some of the more liquid markets. So maybe Keith, let me touch on how these things are structured. You do have covenants, and really sort of bring that out, I think, for the audience. And then we'll turn a little bit toward diversification, because that is a very, I tell you at Mercer, we are, particularly in private credit, diversification is absolutely a key for us in putting together portfolios for either our delegated solutions or our clients. So Keith, if you can talk about structure, covenants, and how it's different than some of the other liquid markets, which, by the way, Ares does participate in, and those markets are okay. But I think as we talk about real asset investing, what are the benefits, for investors who are thinking about giving you capital?
Well, you said it. You described the way, and the way we approach it as well, which is really trying to determine on a given asset portfolio what kind of credit enhancement you have. And one of the benefits you have as an asset investor is that you're never, I wouldn't say never, you can choose to do this, I suppose, but we never take single name risk or binary risk. It's never financing an asset. It's always investing or financing a portfolio, diversified granular portfolio. And that could put you in a different realm, in my opinion, with respect to the kinds of risks that you're taking. My old boss used to call it death by 1,000 cuts, as opposed to binary risk. And we love that because it gives you the ability then to be very draconian in your outlook in terms of performance of those assets. And in that environment, in that scenario, build enough credit enhancement to pay you back. The weird thing is you can get away with that because our markets, I think the reason why we get to have covenant-heavy transactions is because the competitive elements and the institutionalization of our markets isn't as it is in other more traditional sectors. It used to be a lot more consolidated. It used to have entities like GE Capital, very big in the asset finance world, and they don't even exist anymore. So you've had a kind of a fragmentation, even a hyper-fragmentation of our markets, which allows you now, as a lender or an investor, a lot more ability, particularly if you bring scale to a solution and some flexibility. It allows you to kind of design the investments you want to see. So what we try to solve for, in addition to a well-structured transaction with lots of covenants and protections, we're looking for a particular profile of cash flows in all of our transactions. We can do 30 different sectors, and if you looked at every single one of those deals, they all rhyme. They all have very front-loaded cash flows, and you mentioned this. We try to get our money back within 2 to 3 years, which is a very different profile, if you think about it, than a traditional corporate or private equity investment, where it tends to be very back-ended and very residual-oriented. We try to flip that into very front-loaded, and that allows you also to proceed even in times of uncertainty or risk with greater confidence, because you have visibility into those cash flows that you're trying to get, And there's much more stability and predictability into that. And again, we can only get away with this because of the ability to bring capital and solve a problem. If this was a super overcapitalized set of opportunities, I assume the competitive landscape would just draw to the lowest common denominator and we'd look like everybody else. But we don't even know how to spell covenant light.
So, and I'll go to John in a minute, but talk about what you think. I mean, and you know, nobody's going to hold you to it, but how big is that market demand in these pools of capital that you're fishing in? How big is that pond in terms of dollars? How many trillions of dollars do you think that is?
You're asking me?
Yes.
Well, we it's going to sound like a Shark Tank pitch here. The asset market of what you can count, independently count and verify, is $4 trillion. It's way bigger than that because there's a lot of stuff you can't count because it's not publicly disclosed. So I think it's a huge, huge market. That is not our market opportunity. Our market opportunity is a small subset of that. It really is, I think the interesting part about capital in our market in particular is that it's most, I would say, funds and strategies that approach this market tend to be relatively narrow or focused. So there are funds that do shipping. There's funds that do equipment leasing. There's funds that do litigation finance. There's little niche funds. That's weird, by the way, don't you think? Because in credit markets, you don't have funds that say, we're going to do utilities or we're going to do healthcare, and that's it. So I think it's an interesting phenomenon in our market where you have tremendous specialization on one hand and a lack of breadth and scale on the other. So I think that's a big part of what creates the market opportunities for us and the way capital is formed.
John, Steve, maybe you can give some examples, and Victoria, we'll turn back to you, but in terms of examples of these pools of assets, because I think Keith said it's just not a loan to one counterparty, it's a pools of assets with hundreds, if not thousands, of counterparties. So maybe give the audience just some examples that are in your portfolios. You don't need to name names.
Well, gosh, I mean, as I said in the outset, literally any asset, hard asset or financial asset of over $1,000 can be pooled and securitized. So we could all sit up here for an hour each and list and probably not overlap. But
you have 2 minutes.
I have 2 minutes. I mean, well, some of the things we're looking at now are some pharmacy-backed loans in France. The French regulatory environment is such that pharmacy licenses, if you will, are scarce. They're valuable, and pharmacists tend to have to borrow to acquire them. But the government regulates them not unlike a utility, and so there's a real asset value to those pharmacy loans, and so there are opportunities to participate in that, and there are similar opportunities in different countries. The diverse Europe, despite being part of an economic union, still has regulatory differences country by country, and so we could use examples there. I do think that one of the things Keith said is important, and that is the customization that we can achieve versus, I spent the beginning of my career and much of it in public markets. And so the level of interaction between capital provider and originator is intense. And so we are able to go to the people who originate loans that we want to buy, that have a similar credit philosophy. I know Steve said, or somebody said, or Keith, I guess, mentioned the difference between lending to a company and lending to and lending on an asset. We sort of like both. We like to find people that think like we do that we might lend to as a corporation, but find that the better risk-return standpoint is in the asset-based solution. And unlike some of the folks up here, my mandate is actually broader and does include some corporate stuff. But I think that is not only leads to a better front-end sort of onloading of risk for us, but also on a sort of a going forward basis, a better outcome in the sense that private negotiations around things like covenant breaches and even payment defaults tend to be more constructive than they are in the public markets. And so there's less value lost, less time consuming, legal fees are a little lower because you can anticipate more of the problems on the front end and you deal with them contractually. What else? I mean, I'd mentioned handset loans in the Netherlands, coding school loans in the U.S. I mean, literally anything can be.
Steve, what types of things have you done in terms of, have you done loans to pharmacists to buy licenses in France?
we did look at something like that, and we've looked at coding camps, and so we've hit a few of these. One of the interesting things that and it's a bit of an infrastructure play too. If you think about it, the need for sort of broadband and Wi-Fi networks expand all over the country, and there's niche markets where currently it's less developed. And I know this is going to sound a little bit crazy, but it's things like, how do you get that infrastructure to RV parks? How do you get it into student housing? How do you get it into military bases? And it's an interesting little quirky market. The cool thing about it is once you have the infrastructure in place, people need to use it, what you're going to get paid for it, the cash flow is coming off of it. It's a value-added service, and I guess probably the biggest risk, and we would never be in it this long, would be a major technology shift, right? And then you'd be in trouble, right? But get the point.
Yeah, but
2 years.
Yeah,
2 years. I think we'll be good.
Well, no, and to your point, I think that the digital infrastructure space is extremely interesting right now. We've done a number of transactions, all the way to when you think about digital infrastructure, really the first thing that comes to mind is it wireless or is it wired? So when it's wireless, is it a big tower or is it a small tower? All of those come with their sets of opportunities and risks. So we like to think that when you have a large wireless tower that is anchored by one of the large tenants, call it an AT&T or Verizon, where your value add could be you build a network of those towers, you co-locate other tenants in addition to the cornerstone tenant, and then you package it up and you sell it as we announced a couple of weeks ago. Then you can make very solid returns on a fairly de-risked strategy. Another type of strategy when you move from wireless to wired would be the transition from copper to fiber. So instead of laying new fiber, so taking the risk of doing something completely new, you can actually swap that copper into fiber. So you already have a pool of customers. You have your cash flows that are coming in from the copper. So when you underwrite that transaction, you can really underwrite with a solid downside case, and then you say, okay, what if I convert X or Y or Z, and those are my excess returns. There is and especially in Europe, since we're in the theme, there is a concept of fixed wireless access. So it's the ability of providing a fixed, it's a backhaul basically, is a large cable into an antenna, and the antenna that actually shoots the signal into a dish. And this is for situations like in Italy, where I'm from, where you have a lot of those medieval villages where, God forbid, you can dig, of course, and they're very hilly, so it's very hard to get cell tower reception. So if you play in that space, then you could probably average your bet. And to your point, David, I think you're talking about diversification. I mean, if you take just one completely unidirectional bet in some of these transactions, you may run the risk that the regulation change, the technology becomes obsolete, your assets become stranded. So I think that's an interesting place to play in infrastructure.
And Vittorio, just keeping with you, and then we'll circle to the other panelists, but where are you seeing opportunities, US, Europe, rest of the world? Obviously there's a lot going on these days in different parts of the world, particularly in Europe. So where do you see the demand, and where are you fishing for opportunities right now?
Look at, and obviously as Apollo, the platform is very scaled, but it's most scaled in the US. That's where we see a lot of opportunities. When you think about the large cap space and the mid cap space, it's a little bit to your point that the mid-cap space is very fragmented, perhaps less sophisticated, so that's the opportunity to engage in bilateral discussions, whether you want to provide equity, or you want to provide debt, or you want to provide anywhere, and you want to play anywhere in that capital stack. I think there's a couple of tailwinds that we're seeing in the US. The Inflation Reduction Act obviously speaks for itself. The fact that new renewable, I don't know what it's called, right? But it is a climate bill. But the fact that you have long-term visibility to some of these investment tax credits and production tax credit allows developer to take a longer-term view about the development pipeline. The fact that you don't have to find necessarily a tax equity for it. Before there was always a cumbersome structure to get some of these deals done. Now you can actually sell your tax credit for cash, so it may be at a discount, but there is an outlet there. The fact that you want to digitalize a little bit more, in the U.S. I think that's quite important. The one thing that we're a little bit concerned about, and probably rightly so, is the geopolitical risk in Europe. And obviously, you have an energy transition play that is unfolding as we speak. You can take the view that Europe was going to be a longer-term buyer of hydrocarbons. You can take a view that they are very much an opportunistic buyer of hydrocarbons, and that maybe they switch back into renewable energy. So we'd like to think that taking that bet may mean being found with a stranded asset down the road. So we'd rather stay a little bit farther away from it. Ultimately, infrastructure, again, in its true nature, is hard assets. So these are unmovable assets. So if something happens in that geography, it's not that you can take your IP and just move it somewhere else. So we'd like to think that a very strong market like the US, when we see everything else that is happening in the world, it probably is the best playing field for our strategy.
I'll just jump in on that, just really quickly. The rule of law really matters.
Yep.
If you're going to be a heavy structured person, if you're going to care about covenants and bankruptcy protection, rule of law matters. We're seeing plenty of opportunities in the United States. No reason to stretch further.
Yeah, that's a panel. That's a different panel for a different discussion. But we would absolutely concur with you on that. Keith and John, maybe again, Europe, U.S., rest of the world, just given where we are and where we're going, where do you see the most opportunities and where are you fishing?
If I were to force rank our world, I'll give you four things that we're focused on right now. Residential mortgages, that market's broken. Consumer lending we think could be interesting. We've really been avoiding it because of the stimulus impact on performance, which is now renormalizing. That could be interesting. Regulatory capital motivated transactions, that's going to be a big thing.
Yep.
And asset portfolio disposition from traditional holders of those assets, and the whole pension LDI situation is emblematic of that. Behind that, I think, sits lots of additional adjustments. The cost of financing everything has doubled or tripled since the beginning of the year, but asset yields generally have not kept up. We expect asset yields to adjust as a result of the cost of financing them, and as a result, we think there will be asset plays in the next leg. Saved you 30 seconds. Sorry.
20 seconds.
I think there are some really interesting commercial mortgage construction loan opportunities today. Staying in real estate, I think the STEM-related real estate equity properties, tech, science, health and education, also some opportunities there. Our dedicated real asset team likes timber for a lot of reasons. There's a very compelling and complex thesis around that. The consumer, I think Keith is right. It's really interesting. I think we're probably a little early on that one, but that's something that
totally early, but it's really going to be interesting, I think.
During the course of 2023, I think it gets a lot more interesting.
Okay, and we're 22 seconds over. Inflation a year from now when we're sitting here, and I want to thank Jim and Bruce for inviting us on the panel today, but if we were sitting here a year from now, where do you think inflation is? And then, 1 second. Keith?
I'm a higher for longer guy.
Okay.
I'm not going to give you a number. I don't know. It's going to be uncomfortable.
Okay. Turia?
Yes, probably twice as high as what the Fed wants it to be.
I think Keith is my best friend in the whole wide world, so I'm going with him.
John?
Mid single digits.
Okay, well, there you have it. Thanks, everybody. Minute over time.
Okay, now we're moving to a conversation with one of the legendary investors and entrepreneurs in the world, Sam Zell. Please join me in welcoming Sam. He's moderated by Maneet Ahuja, senior editor at Forbes.
Good morning, everybody. What a great event. And so we're here with a man who needs no introduction, legendary investor Sam Zell, founder and chairman of Equity Group Investments. Most of you know him in this room as the king of real estate. Of course, you do a tremendously more than that. And for your unbeatable track record in the world of real estate, spinning distressed assets into gold. But ever the business rebel. Yes, that's a nod to your book. Sam started investing in real estate as an undergrad at the University of Michigan when he should have been sitting in the classroom. But worked out pretty well for you, right, Sam?
Yep.
Yeah. Awesome. So Sam, you've said this before, you've been an investor for over 50 years, and this is the first time, but there's only been one time where you saw a Fed chairman do what he said he was going to do. So kind of going into the environment right now with the Fed, where we've seen all these rate hikes this year, 4 interest rate hikes, and signaled another 150 basis points by early next year, and inflation at 40-year highs. At what point do you think the Fed's approach will ultimately work?
Well, I mean, the one Fed chairman you're referring to is obviously Volcker.
Volcker, yes.
And the result of Volcker was, 30 years of, or 40 years of lowering interest rates and lowering inflation. The current Fed chairman introduced the concept of transitory inflation, which is a little bit like mental masturbation. And it was just a joke. But unfortunately, it delayed the Fed from taking the steps necessary, and I think the inflation issue is very serious. Mm-hmm. Whether the Fed will be able to stick to its guns remains to be seen. There's going to be a lot of political pressure. I mean, you're seeing it already. At every suggestion of a possible change in policy, everybody's cheering it on, etc. The reality is we need to pay the price here. Mm-hmm. And in effect, I think history will probably go back and look at this period of time and say, the Fed lowered rates because of COVID, etc. Mm-hmm. But the lowering should have probably stopped at 2%.
Right.
I think we probably got very little by lowering rates beyond that. But caused a lot of inflationary pressures mm-hmm. that I think are going to take some pretty serious movement to recover from. I hope that 4.5% or whatever the Fed is talking about in the next 2 raises is going to be enough. They're making a big excuse about the fact that they're attempting to raise rates early so they don't have to raise them later. Mm-hmm. Somehow or other that's BS.
It feels like a little too much too late, in fact, right?
That's right. And so therefore, it's not, they're not raising rates a lot up front. They should have raised rates a year ago and didn't. And even when they did start raising rates, they raised rates 50 basis points when they should have raised them 100 basis points. And frankly, I think they raised them 75 when they should have raised them 100. Mm-hmm. So whether or not that discipline will hold itself out, I don't know. We're dealing with very unique times. I mean, we've added $8 trillion of debt in the last few years as a result of COVID. $8 trillion. Remember when the Congress used to do things in billions?
Right.
I mean, and now we're dealing with the trillions. I just don't know how much more the world was going to take of buying U.S. debt. Mm-hmm. And obviously, there's a very significant risk of the dollar losing its reserve currency status, mm-hmm. which I think would be extraordinarily deleterious for the United States.
Yeah, I mean, another legendary investor who is a big friend of the Greenwich Economic Forum, Ray Dalio, has been saying this too. We've borrowed from our future instead of setting us up for our future. So,
I think we've reached a point where we're not sure how long the future is.
Wow. So you're painting a pretty dire picture here. And
well, I mean, I don't think I'm painting anything unusual. I mean, look at what happens where countries around the world lose their discipline. They get huge inflation, they get huge disruption, and I'm concerned about the United States having sufficient discipline to get us from here to there.
Do you think that the credibility of the Fed has come into question?
Oh, I don't, ever since they invented the word transitory inflation, their credibility is in serious question.
So if you were sitting across from Chairman Powell right now, what advice would you give him to kind of steer the U.S. economy back on track as much as possible? I mean, we're in a pretty deep ditch here.
Yeah, I probably would start by saying, where were you? I mean, what were you thinking? I mean, I sat there, over the last couple of years and looked at them reducing interest rates and flooding the market with $80 billion a month of stimulus, and looking at what was happening on the cost side of things, and I couldn't understand what they were doing. And to some extent, there's maybe they were acting politically, but whatever they were doing wasn't good for the U.S. and wasn't good for the U.S. economy.
So shifting a little bit more to the corporate sector, fellow real estate investor and Squawk Box guest host like yourself, Barry Sternlicht, said recently that the economy is breaking hard. We all know that. CEOs are losing confidence. What are other folks in your industry, what are your peers saying should be done? Are they in agreement?
I've never had a long track record of having everybody in agreement with me.
Right, I do know that.
So I don't think the current scenario is very different. We have, although real estate is what we're known for most, the percentage of real estate in our portfolio has changed over time, and at the moment it's near an all-time low. So we're about 70% non-real estate.
Right, healthcare and other industries.
30% real estate, healthcare, logistics, oil and gas, a lot of other stuff. And I thought I saw Barry's comments the other day. I thought his comments were a little extreme. What we're seeing is a softening in a lot of industries, but nothing yet that would suggest some kind of significant depression or hard landing. I think that remains to be seen, and how we deal with it. And frankly, there's a lot of issues all over the world that are going to affect that. I mean, obviously the war in Ukraine, what's going on in Iran right now, what China is or isn't going to do. I mean, there's just a lot of factors that all have to be plugged into, whatever kind of a conclusion you come to.
So you spoke about a depression, but technically some folks are saying that we're already in a recession. Recently you had said we're not there yet. How do you feel now?
I don't think we're in a recession yet. I think things have softened. And I don't see much out there that would change my view that softening is going to get hard again soon. And I think, this concept of mark-to-market, which has always been a capitalist tool, is really needed here. And so I think that we have more yet to come, but I don't think we're in a recession quite yet.
So you just said, inflation is a huge concern. We're at 40-year highs, and we saw the Inflation Reduction Act pass in August. But what other policy?
Excuse me, the Inflation Reduction Act?
That was the title of it. Well, that's what.
I mean, it was an inflationary bill, and
Yeah.
it resulted in a lot of extra spending.
Right.
And irresponsible.
Right. That's why I wanted to get your thoughts on it. That's what the government called it. That doesn't mean that's what it is.
Am I being too subtle? I mean,
no, you aren't. Back to your book. You are always a straight shooter, Sam, and that's why we love you. So yeah, I mean, let's delve a little bit deeper there. Did that just get us deeper in the hole? It feels like there's a lot of critics that are saying, same as you, that it's a misnomer on the title there.
I think the title is very, very misleading. I don't think the American people are going to be fooled by it.
Mm-hmm.
And I think that it's only going to add to inflationary pressures, not decrease them.
Mm-hmm. So what legislative action should Congress and the government be taking right now?
Stop spending money. Stop spending money. I mean, we're spending money we don't have. We're creating obligations that we can't meet. Just think about the fact that the average cost of government debt a year and a half ago was under 2%. And at that level, we could, quote unquote, meet our obligations. That number is going to be 4% very shortly. And that means that we will be paying deficits. We'll be paying interest with deficit financing. Mm-hmm. Not a prospect that makes me smile.
Mm-hmm. And so central banks, we're talking about the Fed, and central banks are often at odds or trailing government leaders in terms of economic priorities. Do you see this changing in the year ahead? Do you feel like, corporate America, leaders like you are being very vocal about what needs to change, what needs to happen, that the spending needs to stop? Do you feel like Washington is listening?
Well, the real problem is that we really believe spending should stop on things that we're not involved with. Mm-hmm. And where spending is beneficial to us, we're all in favor of it. That's not what I would call discipline. Mm-hmm. And but I think the absolute, you just can't spend $8 trillion in 2.5 years and not have that come back to bite you. Mm-hmm. And I think that and unfortunately, it's not something that's going to come back and get corrected in 12 months. Mm-hmm. I think that $8 trillion is going to be hanging over the U.S. economy for some time to come.
Mm-hmm. And so
as it is at the other central banks around the world, all of which, in my opinion, excessively dealt with COVID. And I think when we look back on it, 20 years from now, I think we're going to look at the world's response to COVID as not particularly productive.
Mm-hmm. So where should we specifically cut back on spending? Where do you see opportunities for us to kind of rein things in?
Well, I think that the whole social support system that doesn't really answer the question, how are you going to pay for it? Mm-hmm. The fact that we're dealing with a defense situation where there's no question that we're going to have to spend a lot more on defense mm-hmm. than we have been planning. And we've got a lot of quote-unquote partners around the world who better start doing it as well. I mean, mm-hmm. I think the whole Ukrainian thing is proving beyond a reasonable doubt that there's no reason to be comfortable and there's no reason to sit back and say, well, everything is going to be fine. Mm-hmm. And so we've got to, particularly, I'm concerned about what I would call discretionary spending, mm-hmm. Where it's one thing when you're quote unquote really doing, let's call it infrastructure. Mm-hmm. Well, we passed a giant infrastructure bill, but in order to do that, we also had to pass, a huge public expenditure social programs that we can't afford. Mm-hmm. And the sooner we wake up to that, the better, and the faster, the better.
What about student loans?
I think that that's maybe one of the worst ideas that anybody's ever come up with.
I wish I could get my student loans paid for.
Well, first of all, I mean, I think student loans as a whole are something we can't be too proud of.
Right.
It's just another social crutch, and in many cases led to universities and schools increasing costs because they could, because in effect the government was providing the difference. And then after you encourage people to borrow money and get a degree, whether that degree was economically justifiable or not, and then you start creating, programs to cut the responsibility, that doesn't sound good to me, and that doesn't sound a precedent that I think is worthwhile.
And infrastructure. I mean, we do have an infrastructure problem in this country.
We have a huge infrastructure problem, but we haven't been able to get the capital out of Congress to deal with the infrastructure because at every point there's a quid pro quo. And the answer is you want $1 for infrastructure, then we want $1 for more social programs. We can't afford it.
So it's no secret that usually during times of market volatility, we see a flight to safety, yet at the same time, gold has seen 6 months of consecutive losses, the longest streak, I think, in monthly declines in 4 years. What's your outlook for gold going forward?
I actually bought some gold in the last year.
Oh, you did?
I bought some gold stocks and I bought some real live gold. I've never done that before.
Wow.
It's not of a significant enough amount to change anything. But to me, it's reflective of the fact that I'm very concerned about fiat currencies. We had a gold standard. We had for many hundreds of years. Our monetary systems were predicated on real collateral, for lack of a better word. Obviously, since Nixon got rid of the gold standard, and there's been frankly a significant lack of discipline overall, I think that we've created all these fiat currencies, and particularly during and after the Great Recession, there was an extraordinary expansion of governmental, like the Fed. I mean, in the Great Recession, the problem was the banking system was weak. The banking system today is very strong, and that's the good news. The bad news is the country's economic system ain't so strong, and I think there's a lot of risk that the Fed will not be able to control and discipline the system.
You spoke about the banking system being really strong, and we know that after record investment we saw during COVID, there's a lot of dry powder sitting on the sidelines. There's a pullback in capital markets activity and things like that. When do you see that resurging, and do you see that as a potential opportunity to push the economy forward in Q1, Q2?
I don't think so. In other words, I think that a lot of the problems that we're dealing with today are the result of excess liquidity. And we've just begun to take that liquidity out of the system. And just like the first question you asked me was, will the Fed be able to, discipline itself? Remains to be seen, because it's, liquidity and lots of liquidity is very seductive.
And so we spoke in the beginning about diversifying your portfolio away from real estate, that it's at an all-time low, right? And 70% is in other areas. There's a ton of investors in the room that are obviously looking for cues from legendary investor like yourself as to maybe pockets of opportunity. Shippers is one of those areas where I think you have exposure in your portfolio. And we're seeing a slowdown there too in anticipation of a recession. What signs would you be looking for to reverse that? Is there a counterintuitive play to be had here?
Well, first of all, I must be asked at almost every one of these kinds of sessions about what markets am I interested in and what signs am I looking for. The reality is that everything comes down to the deal. In other words, we were doing energy deals where energy was a bad word. Why? Because the deals reflected the fact that it was a bad word. So I think that it's still the circumstances and the individual stories or pressures that create the best opportunities. I just don't believe in saying, well, you know, railroads are going to be great. Let's figure out how to invest in railroads. We've invested in railroads where the opportunity was significant and it was well worth the risk reward.
But looking at it as an economic headwind, do you see an easing of supply chain issues with relation to shippers? Are you seeing any signs? Maybe not. I totally hear you in terms of an investment play. It comes down to the deal. But in terms of supply chain pressures, that's been dragging on the economy as well, the global economy.
There's no question that the supply chain scenarios are getting better, but they're getting better at the same time as demand is decreasing. So whether or not the total sum is a plus remains to be seen. I mean, I think we've got to deal with the fact that we created massive excess demand. We fulfilled that demand by providing, you know, unlimited liquidity and free money. And I think that that's never a program that makes any sense, and I think we're paying for it.
So we just saw OPEC cut production to boost falling oil prices. And given the disruption already caused by the ongoing war in Ukraine, what impact do you see this having on the economic recovery?
Remains to be seen. I think it was, you know, in other words, I think Russia and the rest of OPEC envisioned a reduction in demand and therefore tried to, quote unquote, get ahead of it as opposed to trying to raise prices after the situation has already started. So I don't expect significant demand. Might be some demand in terms of the midterm elections by virtue of the fact that I think over the next 6 weeks the price of gas is going to go up. And just like I think it probably went down too much over the last 6 weeks. I mean, you know, if the government can quote unquote release the you know, the strategic stockpile at the rate at which they released it, which reduced, you know, which increased supply and therefore reduced pricing. You know, we have less reserves than we had before. There's a price to be paid for that. And I'm concerned about too much response to short-term needs and not enough response to what's in the long-term interest of our country.
Do you think that we'll see an evening out by next year?
I think that if we have a softening of the economy next year, which I envision, I think we will see, frankly, that the OPEC rise in supply probably had not too much effect.
So looking at this as the bigger picture, folks are starting to whisper now, or maybe a little bit more than a whisper, that we're seeing it's a little bit reminiscent of 2007 in terms of the real estate market. Who better to ask than you, obviously, but I would love to get your perspective on the 4 main asset classes in real estate right now.
Well, first of all, I think the comparison to 07 is not correct.
Okay.
07 was a very, very different scenario. You had, you know, an unlimited availability of capital. You know, people were treating debt like it was cash, which it wasn't, and we had a lot of irresponsibility. on the banking system and the lending system, etc. I don't see that being the case right now. What I see is that various elements of real estate have got weaknesses to it. I mean, the office space market is an example.
Right.
If you look at what the publicly held office space companies are trading for, they're trading for huge discounts to theoretical NAV. You see NAV numbers of 40 and the stock's trading at 10. Well, I can guarantee you that the 40 is bullshit. And the 10 may be too low, but 2 TOO is an unknown. I mean, if the real number were 18 and it was trading at 10, maybe that's not, maybe that's an appropriate discount. So, I think the office space arena is a one where there's a lot of, there's just a lot of repricing going to go down and a marking to market that's going to change that whole arena. It's obviously impacted by the whole question of
return to work.
Return to work. The day that the world shut down in 2020, I went to work. And I've been at work every day since. And
what about the rest of your company?
Well, I have encouraged everybody to come to work as often as possible. I don't believe work from home makes any sense. I don't believe you can motivate by modem.
I love that, motivate by modem.
I don't believe that you can create the mentoring and the learning process and the connections necessary in order to make work viable. There may be some professions, maybe IT, where you could work remotely, but I think there are very few of them. And if we don't get back to work soon, our country is going to pay a very big price for not being at work.
It feels like, at least in New York, in this tri-state area, there's been a return to work. Across certain industries.
In New York, it's give or take about 50%. In Chicago, it's about 50%. The activity level outside of attendance at office, has been increased significantly. But I think that that people are unfortunately using this whole return to work thing as a way of not being at work. And pretty soon I think we're going to see a lot of people fired because they're going to be, employers are going to start questioning whether they are really at work or not.
No, we're already seeing a lot of layoffs. Yeah. We're seeing it from the big tech companies. We're seeing it across Wall Street. I think Goldman, Meta, Google.
But the standard is going to be when it comes time to lay off people, do you just lay off people or do you lay off the people who don't come to work?
Well, I think they said, Jamie Dimon said, no one's going to be warming your seat, right?
Yeah,
so
right.
It's going to be the people who don't return to work first, is at least how, as a journalist, I'm reading it.
As it should be.
Yeah. So what about the broader commercial real estate market?
Well, I think
I heard you say recently on TV that the luxury office market is doing well. Maybe I misheard that.
Well, everything is relative. The answer is that in an environment where there's a lot of pressure on coming back to work and making work more interesting or pleasant or palatable or better ventilation, there's no question that companies are taking less space and paying more for it to provide their employees with a better environment to work in. Outside of office, retail is still very much of a falling knife. At the very top, the very best malls continue to do okay. And at the very bottom, the shopping center with a food anchor and a drugstore and a couple of shops continues to do well. And everything in between is to a large extent obsolete.
Because of the shift to direct-to-consumer.
Well, it's partially the shift to direct-to-consumer, but you have to look at the historical statistics. The United States has historically had 5 times the number of square feet per population of retail as, say, Europe.
Wow.
So we've in effect overbuilt tremendously in that arena, and you know, the combination of e-tail and the combination of the COVID, et cetera, has definitely called into question whether that retail base need to be anywhere near that size. On the residential side,
I was going to say, it feels like just as, you know, just even in my neighborhood, when shopping centers get shut down, just another condo building goes up. Is that the solution to avert a crisis in the commercial real estate space?
I mean, I think that if you look over the last 20 years, with the exception, you know, but basically up until the Great Recession, we built, give or take, about 1,250,000 residential houses a year, give or take a million single family, give or take 250,000 of, not single family, but 250,000 of multifamily. And then, depending on the year, anywhere from 50 to 100 of mobile home parks or mobile home or manufactured housing. Since the Great Recession, the number that was 1 million started out at 250. It slowly increased to about 650, but it's still significantly below what it has historically been. So that's why the multifamily business and the mobile home park business and housing for rent has been so strong. I think more supply is going to come. When, depends on when.
You said housing for rent. Housing for buy is another picture entirely, I mean, right? With 7%.
I've been in the business 50 years, and I've never seen a situation where the monthly payment doubled in 9 weeks.
Wow.
And that's basically what happened. Now, you could argue that the monthly payment before this was ridiculous.
Was too low.
I mean, in other words, you know, you had a single family for rent business that was predicated on buying at a 5 cap and financing at 2.5. Well, the 2.5 went to 6. So all of a sudden, that's not an attractive investment, and there's no positive leverage.
So looking outside the U.S. then, you're known for seeing opportunities others don't. With all of the volatility we're seeing in the U.S. and the situation overseas, are there pockets of opportunity globally that are appealing to you right now?
We're probably less global today than we've been in 20 years.
Wow.
And that's primarily because of my comment previously about currencies and the fact that currencies are artificially being supported, and therefore you're seeing volatility that's just unbelievable. I mean, in 2002, we invested in Brazil, and the real was 167. Today, the real is 600. I don't care how much growth you have. You can't have enough growth to overcome a 6 times depreciation of the currency. And although the real is one of the more extreme examples, there are just tons and tons of currency examples around the world where currencies have weakened by 40, 50%, let alone 600%.
So we're sitting in the hedge fund capital of the world. How do you hedge risk then with, you know, we're in this situation in the U.S., we're in not a great situation overseas.
How about discipline?
Right, it all comes back to discipline.
How about caution? How about the fact that, you know, I mean, it's, you know, we have a publicly held company that over the last 5 or 6 years, we've liquidated everything in it.
Wow.
So we've got $3 billion in cash. And normally in an inflationary period, you'd say, gee, having a whole bunch of cash is not a terrific idea because it's depreciating every day. But
we heard Dalio just say cash is no longer trash.
Well, I read his quote yesterday, and I couldn't agree with it more. And by the way, when you compare that company versus other companies in its space, it's massively outperformed because it's just had cash.
Mm-hmm. So you're sitting on $3 billion of dry powder.
Yeah.
How are you dealing with some of the challenges some of your portfolio companies are facing right now?
Well, as I said before, our companies are doing better, frankly, than my view of the future. We've been very cautious. We've been encouraging our companies to anticipate. A year ago, we sent our companies out and said, "You got to get price increases." Mm-hmm. And they said, "Well, why would we want to disturb our customer base?" And I said, "Because your costs are going to go up, and it's a lot harder to catch up than to anticipate." And the result was they went out and they got increases, and and consequently, in the current environment, they're not having to play catch up.
Mm-hmm. And so, taking it like another step back, and you said you don't think the U.S. is currently in a recession. We're headed for a soft landing, or we're easing into a soft landing.
No, I didn't say that. I said I don't think we're in a recession. Whether or not I do think we're going into a recession, whether that's going to be a soft landing or a hard landing, much depends on what's done over the next 3 to 4 months. I mean, if I think that the single biggest thing to protect us against a hard landing is if the Fed sticks to their guns.
Okay, all right. But globally, do you think that we might be heading towards a recession?
Well, I think Europe is already in a recession.
Right.
And I think there's, and obviously, the emerging markets are having a tough time.
Right. And what about the move with the Bank of England that we saw just a week or two back?
Well,
is that a harbinger of things to come ahead?
I hope not, because I think what they did was pretty extreme, and they like a lot of places in the world have a leadership problem today. But I think that there's serious steps that need to be taken, and we need to convince the investing community that the Fed and is going to maintain its discipline.
Mm-hmm. And so what are you telling your portfolio companies right now in industries like healthcare, logistics, as you're waiting for the Fed to stick to their guns? And
I think I'd go back to what I advised them all when COVID began. And what I said to them, and we had a Zoom call of all of the managers, but what I said to them was, assume nothing. That whereas in previous periods of time, when we're able to make assumptions and be relatively confident that those assumptions would lead to fruition in terms of results, I think we're in a period of extraordinary volatility. Obviously, the market is reflecting it. I think you need to be extraordinarily cautious. Mm-hmm. And that's the advice we're giving everybody. That growth is terrific, but not with
the risk. Right. And so with that $3 billion sitting on the sidelines and this intense period of market volatility and this extreme caution that you're taking, are you sourcing deals right now, or are you, how are you looking at opportunities?
I don't think we've been busier than we are right now. If anything, as the economic environment has deteriorated, the number of deals and the number of opportunities and the number of return phone calls we're getting is much, much greater than it was 2 years ago.
Yeah, I mean, as you're known as the grave dancer, right?
Yeah.
For this is almost a perfect opportunity for you.
Yeah, I think it's still too early. In other words, I think that there's still a great lack of reality. Mm-hmm. And a lot of people are expecting, even though they talk one way, they're hoping or expecting a different kind of result. Mm-hmm. I personally think that this is a period where liquidity equals value, that steps taken now to protect your base and create and increase your optionality will pay off in big benefits as we move forward. And I think those that become, immune to the risks suffer the consequences.
Well, you heard it from the grave dancer himself, billion-dollar investment advice for this market. Thank you so much, Sam.
My pleasure. Thank you.
Okay, thank you so much for that. So we're going to give you a break until about 10 after 11, so almost 30 minutes, and we'll see you back here for conversation on healthcare. Thank you.
Ensuring a bright, bold future means investing in tomorrow, today. And Apollo is at the forefront. Our capital is helping to solve some of the world's most complex problems by securing retirement for millions of families, building and financing stronger businesses, and driving a more sustainable future for our communities. Bridging our economic present to our future. Empowering people to retire better, from teachers to firefighters and other essential workers, Apollo is creating retirement solutions for millions of families. We're investing across sectors and geographies to create jobs and support local communities, and partnering with businesses large and small to fund their growth and enable transformation. As we look to new generations, we are committed to making progress and to developing a more sustainable future as a leading capital provider accelerating the energy transition, from development to production, all the way through to consumption. Building a better future also means expanding opportunity across our ecosystem. It means deepening our relationships, broadening our network, and developing new connections every step of the way to better serve our investors and our communities. Through it all, consistently challenging convention, sparking new ideas, and fueling innovation. At Apollo, we are investing in tomorrow, today.
Surfin with ways of digital financial technologies. With the rapid development of digitalization and globalization of financial markets, Surfin has always been driven by digital technologies to invest globally. Surfin Group specializes on two major areas: digital finance and technology empowerment. Since 2017, Surfin Group has invested across 3 continents, which are Asia, Latin America, and Africa, with 20 million users in 8 countries and a total transaction volume of over $2 billion. Surfin invests digitally. Surfin Group focuses on digital investing to empower financial services and asset management globally. Surfin Group processes and develops tens of terabytes of data, hundreds of big data models, millions of feature vectors, millions of effective product models, and asset allocation portfolios. Surfin has global risk management experience. Surfin Group delivers risk management expertise in global asset allocation and investment. The investment and technology can be efficiently married by individually matching of dynamic asset allocation portfolio based on big data and personalized efficient frontiers, integrated with multi-asset classes, multi-trading frequencies, and multi-strategies through risk parity allocation, personalized and diversified portfolios, can be constructed to provide scalable asset allocations and across various market cycles. Surfin Group also develops a fully functional and convenient digital integrated wealth management platform across borders and different markets, which can provide middle-class customers with digital smart financial services, including news and information, user forums, investor education, investment advisory, and financial planning services to enhance global investment experiences. Surfin Group develops 4 proprietary core technology systems that enables real-time online accessing, multi-ethnic group matching, and global multi-country servicing, intelligent risk appetite system, EKYC system, big data behavior analytics system, AI smart voice system. Surfin Group looks forward to seeking mutual benefit and win-win cooperation with various partners to develop an ecosystem to invest in emerging markets. Surfin Group has always been persevered, persistent, and passionate. Surfin shall stay focused and strive to serve more global investors with digital technologies and making life better with smart, open finance.
130 XPO driver training schools. And we're constantly enhancing our technology, creating new network efficiencies to ensure a world-class LTL shipping experience from pickup to delivery. With industry know-how, local knowledge, and the hunger to keep improving results, when you ship with XPO, you'll find that our people are committed to your success. XPO, your freight first.
Over 250 million young people are not in education, employment, or training. But how you start in life shouldn't determine what you do in the future. In the last 3 years, Future Makers by Standard Chartered has supported more than 650,000 talented young people from low-income communities, transforming lives by empowering them to learn, earn, and grow. Because where others see problems, we see potential. We're Standard Chartered, and we're here for good.
What if you could invest in private equity, real estate, private credit, even art, with clarity, confidence, and help when you need it? Meet Yield Street, the leading platform for private market investing. We believe that private market alternatives like real estate, private credit, and art should be a fundamental part of your portfolio. In fact, investment professionals recommend allocating at least 20% of your portfolio to alternatives. So how can alts create a more efficient portfolio? Versus traditional investments, alts reduce risk while maintaining your expected returns, or maintain your risk level while potentially improving your expected returns. We talked to actor and former White House staffer Kal Penn to help explain private markets.
If you're watching this video, it means you've been wondering, what are alternative investments? And why are all your savvy investor friends talking about them? Or maybe that's gonna be you right after this video. So, alternative investments are basically anything beyond the stock and bond markets. You're probably most familiar with real estate. I know I love places. A beautiful resort. Or maybe just an office far away from your perfectly behaved children. There's also private equity, venture capital, and a few more that aren't as mainstream, like art and crypto. Basically, lots of cool things to discover. When you put alts in your portfolio, you're helping to ensure that you have investments that don't always follow the ups and downs of the stock market. Yup, here we go again. That, my friends, is called diversification. In addition, people like alternatives because they can generally outperform the stock market. So, how can you get started? Before Yield Street, you probably would have had to pony up $1 million and tie it up in a single investment. Yikes. But now, the potential of private markets is at your fingertips.
Thanks, Cal. With $3 billion invested on the platform and almost $2 billion in principal and returns paid to investors, and 9.6 realized net annualized returns, isn't it time to diversify away from the stock market? Invest in curated private market alternatives from top managers, all on one easy-to-use platform. Evolve your wealth. Yield Street, private market investing.
MFA exists to serve and represent the private fund industry, and we do this through advocacy and convening our members to address key business and operational issues.
And so the MFA is a phenomenal partner of resources and peer groups and forums that comes together.
And this ability to bring people together is just so important because it just makes me better, it makes my team better.
What the MFA does is the MFA sits firmly in the middle and is ensuring that as they take the inputs from the regulators, take the inputs from the policymakers, and then take the inputs from the manager, that feedback loop that they're bringing is going both ways.
If we have a growing and active membership, that provides MFA in the industry with more resources, more credibility to better advocate for those policy outcomes that support the industry's growth.
So when you join it, you're not joining an association, you're joining a group of peers that have common interests and really want to help you succeed.
There's no downside. It is truly all upside when you become a member of the MFA.
Surfin with waves of digital financial technologies. With the rapid development of digitalization and globalization of financial markets, Surfin has always been driven by digital technologies to invest globally. Surfin Group specializes on two major areas: digital finance and technology empowerment. Since 2017, Surfin Group has invested across 3 continents, which are Asia, Latin America, and Africa, with 20 million users in 8 countries and a total transaction volume of over $2 billion. Surfin invests digitally. Surfin Group focuses on digital investing to empower financial services and asset management globally. Surfin Group processes and develops tens of terabytes of data, hundreds of big data models, millions of feature vectors, millions of effective product models, and asset allocation portfolios. Surfin has global risk management experience. Surfin Group delivers risk management expertise in global asset allocation and investment. The investment and technology can be efficiently married by individually matching of dynamic asset allocation portfolio based on big data and personalized efficient frontiers, integrated with multi-asset classes, multi-trading frequencies, and multi-strategies through risk parity allocation. Personalized and diversified portfolios can be constructed to provide scalable asset allocations and across various market cycles. Surfin Group also develops a fully functional and convenient digital integrated wealth management platform across borders and different markets, which can provide middle-class customers with digital smart financial services, including news and information, user forums, investor education, investment advisory, and financial planning services to enhance global investment experiences. Surfin Group develops 4 proprietary core technology systems that enables real-time online accessing, multi-ethnic group matching, and global multi-country servicing. Intelligent Risk Appetite System, EKYC System, Big Data Behavior Analytics System, AI Smart Voice System. Surfin Group looks forward to seeking mutual benefit and win-win cooperation with various partners to develop an ecosystem to invest in emerging markets. Surfin Group has always been persevered, persistent, and passionate. Surfin shall stay focused and strive to serve more global investors with digital technologies and making life better with smart, open finance.
Ensuring a bright, bold future means investing in tomorrow, today. And Apollo is at the forefront. Our capital is helping to solve some of the world's most complex problems by securing retirement for millions of families, building and financing stronger businesses, and driving a more sustainable future for our communities. Bridging our economic present to our future. Empowering people to retire better, from teachers to firefighters and other essential workers, Apollo is creating retirement solutions for millions of families. We're investing across sectors and geographies to create jobs and support local communities, and partnering with businesses large and small to fund their growth and enable transformation. As we look to new generations, we are committed to making progress and to developing a more sustainable future as a leading capital provider accelerating the energy transition, from development to production, all the way through to consumption. Building a better future also means expanding opportunity across our ecosystem. It means deepening our relationships, broadening our network, and developing new connections every step of the way to better serve our investors and our communities. Through it all, consistently challenging convention, sparking new ideas, and fueling innovation. At Apollo, we are investing in tomorrow, today.
Surfin with waves of digital financial technologies. With the rapid development of digitalization and globalization of financial markets, Surfin has always been driven by digital technologies to invest globally. Surfin Group specializes on two major areas: digital finance and technology empowerment. Since 2017, Surfin Group has invested across 3 continents, which are Asia, Latin America, and Africa, with 20 million users in 8 countries and a total transaction volume of over $2 billion. Surfin invests digitally. Surfin Group focuses on digital investing to empower financial services and asset management globally. Surfin Group processes and develops tens of terabytes of data, hundreds of big data models, millions of feature vectors, millions of effective product models, and asset allocation portfolios. Surfin has global risk management experience. Surfin Group delivers risk management expertise in global asset allocation and investment. The investment and technology can be efficiently married by individually matching of dynamic asset allocation portfolio based on big data and personalized efficient frontiers, integrated with multi-asset classes, multi-trading frequencies, and multi-strategies through risk parity allocation. Personalized and diversified portfolios can be constructed to provide scalable asset allocations and across various market cycles. Surfin Group also develops a fully functional and convenient digital integrated wealth management platform across borders and different markets, which can provide middle-class customers with digital smart financial services, including
Ladies and gentlemen, we'll be starting in just a few minutes. If you can make your way back to the tables and seats, we'll be starting promptly in just a few minutes so we can stay on time. Thank you.
Surfin Group develops 4 proprietary core technology systems that enables real-time online accessing, multi-ethnic group matching, and global multi-country servicing. Intelligent risk appetite system, EKYC system, Big Data Behavior Analytics System, AI Smart Voice System. Surfin Group looks forward to seeking mutual benefit and win-win cooperation with various partners to develop an ecosystem to invest in emerging markets. Surfin Group has always been persevered, persistent, and passionate. Surfin shall stay focused and strive to serve more global investors with digital technologies and making life better with smart, open finance.
Companies of all sizes rely on us for world-class, less-than-truckload freight transportation. We handle our customers' freight as if it were our own, moving it across North America on a coast-to-coast network that covers 99% of all US zip codes. When freight is put in our hands, it gets where it needs to go, safely and on time. Our customers are growing, and we are too, expanding our footprint and fleet, and certifying more truck drivers at over 130 XPO driver training schools. And we're constantly enhancing our technology, creating new network efficiencies to ensure a world-class LTL shipping experience from pickup to delivery. With industry know-how, local knowledge, and the hunger to keep improving results, when you ship with XPO, you'll find that our people are committed to your success. XPO, your freight first.
Over 250 million young people are not in education, employment, or training. But how you start in life shouldn't determine what you do in the future. In the last 3 years, Future Makers by Standard Chartered has supported more than 650,000 talented young people from low-income communities, transforming lives by empowering them to learn, earn, and grow. Because where others see problems, we see potential. We're Standard Chartered, and we're here for good.
What if you could invest in private equity, real estate, private credit, even art, with clarity, confidence, and help when you need it? Meet Yield Street, the leading platform for private market investing. We believe that private market alternatives like real estate, private credit, and art should be a fundamental part of your portfolio. In fact, investment professionals recommend allocating at least 20% of your portfolio to alternatives. So how can alts create a more efficient portfolio? Versus traditional investments, alts reduce risk while maintaining your expected returns, or maintain your risk.
Okay, everyone, welcome back. We're going to get settled and welcome our next panel. If everyone could sort of wrap up their conversations, I know it's so nice to be able to socialize, but we're going to go back to the program. Okay. So I'm welcoming now for a conversation about transformational healthcare investments. Shh. Thank you. We're gonna start the panel. I'm gonna let Gregory Zuckerman, who is special writer for the Wall Street Journal, do the intro of the other speakers, and please join me in welcoming them.
Good morning, everybody. Hope everybody's having a good time. My name is Greg Zuckerman. I'm at the Wall Street Journal. It's an exciting panel we've got here about healthcare. Healthcare is a fascinating world where it's impacted by macro forces that we've all discussed the last couple days here, and yet there's innovation going on behind the scenes that really is not affected, and it's kind of long-term, it's revolutionary, it's changing all our lives, it's saving lives. So we've got a really unique opportunity here because we've got a provider in the middle, Jeff, and we've got two different types of investors, early stage, a little bit later stage as well. So they've got really interesting perspectives. And what I thought I'd just do is ask, starting with Annie, each of the panelists to give a quick introduction of themselves. Better they that do it than I do it.
Okay, Annie Lamont, you'll be the, is this on? Can you hear me? Okay. You'll be the judges of whether it's an interesting panel, I guess. Founder of Oak HCFT. I've been a venture capitalist most of my career. We were founded in 2014. Have raised $5.3 billion in 5 funds, and it's Oak HCFT for healthcare and fintech. We do everything from early to late, $1 million checks all the way to $100 million checks, and really just all about investing in the tailwinds in healthcare and fintech.
Thank you. Jeff?
Great, it's a pleasure to be here. I'm Jeff Flax, the CEO of Hartford Healthcare. Our healthcare system is largely based here in Connecticut. We're the second largest employer. We have 35,000 employees, $5.8 billion in revenue, and 430 locations.
Good morning. Colin Greenspan. I'm the founder of a fund called Naria. We are an early stage venture fund looking to put sort of $5 to $10 million to work per investment, really across all industries. We're true generalists. We tend to take a sort of very macro-driven view to kind of what we think the world looks like at any point in time, 5 to 7 years out, and then invest accordingly where we think there's a real edge in either sort of science or technology. And so we're doing a lot in healthcare, and that ranges from therapeutics to diagnostics, but also a look on the IT side. But we're also exploring opportunities in alternative energy and space technology, and so it's really across the board. And Nari is a new fund. We're at the tail end of doing new deals out of Fund 1, and we'll have a second fund up and running the next few weeks, and it's good to be here.
Thank you. So I thought we'd first provide a little bit of backdrop. We talked a little bit over the weekend, and there was a consensus that the healthcare system is broken, that there are real serious difficulties that we're going to have to address, and that's what investors do. They try to make money, and they try to make improvements and such. So I thought I'd start with Annie, that we can discuss it. What are the problems, and how are investors like yourselves attacking them, and how do you make money from those decisions?
Mm-hmm. Well, we have a mission, and the mission in healthcare is very simple. Hey, Luke. Lowering costs and improving quality in healthcare. And we have a market, as you know well, that is somewhat dysfunctional but keeps growing. There's just inexorable growth. And so the fundamental problem is fee for service. I mean, you all know it. It's essentially people are incented to do things, and there's no incentive not to do things and to manage your care long term. And we have a fundamental view, and it's 20% of the economy now. It's so entrenched. It's literally the largest employer in every state in America. And so it's very hard to change things because you just have so many forces that are fighting change. Our view is that you really need to move, and you've heard this expression, value-based care. And so our view is you have to move the system so that doctors, starting with primary care docs, hopefully independent primary care docs, and Jeff and I can debate what he's doing in terms of owning primary care and how we think about it. But independent primary care docs really being responsible for the entire continuum of your care and paying the risk dollars for that. So that, our view is that is the only really fundamental way to change this paradigm of fee-for-service and people wandering around the healthcare system and being charged, and somebody being charged, not necessarily a patient, although the patient is taking part of it. The only other thing I'll mention is 25% of healthcare cost is now pharma. That is double what it was 10 years ago. So that is just that's something that we'll talk about here, I think, a little bit, because we have to be addressing that in different ways, and clearly some of that is just, we have some amazing life-changing drugs that have come about that are incredibly expensive. But we also have a system that is a little bit broken in terms of distribution.
And Jeff, you both help run a system, but make investments. Tell us kind of where the innovation is coming from. Where are you putting your money right now?
Yeah, I would start I completely agree with Andy's comments. The status quo isn't acceptable in healthcare today. If access is a tremendous problem. It takes 10 months for people to get an annual physical. People with cancer diagnoses often have to wait 3 to 4 months to get into treatment. When we look at affordability, the cost curve and the price of healthcare must be bent. It's not sustainable. When we think about quality and excellence, it's inconsistent. And I think the most important issue is look at health equity. Right? If we've learned anything through COVID, the inequities in healthcare are completely unacceptable. Right? In fact, we operate a hospital in Bridgeport that's basically on the line with the town of Fairfield. The life expectancy is about 20 years difference if somebody's born on the Fairfield side of the line,
wow,
or if they're born on the
the
Bridgeport side. It's totally unacceptable. So we have to change, and to change, we have to dramatically disrupt ourselves. Our health system today. When I started at Hartford Healthcare 18 years ago, 70% of our revenue was generated by the hospitals. Today, the hospitals are generating about 45% of the revenue, and that's been purposeful disruption. So we've invested tremendously in home care. We're the largest home care provider in the state of Connecticut. The future of healthcare is going to be in the home. Home monitoring, hospital at home, and we're going to see physicians now who are going to be treating people in the home. A much less expensive place to do it, where you can do it with much greater internal controls. We're going to see behavioral health being done inside primary care offices. We're doing it now in urgent care centers, and we're providing behavioral health virtually in very significant ways. So to me, we've invested heavily in virtual care, behavioral health, we're investing heavily in home care, and we're investing significantly in what Annie described around changing the way we're paid. So first, 4 years ago, we got an insurance license. We partnered, 50-50 partnership with Point72 out of Boston, and we created our own Medicare Advantage plan. And it's been a slow growth learning process for us. But most recently, we partnered about 6 months ago with Optum, and we have a 50-50 partnership where we're creating our own risk-bearing entity that will be payer agnostic, that allows us to contract with all payers, initially in Medicare Advantage, but moving towards commercial over time. But I just want to underscore, my final point would be what Annie said. We have to get paid for outcomes, and we have to get paid for the total cost of care. And providers like us have to move away from getting paid for the more you do, the more you earn, or even the more mistakes you make sometimes, the more you earn, or the less efficient you are, the more you can get paid. So the movement to value-based care and to being paid differently is really the most fundamental thing we have to do. But then systems like us have to become ecosystems, and we don't need to own everything. We just have to ensure that we can coordinate the care and manage the care, because we have to move away from transactional care to highly integrated care coordination.
Colin, you want to tackle the questions?
Yeah, sure. So I agree with most of what you both said. There's this interesting question. We're talking on this panel talking about sort of transformational investments in healthcare, and as an early stage investor, I sort of need to sort of separate my role as put my investment hat from sort of my citizen hat and my father hat on sort of all my frustrations with how expensive it is to pay for bills when my son broke his wrist, or how long it takes to go see a doctor, and that's very frustrating. But I see this industry as one in which, very different than a lot of industries I invest in, one in which there's certain things that startups can really do to move the needle, and there's other activities where sort of the government and the bigger institutions like yourself really need to sort of do it from the top down. And there's some symbiosis there, but where we're trying to play, at least on the IT side, is more sort of around democratization of data and getting folks more information so they can make better decisions. We have a company doing that in Medicare Advantage, for example. And then where we spend a lot of time is actually investing in more of these higher risk kind of binary outcome companies that are more on the therapeutic side, that are really sort of pushing the curve on the innovation side for creating new drugs. And because I agree on the value-based care side, it's really important that we need to move there, and we're looking at all sorts of different business models that are pushing that on the cardiovascular side or more generally, but it's always hard to sort of get the flywheel going at a startup, and I would think with the dollars associated to do that the right way and the covered lives, it's almost easier with the right initiatives to do it from the top down.
Thank you. I thought I'd follow up with Jeff for a second. You said something really interesting, and frankly, we didn't prepare this ahead of time, so you may not have an answer, so I apologize to Jeff and the audience. But you said the future is the home, which I thought kind of fascinating, because we all we write stories about hospitals and the spending going higher, and I didn't realize as a percentage it's actually going lower. Give us a couple names or one name of a company that either you've partnered with or just have noticed that's doing really interesting work in the home, healthcare in the home, doing innovation, revolutionary maybe kind of work. Is there anybody that comes to mind?
Yeah, I'll tell you, it's interesting. For a number of years, I took a lot of pride in saying that we were within 15 miles of every resident in the state of Connecticut, and we set the ambition to be within 10 miles of every resident in the state of Connecticut, which we achieved recently. I no longer speak that way, because what we want to be is in everybody's home. Now, it doesn't mean we're providing home care services in everyone's home, because not everyone needs that on any given day, but we're in the palm of your hand. We're there because we can provide virtual care, real time, for whatever your need may be. And we just did a very interesting partnership with One Med. And One Medical was just in the process of completing the acquisition process acquired by Amazon Health. And we're building 5 One Med offices here, Darien, Stamford, Westport, Fairfield, and New Canaan. And those offices are set up where they're capped at 1,000 patients basically per primary care doctor, but we guarantee 24-hour access to virtual care. So anyone who has a need, wherever you may be, can get access to a provider through virtual care. And if you need to be in the office, because of the cap that's in place, you have more immediate access. These are the types of innovations to me that are exciting, and specific to home care. You know, there's Optum has made some very interesting investments where they're actually looking to put physicians who are going to be seeing house calls, where they're going to be
like in
providing
the old
house
days.
calls,
That's great.
just like the old days.
Yeah.
And we are putting now hospital beds for hospice
Really?
in the home, as opposed to having people come to the hospice.
Yeah.
You can do it better and actually preserve people's dignity and give them much better service, in the family better service, if you do it in the home. So
that's beautiful.
There's tremendous opportunity in the home.
What's the company? I'm sorry, Optimum, you said?
Optum was part of a partner with United Healthcare, has
United
invested
Healthcare.
heavily in that space.
That's fascinating. I mean, those of us who have experienced institutions, I'm sure yours is the exception, but sometimes it can be frustrating and disappointing experience. So it just, by definition, it's hard as an institution. But yeah, if you do it in the home, that could be revolutionary.
The other piece I just would say is home monitoring. You know, if you think about chronic disease and the issues that people have, the ability to manage diabetes, to manage heart failure, kidney disease, end-stage kidney disease, this is where massive amounts of the money in the country is being spent. Massive amounts of money. And the amount of hospitalizations and readmissions that could be avoided, the amount of pharmaceuticals that can be conserved if done properly. But you need really sophisticated, advanced home monitoring, and you have to figure out a way to get paid for it. And the same thing with virtual care. You know, it's been resisted. If you don't figure out a way to get paid for it, right, there's the disincentive to do it. But those are the innovations that we need.
And I assume the pandemic has accelerated that. We were all getting a little more comfortable talking to our doctors on the phone kind of thing. At first we were uncomfortable, but it's not so bad after all. Yeah, I don't speak in person. Annie, I'm going to ask you, when you think about healthcare and issues, you think about rising costs, you think about staffing issues.
Yeah.
What innovations are you seeing out there in those regards? How are people tackling those issues, and how can you make money off it?
Okay. Talk about that. I think we all know about staffing costs increasing, and particularly on the provider side. I mean, Jeff is dealing with that every day in terms of bringing in clinicians. I'll say, one thing before I even go into that is people always want like really exciting AI. Let's talk about like innovative, things that are going on. There's nothing innovative going on in healthcare. The reality is it's just improving the system, making it better with technology that already exists. And we're like 20 years behind, as most of you know, in terms of using things that already exist out there. So, One Medical, we were actually the founding investor in One Medical, and that was just applying, open table, like, okay, you can go online, you can talk to your doctor, through email, text, we'll prescribe on a weekend for you. I mean, this is like really simple stuff and giving people a good consumer experience. And that was 15 years ago when that was started. And right now, I think in terms of lowering costs, the great news for me is that hospital systems, Jeff may debate this, but we have actually avoided selling software and solutions to hospitals because it's complex, everybody wants something different, they were all focused on implementing EHRs. They really just wanted things that aggregated revenues. They weren't as focused on efficiency. And the exciting part to me actually about the staffing issue and where we are today is that hospital systems and healthcare systems are very focused on it now. And we have, a couple of incredibly interesting companies that, Jeff may be talking to a few of those. And I know, where you're simply digitizing things that are being done by, 500 laborers looking at a spreadsheet, so it's the simple administrative things that we're starting with. But we're also looking at things like call center. Like nobody actually talks about call center. How much money do you spend on call center at Hartford Healthcare?
Yeah, tremendous amount. We employ 500 people.
Yeah,
wow.
Right. So over 100
Are they in
million.
America?
Yes.
Yeah.
So I know, HCA spends like $200 million on call center.
Wow.
It's incredible. And, we have a software solution that basically, and 2% of people, when you go to a website of your healthcare system, you're talking about 1 to 2% of people actually convert to making an appointment. It's sort of a useless, they've actually, what they've done is integrated website, calls, voicemail, email, all in one place. and are reducing the need for a person to actually talk to you by 60%. So they're literally taking 200 million of spend, down to about 40 million of spend and providing a much better solution. I think HCA found that 30% of the first calls that they were getting to make an appointment were not being answered.
Not being answered at all.
Not answered at all. I mean, this is an HCA. I was on the board for a while, so I know them. The reality is, it's probably the most well-run hospital system, other than Hartford Healthcare in America. And so, for them to find that, they didn't know that. They didn't know that until they did the diagnostic with this company, Syllable, and are now implementing this, across the system. So, there are things like that that are just like simple ways to improve processes.
I thought I'd ask Colin, you talk to entrepreneurs in many industries, but including healthcare. What are you hearing in terms of their mindset right now? We're going into likely a recession if we're not in one right now. Regulatory change is something of interest and of concern for a lot of the entrepreneurs in this space. What's the sense you're getting from the entrepreneurs?
Yeah, I think it sort of depends on the stage of the company, but I think we can debate whether where we are in a cycle right now, and there were some good discussions on that earlier today. But I think for the right entrepreneurs that are building truly transformational businesses that are going after sort of need to solve, not nice to solve problems, they will be just fine. There's plenty of capital out there at sort of early stage and growth stage. And I've seen some valuation compression, but it's still just a lot of funds sort of fighting for the best deals. And so if it's an interesting opportunity, the metrics are intriguing. They're going to be fine from a fundraising standpoint. And I think from engaging with strategics, there seems to be everyone seems to be open for business and really looking to collaborate. And so I actually think it's a really good time for entrepreneurs, assuming to the extent they have metrics that are actually relevant and sort of those unit economics are tight, and there's a path to sort of growth that is somewhat they're controlling their own destiny versus sort of this deep trough that was okay a couple years ago and coming out steeper. And then for the companies that are pre-revenue and sort of pre-traditional financial metrics, I continue to think there's a lot of capital there. One of our biotechs, despite what's going on in the public markets this year, had one of the biggest private rounds a quarter ago, and so I tend to be very optimistic. And then just on the innovation side, just seeing a lot of these sort of less pioneering advances in science, but sort of this kind of second wave where the biology has been proven out, and now there's different business models to go after, things like gene therapy or these new sort of upstream and downstream CDMO models to help on the services side for especially in advanced therapies. And so I'm actually pretty optimistic, especially on the therapeutic side.
So you as an investor, you're not getting much better terms than a few months ago. You're not getting the same people reducing their demands. You're not getting bargains that maybe one would have thought given the macro challenges out there.
Yeah, I would say that's probably true. We only do a couple deals a year, and so I haven't done a new deal since June. So I don't have the best data on it, but as far as our company, we have 3 companies raising now in different sectors, one in healthcare, and they should have pretty good up rounds.
Okay. I'll shift back to Jeff for a second. You do strategic deals, work with companies. Make the argument why that is a better move for these companies, working with a health provider like yourselves.
Yeah, I'm a tremendous believer in partnership and taking advantage of the innovation from firms like the 2 people I'm here with today. The amount of innovation, the amount of money in private equity that's being invested in healthcare today is really beyond anything certainly I've ever experienced in my career. And I'll give you one really good example. We've had great success with a TPG-backed investment, Go Health. And Go Health, which began out in the West Coast, we did an agreement to develop a Go Health urgent care center network across Connecticut. We have about 25 with about 5 under construction today. And we did urgent care for years, and we muddled along. Go Health, with the right level of innovation, technology, money behind it, bringing together the right talent, has totally revolutionized the way urgent care is provided. And our net promoter score is now around 90 for urgent care. We went from doing something like 60 or 70,000 visits to this year we're going to go over 600,000 visits. And it has become an integral part of our healthcare system. But what I would point out, and I think this is really critical, when organizations like ours partner, we're not partnering kind of in an episodic or transactional manner. It has to be through integration. So when we partnered with Go Health, it's our electronic health record, we credential all the providers, and we integrate all of our imaging and laboratory and ancillary services into the Go Health model. So from the consumer experience, you're not just simply getting your need met, it's part of your longitudinal healthcare. And to me, that's the value of partnership. Go Health could build, independent of us, a network of urgent care centers in Connecticut, but they simply would be solving one problem. But when they built it in partnership with us, from the consumer perspective, it becomes a permanent part of your health record. Your provider knows electronically before you even leave why you were there, and all of your care and records and history is fully integrated, and all of your lab findings and so forth are sent to your healthcare team. So to me, partnership is critical, and places like us aren't great at inventing things, but we are a great sandbox. So we do support, we have a healthcare accelerator. Our mayor, Luke Bronin, is here from the city of Hartford. Luke's been an amazing partner of ours, but we work with the city of Hartford. We have a healthcare accelerator that we've co-funded. We've got 15 startups that we've brought in that we just give them the keys to the car. They get to come in our organization, and they get to develop their companies from the confines of our organization. We've done the same thing with Israel, with the Economic Development Forum in Israel. We're one of 4 US-based health systems that bring companies that need to domicile, that were invented in Israel but need to domicile here, early stage, and we do it in Connecticut.
Wow.
So I'm a huge believer in Connecticut, and I think it's a wonderful place to originate these companies. And we have a culture in Connecticut that supports it.
Is that unique? I have no idea. I wasn't aware this was happening. Is that unique to your system, or all over the country, providers are having cutting strategic deals and alliances and joint ventures?
There's probably 50 to 100 health systems like us in the country who are working along those same lines. Andy even knows better than I do. It's probably a continuum of how innovative they are.
Andy, do you want to give a couple thoughts on that?
Well, I think it's interesting because we'll use Yale New Haven as an example. They're about to buy 3 more hospitals. We were talking about it earlier, and that's a model of we're just going to keep doubling down on hospital. We know hospital, we're going to do hospitals. So you see that a lot over the country. But I think if you are thinking about the future, you've got to be thinking about an integrated, vertically integrated model, as Jeff is doing, because we are going to have. I mean, what's happened really, you've seen it in the last 3 years with COVID. Now you actually have fewer people in the hospital, and they're more intensely sick. So we actually don't need more beds. Even with demographics, it's like you don't need more beds because we are handling many people that used to be in the hospital system, and we're trying to keep people out of the hospital system throughout the continuum in healthcare. And if you're going to think about value-based care, then you have to think about other ambulatory, virtual, in the home. You just have to think about these other venues because you've got to think about right time, right place, right care. And so I think Jeff is definitely thinking about it in the right way.
When you do these deals, I'm just curious, do you take an equity stake? How big an equity stake? Is it always an equity stake? How does that work?
So we typically are at least 50-50 partners. Sometimes we may even have a greater percentage. We did one thing that's rather interesting. We work with MIT, and we developed a company that's just in its early stage. It was recently formed called H2O, which is a predictive analytics company that's focused on operating room efficiency. But the dean of the analytics program at MIT, Professor Dimitris Bertsimas, worked in Hartford Healthcare for several years with his PhD students, built this model. So we have a smaller percentage, a relatively small percentage of that company. But we earned that percentage by being a development partner with Professor Bertsimas and the company he formed.
As opposed to investing. You didn't have to put up any cash, you're saying?
Correct.
That's like a win-win.
Or limited cash.
Yeah. If it works, great. If not that much effort on your part or risk on that part. Have there been any huge home runs in that world where a provider has gone in a strategic deal with someone, a startup and such, and any that you're aware of? I was just curious.
So we had one company, which goes back almost 10 years, which is really exciting because it was formed in our organization, and the person who was kind of the primary developer ended up forming a company called Premise, based on the product that was developed within Hartford Healthcare. Ultimately, he sold it to Eclipsis for a significant sale price, which then resold and became the foundation of really of Allscripts in many ways. So, it does happen, and it happens all over the country.
It's interesting. Thought I'd ask Colin about just sort of, as the healthcare system evolves, there are ways, there are trends that are emerging that maybe aren't as investable as others. Maybe there's some that, and yet they're important to all of us in this room. What should we be aware of? What kind of trends are out there that you guys are seeing?
I mean, I think we talked about at the beginning of this panel, just the push to value-based care is a huge one. And again, for us, it's this question of as an early stage investor, what data can you get to get comfortable? Not that this is something that should be done, but that this team has an edge to go do that. Is it a partnership with an interesting health system? Is it some technological edge? I'm also like, there's a lot of low-hanging fruit here, but these companies are really asking for capital without a lot of data, and so it becomes this almost a founder bet and a macro bet, which for us we tend to want to sort of underwrite to sort of tech and scientific risk. So we do a little bit less of it. I also think I talked about the democratization of data. I think especially in the Medicare space, just with an aging population, there's a lot of confusion around the open enrollment process and what sort of plans are best for which people, and when they can switch, and how that all works, and what those economics are like. And so we have a company that is actually started by some ex-Palantir folks that, they were doing some healthcare within Palantir, but are trying to take a very data-driven approach to go after on the brokerage side, go after some of the big public companies that we would argue have struggled to do that. And so those are some themes, maybe bigger themes that maybe this isn't exactly what your question is, but one of the things we're pretty passionate about too is this idea of doing more domestically, sort of from the bottom up, and that's everything from producing KSMs, key starting materials, and active pharmaceutical ingredients here in our country. For a bunch of reasons. One, just from a timing standpoint, if there's another pandemic, it's very, very hard with supply chain disruption. It improves the unit economics as well, so that should sort of trickle down to everyone. And then also just from a national security standpoint too, if you think about sort of where those ingredients are manufactured, if there is ever, for antibiotics and whatnot, I think it is important. And so we're looking at some of those themes as well.
Annie, do you want to give your own thoughts on the kinds of companies you're talking to, the entrepreneurs, and what kind of trends, if you're seeing any of those similar trends?
So one thing, social determinants of health, I don't know if you've heard that expression, but it really is talking about, nutrition, housing, all those things that affect the well-being of an individual, mental health, and incorporating those. And we do have a few companies, one in particular that is literally state by state going and incorporating, creating a network so that one can track actually, there are benefits that exist federally and state-wise, but they're not coordinated at all. I mean, just think about SNAP program is, the food stamp program, and then you've got HUD over here, housing, and then you've got HHS, so totally separate. And mental health, dealt as a separate issue. And those are really, when you look at Medicaid, when you look at actually, issues of our U.S. Health status, that's what drives most of the health problems in America. And yet we don't coordinate those. We're not thinking about it that way. I mean, in my mind, the vision of the next, administration would be like, let's put all these buckets of money together, because it's now happening in some of the states. They're trying to coordinate this. And there are companies that I said, this company has now grown to 100 million, and it's working with 16 states across the country. This became even more evident during COVID. and just aggregating that information, tracking individuals, which has all sorts of HIPAA, issues. But if they haven't, taken advantage of a Bennett, actually getting them there, thinking about housing. You actually have United Health, you have major insurers that are now doing experiments, and Phoenix is one place where they've literally bought housing and are putting individuals in housing that are chronic users of the emergency room, and are finding, great success in actually lowering total overall costs. So, thinking
So in
about
other words,
that.
an emergency room that would be in the hospital itself.
No, I mean, what I'm saying is these people, literally they're people that show up in the ER every week, every other week.
Yeah.
I mean, and most of it is related to homelessness, mental illness. So, if you can think about those people in a different way, and a lot of it is homeless, starts with homelessness, and then, you figure out they're getting, food benefits already, but, supporting the whole person. So, we just got to think about this thing. I mean, childhood diabetes went through the roof the last 5 years. You're talking about like 50%. I mean, it is insane. So, these are the things that we're not dealing with as a country, and you cannot deal with it at a micro level. You got to deal with it at a macro level. So, in terms of trends, I mean, we all know mental health. That's obviously, a serious issue, and one thing we've invested quite a bit in. And the good news is there's a lot more money for mental health that came out of the COVID, and people are talking about it, and they really weren't talking about it 3 years ago pre-COVID. So that's a bad thing and a good thing.
Yeah. And money is flowing into mental health right now. You're
yeah.
seeing that everywhere,
Yeah.
right?
Yeah.
Too much money? You think it's just...
Oh, no. God, no.
It's all, it's all necessary.
No, I mean, obviously the issue is figuring out the clinicians, and I think we're now... There are a lot of social workers that have been on the sideline, and with virtualization, we're now like bringing them back into the fore, and people can work 4 hours a week or 20 hours a week, or raise their kids. They don't have to go into facilities. So that's been actually huge in expanding the workforce in areas like mental health. Sorry.
Interesting. I want to leave about 5 minutes for Q&A if there are any, but I just had a couple more questions. Speaking of mental health, and again, we haven't talked about this before the session, so I'm going to apologize if you have nothing to say about this. But one thing I'm really fascinated by is the revolution in psychedelics, and how many kind of mainstream people I know, hedge fund managers, private equity guys, who over a beer will say, you know what, Greg, I've started to microdose. And I'm like, wow, you would never expect this whatsoever. And it seems like it's sort of like marijuana was years ago, where it went from, crossing that line where it's becoming more acceptable. And it's being able to address things like anxiety and PTSD and marriage counseling and such. So the little that I'm detecting, I'm not recommending you try it at home, but if you do, let me know. I'd love to write about it. I'd love to hear what if you guys have any perspective on, is this the next marijuana? Is it the revolution? Is it something that we as investors should be thinking about? Or, yeah, maybe down the line, but it's too early for guys like us. Do you want to start with Annie?
No, actually, this is a politically sensitive topic that I will not comment on.
That said, no, okay.
I actually think there is a bill that's being proposed in the next legislature around this topic, and people are looking at it and they're thinking about PTSD.
Yeah.
I mean, these things start, and there's credibility, obviously, if the armed forces is supportive of it and they believe, and there are actually clinical trials of PTSD that are quite successful. So
that's when somebody like you would get involved, when serious investors are waiting for.
Yeah,
it's too early.
We will be waiting a long time, probably.
Okay.
Yeah, I'm not sure we would invest anytime soon, but there have been a few companies that are going after this, and the early science is pretty interesting. As someone who was living in the Bay Area for a long time, there's all sorts of experimenters, and with the Burning Man crowd or whomever, sort of the kind of the tech world that have talked about this, and not just for sort of obvious health reasons, but even just for sort of coming up with new investment theses, and there's a whole pretty small community there. I don't think that's really an investable market at this stage, and I would be pretty nervous about the regulatory environment. So I think it's something we would watch, and we're never sort of kind of pioneers when we invest. It's always looking at that next wave, and so but I think it's pretty interesting.
Jeff, what about you guys? Are people tripping, taking trips?
I would only add the other side of it, which is and I do think an area that's getting a lot of investment also is addiction treatment centers. And there is a lot of focus on addiction treatment centers, and I think it's an emerging area.
Yeah.
And I think we're going to see more private investment in those spaces because people can do it well and make it more accessible and more affordable.
I don't think you can get addicted from what do I know about psychedelics. Right. I've never tried it. But I don't think there's an addiction issue there, but maybe there is. I don't know. But it's not something you guys are looking at this early studies and thinking about treating people with anxiety or talking about that, microdosing, that kind of thing. All right. Let me know if you do. And the other question I had was, you had mentioned, Jeff, specifically about Amazon. What's it called? Amazon Health? Amazon, yeah. And there've always been kind of concerns or interest in Amazon and the behemoth out there and whether they're going to make a big impact on this industry. What kind of impact are you seeing? What kind do you expect? Is there somebody like Amazon, Google, or Apple? People talk about Apple and the phone and et cetera, and that being the future doctor and monitoring you, et cetera. Tell me about those companies specifically, but also just kind of those innovations, maybe coming from big tech.
Yeah, I think it's all the above. Right? Walmart has significantly focused in investing in health. CVS, right, is looking to build these health hubs and become the front door, right, to healthcare in many ways. Walgreens, and something Annie was involved with, has significantly invested in primary care through Village MD. So when you think about all the different companies, and Amazon is clearly, looking to move in this direction, the vast majority of these large public companies who work with different levels of, with consumers, whether it's through e-health or through physical locations, they all have potential to have great impact in different ways. So my point of view is, as a regional healthcare system, and I hope this would be the point of view candidly around the country, we shouldn't resist these organizations. We should look to partner with them and figure out ways to make healthcare more accessible, more affordable, more equitable, and raise the level of quality. And they may very well emerge to have a lot to offer. The example with Walgreens and Village MD, they're proving it right in parts of the country. So,
and it's successful there, yeah. It's an effective program, yeah.
In some instances, not all. Some haven't succeeded. Some have restarted. Some have reorganized numerous times. Google Health has reorganized numerous times.
Yes.
We're talking to Google very actively. I think we have to remain very open-minded because I think it comes back to this basic premise. We have to disrupt the status quo. Healthcare's got to change. We all said that. So to change, so we have to be very open-minded and objective and continue to seek, I often use the analogy where it's like salmon swimming upstream. They don't all get upstream, right? We know that. But you have to just hope that you make good selections, you pick more proven partners, and if you fail quickly, right? And make sure your bet that you're putting on the table is measured. You have to be willing to fail. We're not going to change it if we're not. We can't be that conservative, when you're trying to address a historic situation that, absent being addressed, the impact it has in this country is put the country at great risk.
Colin?
Yeah, I would just add, Amazon's going to get all the headlines, but you're seeing that trend from less tech-forward companies too, and so any sort of national grocer that has pharmacy capabilities is really pushing on this as well. So you're sort of seeing the less tech-savvy folks come after this opportunity.
Annie, do you have any thoughts on the big tech coming into this space?
I'm not particularly worried about it. I mean, we just keep seeing them. Apple is not really making an impact.
Speaking of Apple. There you go.
Yeah, I mean, they look at everything in a tech way, and it's really a services. So, no, I'm not really. I think Amazon's the only one that's really making some bold moves, and I'm excited about that. They know how to serve the consumer in a different way, and they're willing to try and fail. I mean, I'm not very happy about what they've done with our local Whole Foods, but...
All right, that's another panel. We'll get to that another time. All right, we only have a couple minutes left, so I thought I'd ask, there's a Q&A. I see a hand going right back there.
Hi. Thanks so much for the terrific panel. Question for you that picks up on some of these themes of addiction and mental health. A dear friend of mine started a community health center in downtown Westport, our beautiful home state, called Lift Wellness. And as she thinks about growing her business, should she think about that as a healthcare business, they're doing eating disorder recovery and similar, or should you think about that as a real estate business? Where is the capital coming from, and how should she look at scaling?
Anyone want to take a shot at that?
Well, you probably know more about real estate. We actually shy away from real estate plays. So I'd like to think that's all about the care of the individual. So I definitely think of it as a healthcare company. And real estate is secondary. I mean, you have to have a strategy that makes sense for you if it's facility driven. I would certainly encourage a strategy where it's sort of omni-channel.
Jeff, you want to tackle that?
You know, I would only point out, you know, healthcare has become consumer driven. And, you know, so the notion of these types of locations, you know, they're retail locations today. So I think you have to have an element of a retail strategy that's viable. But I would just echo Andy's point. I mean, it's healthcare services they're providing, but location really does matter and does impact, you know, access, which is really crucial.
Okay, I have another question right in front here. I think
instance, one method we could have used when they passed the last tax law under the previous administration was they repatriated money back. Corporations could repatriate money back at a reduced cost from 30%, I don't know if it was 30% down to 20 or whatever. What about taking half of that money, putting it into a fund that the government could not touch, and that fund would grow through investments over years, which would offset the cost from 50-year-olds on up, where you tend to have the majority of costs occurring, to offset that money would come from that fund as a supplement to one's payments. Additionally, another method could be deducting your monthly payment or your insurance payment annually from your income taxes. Now there have to be controls on that, because obviously there's no incentive to avoid the cost for the insurance company keep charging more. So there are ways to do that. But just that concept I'd like you to address, if you can.
Well, I think there certainly could be more creativity around funding mechanisms. I just legislatively, the inertia around that would be very, very difficult. I think there are obviously other smarter ways to do it. In my mind, we're still spending, 80% more than other healthcare systems around the country. Other countries are spending on healthcare. So, to me, it's, yes, we could be funding it differently, but we could be spending a lot less money than we are providing better care. So, and that's our focus.
All right, we are literally in our last seconds here, so I want to thank the panel. I think I could speak for them to say that you guys will be around afterwards if people want to come up and have questions. I know I'm going to be at a table over there that they asked me to go sip my books, but some experts in the field, so people, if they'd love to come up and ask a few questions outside, I think I could speak for them in saying people would be thrilled to meet people. Thank you for everybody's attention, and have a great day. Thank you.
Okay, so we'll give everyone 2 to 5 seconds to shuffle. Then we have our last panel that will be our last panel before lunch, I should say. And this is going to be technology. It's called Technology, the End of Growth at All Costs. And our moderator today is Ed Hammond, who's senior deals reporter at Bloomberg. And we'll let them get up onto the stage, and I'll let Ed welcome the panel. Thank you very much.
Well, thank you everyone for coming. I'm just going to quickly introduce the panel and then we will jump into our chosen topics. So next to me I have Bryant of Time of Bravo. He's a partner there and he deserves special applause because he stepped in very, very much last minute to do this. Next to him I have Ulrike Hoffman-Bischardi, who we're going to just refer to as UHB for my own sake. Going forward on this panel, she's a senior portfolio manager at Tudor Investment Group. And right there on the end, we have Jonathan Durham of General Atlantic, where he is the global head of technology buyouts. And he is going to be just called JD for the remainder of the panel. So let's start with our title, which is Technology, the End of Growth at All Costs. It doesn't really seem like a question at this point. I think it's probably just a statement of fact. With that in mind, obviously, it begs a question about what era are we going into if we have reached the end of the growth at all costs one. Ulrike, I'm going to start with you with this question. What are we at the beginning of now?
Yeah, maybe just to go back to the title, growth at all costs, I wonder whether that period that you're referring to, like 2020, 21, maybe it was more a period of growth at no cost. Because what actually happened was rates were so low that the opportunity cost was virtually zero. So why not invest in hiring, in R&D, and just wait for the next investor to come along and even give you funding at higher valuations? So really, if the alternative is a zero return, if the alternative is a zero return, a lot of risk gets funded. And if we look back even at valuations, clearly we reached valuations that were very high by historical standards, 15 to 20 times annual recurring revenue. The only historical precedent we've had was 99-2000. But there was one big difference, again, that rates were close to zero at that time, whereas they were 6% prior. So when you dissect what actually happens, and we went back and looked at the rise of software valuations during that period, 90% can be explained by the rising rates, by the lower rates. So only 10% were in improved fundamentals. So now, as we look forward with rates closer to 4%, we're just going to have to face a very, very different valuation environment for some time. And if rates even go higher to maybe 5% on the Fed fund side, I would expect that software valuations are going to come down further.
Brian, I'm going to turn that over to you. How, as a buyout fund, do you play that? Is this a waiting game at the moment for them to come lower, or do you try and get in the market at the moment? I asked that question in the knowledge that you did announce a deal yesterday in the software space, but I wonder sort of bigger picture, whether this is a wait and see or whether this is a moment to go in.
Yeah, I think for us, we tend not to be like market, we don't prognosticate about what's happening. Right? Where are we in the cycle? We can't time the markets. So what we really focus on is the quality of the businesses and the franchises, and do we feel like there's an operational opportunity for us to really help these companies get profitable and make money and ultimately have a good exit. So I think you'll see that from us here over the next 6-12 months, really being thoughtful and mindful about picking our spots and what do we think are the most high quality companies that maybe have also kind of traded off here with some of the companies that we think of as not as high quality, and trying to get those deals done. But I'd say capital today just feels like it's a lot scarcer. Obviously the cost of capital is going up, and so it's making getting things done trickier and a little more difficult. But we do feel like it's still an interesting buying opportunity now, and it's hard to say are we totally at the bottom? Is it going to be in 6 months, 12 months? But there's still good opportunities out there to find high quality companies.
JD, from where you sit, we're at this moment obviously where we are pivoting away from growth at all costs, and I wonder, when you're looking at the companies that you can potentially go and acquire in the public markets, what are the management teams thinking in terms of, how they prepare for the next phase? Are they able to prepare for the next phase, or have they become so used to this singular environment where it is just grow, 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 that you're having to almost re-educate them about, well, look, this is the reality that you're in now. If you want to go private, if you want to do a deal with us, this is how it's going to look.
Yeah, it's a great question. I think there's definitely an evolution and education, as you said, happening. And I think, in the last 2 years, founders, public company CEOs, they were so incentivized to chase another 5 or 10% more revenue growth, because every IPO pitch you would sit through, they'd show you a scatter plot of revenue growth on one axis and your TEV to revenue multiple on another. And everyone thought, wow, if I can just get another 5 or 10 points of growth, I can trade at 15 times revenue, as Ulrike was saying, instead of 10. And so it was free to deploy more OpEx and chase that growth. And I think the market is clearly now transitioning towards what I would call profitable growth, where growth is still really important. And at General Atlantic, we're a growth equity firm who's entering what we call growth buyouts. So we still want to invest in companies that have 10, 20, 30% growth, but we want that to be profitable growth. And I think to your question, Ed, helping companies and founders retool themselves to pursue that is really the key. And I think that's where private equity is actually very well positioned to help these companies build that muscle, supplement the skills they need, potentially build out their teams. At General Atlantic, we have a growth acceleration team, and they're, just as an example, they're putting out toolkits to our 200 companies right now on, hey, how should you think about pricing in an inflationary environment? Or if you're thinking about cost optimization, here are some of the best practices for how to pursue that. So I think that's where the market's going and what those executive teams are pulling and needing, hopefully from private equity sponsors like us and others.
Ulrike, do you see the same in when you're looking at the sort of companies where you might invest, this ability, as it were, to move away from hyperscaling, which has been a core competency at so many of these fast-growing tech companies? Are they able to now adapt and perhaps even thrive in this new environment?
Yeah, that's the key. That's the key question right now. We spend a lot of time before we're investing. We have a very long-term horizon with our software investments, and so the growth mindset of the management team is a key variable in our evaluation. And so now we've started to see that CEOs can adapt to this environment. They see the challenges ahead. They're cutting costs. They're still investing in certain areas. But I think it's a litmus test for a lot of this new generation of CEOs to navigate this environment of economic turmoil over the next few quarters.
I guess, again, sort of Ulrike, for you on how you identify what are the right investments in the moment. Like, how important is it to find the management teams with that quality to adapt? Because that's not something that has necessarily been a key differentiator in the last decade or so, where companies have grown for all kinds of different reasons, but by and large, everything has sort of risen together. Now, you actually need to be able to identify, well, this is a management team that's going to be able to make the changes, to institute the cultural differences that is going to help that company survive.
Yeah, we actually do spend a lot of time with companies when they're private. During that phase, you can observe a lot of resilience. You can see what worked, what didn't work, how did they overcome challenges in the past. And for us, that's a key attribute to have that long-term perspective, that management teams are able to pivot and overcome obstacles. So we're very excited to see how our management teams will cope in this environment, and very optimistic on that front.
And Bryant, for you guys at Timer, obviously one of your sort of signature things about the firm is that you stick with existing management. You like to buy companies where you can essentially be fairly light touch in terms of having the management in place, progress the business under the auspices of Toma. Is that something you're going to be able to continue to do, or are you going to have to go in and actually be a bit more heavy-handed to help these companies change their culture and perhaps become less focused on growth at all costs and more focused on profit?
Yeah, no, it's interesting. I mean, you're right. At Thoma Bravo, we are always, like, our strong bias really is to partner with the existing team. And the reason for that is in almost every investment that we make, there's this operational thesis that we have. We're making usually pretty significant changes to the company. And to go do that with a new team that you have to find and bring in and train, and then they've got to bring in their people, you just lose a lot of time. So we've always found that if we can find a management team that's willing to collaborate with us and work with us and really kind of utilize our playbook and our way of doing things, that's just a lot more effective and powerful. We are finding now in this environment, as we talk to CEOs of public companies, that a lot of them aren't necessarily up for the challenge. They don't want to do it. Right. And so, I think it's going to be a really interesting mix, actually, of finding management teams that, love the business that they're in and want to continue on and understand that they have to learn and adapt and figure out how to grow, profitably, versus, the teams that maybe say, hey, this isn't for me. Like I was here in this growth world to hire as many people as we could and go after this market. That's my skill set, and that's the next phase of this journey is not something that I look forward to. And so we have a solution for that as well. But our strong bias is always, like I said, partner with that existing team if we can.
JD, same for you. Is this something you're seeing where you have management teams for whom growth has been a sort of inexorable thing, and they're only used to ascending higher and higher, and now they're having to sort of get on board, and do they all want to do it?
Yeah, I would echo exactly what Bryant said. At General Atlantic, we also want a collaborative, back the person in the seat is usually the best modality. And in the best situations, there's a pull where they're looking for the help to help drive the company in a profitable growth direction. But I would also echo, I think Brian's exactly right, which is there's a personality question too, I think, where you might have a founder who created a really cool business and they took it from nothing to 100 million of recurring revenue. And the skills and requirements to take that business, to double and triple from there may not be something they're interested in doing. And they might be more interested in stepping back and starting another business, and sort of going at it again. So it really just depends on the personalities and the folks in the seat. And I think that's where, in a collaborative way, private equity can step in with some of the skill sets to either supplement the existing team or bring new talent in where it's needed.
And when you're setting those sort of expectations, what does good growth look like in the near-term future?
Good, in the software world, to maybe make it simple, good software businesses with recurring revenues and 90% plus retention rates often will have gross margins in the 70% area. And the way I tend to think about those businesses is at a certain scale, as they get larger, based on benchmarks and experience, they should be able to approach profit margins in the 30% to 40% area. And so the way I think about it is if you see a company today that might be break even or 10% margin, you try to think, okay, how, as this business scales, how does it create the operating leverage to achieve margins eventually in that 30 to 40% range? And how do you do that? Well, you have to look at what are they doing operationally where they're getting operating leverage. Are we spending sales and marketing that's delivering an adequate return? If we look at the R&D investment in the product, is that driving an adequate return? In a lot of cases, what you find is you don't actually reduce spend. I think there's a lot of misperception about taking out costs. It's usually just reallocating costs to higher ROI activities in the company that when everyone was just throwing costs and trying to grow, you build up a lot of inefficiency.
And this is, Rika, I'm going to pick you up on this. This is something we talked about in sort of preparing for this, that in the previous economic cycles, in particular in the sort of previous very pronounced downturns, the companies that have come out best are the ones that have continued to spend fairly highly on sales and marketing. And I wonder, when a lot of these high growth tech companies, their spend is on sort of essentially acquiring users, how do they manage that going through this period? Do they continue to invest heavily in that, or do they invest in different, perhaps more traditional kinds of sales and marketing to come out of this in the best possible shape?
So, I mean, our portfolio companies typically have really good sales efficiency. That's what we are looking at. So we measure it in CAC payback costs, or time. How long does it take for a company to recuperate their sales and marketing spend? So, early in the year when we were thinking about this bleak economic outlook, we shared our thoughts with management teams of our portfolio companies just to help them brace for this environment. And our recommendation was not necessarily just to cut costs. It would be just to try to optimize, to try to drive efficiencies. So unfortunately, probably it means that none of our portfolio companies are going to be taken out by the two gentlemen on my side, because I think they want to try to do it themselves. And get through that downturn. If you have those, if you can articulate your unit economics to investors, at least investors like us, we are willing to underwrite those and invest in these companies going forward, because we know ultimately they have such a big market opportunity, and to JD's point, such good operating potential at the end of the runway, that we want them to invest and we want them to become the market leader that they're now looking like they will become.
Do you think the public markets so far have been, so far in this cycle perhaps, have been good at distinguishing between which of those companies are going to be well positioned and which aren't? And I ask that because in tech, you have this enormously high sort of correlation between all tech companies, and they've all been seemingly hammered equally, perhaps aside from the SPACs, which have been at the high end of that process. And I wonder, sort of looking at the public markets, why we're seeing this failure to disentangle the good from the bad in terms of the technology businesses.
It's hard for me to speculate on why, but you're absolutely right. If you look at software, which is what all three of us are involved with, it's actually one of the sectors with the highest intra-stock correlation. So meaning that those stocks tend to move in unison. And that's not the case historically. They're actually pretty heterogeneous stocks or companies. You have companies catering to end markets like construction, and you have data infrastructure. So it's really an oddity in the situation, and I think it's a really good starting point to think about where are alpha opportunities. And one way to look at this is where to find value right now is to look at high growth companies with recurring revenue models that trade at a level that's lower than their March 2020 low. Because at that point, you're already incorporating the prospects of a recession. And secondly, because of the recurring revenue nature, these companies are much larger now after 2.5 years of growth and much more profitable than they were back then. So there are these select pockets of opportunity right now that look really interesting from a risk-reward perspective. But maybe software as a whole, I think there could still be more downside in valuations if rates continue to go up.
Right. I think, Ed, the other thing too is the market was so oversupplied with public companies last year, and so I think there were over 1,000 IPOs on the NASDAQ and NYSE last year, and a normal year might be 200 or 300, and that includes all the SPACs you mentioned. And so I think a lot of public market investors were overwhelmed last year, and they're just throwing up their hands right now. And so, as Ulrike said, a lot of these things are kind of trading together, and the work hasn't been done, and the results haven't been out there long enough to really say, okay, which of these companies is working? It's this 20% grower versus this 20% grower. We're not really sure yet because it's been public for 12 or 18 months. Many of these companies went public through SPAC or direct listing and didn't even really educate the market on their businesses in the first place. So hopefully, selfishly for Brian and myself, it's more opportunity of companies that are mispriced by the public markets because they don't have a following and the market doesn't know how to think about them.
Well, I suppose on the SPACs, they didn't. I mean, there were fewer data points because they didn't have to provide as much data, but they could provide a lot of promises, very few of which one assumes, at least today, are being fulfilled. Brian, on the opportunities, I mean, clearly when you have a saturated public market and depreciating values, it's going to be good for the buyout business. And I wonder where you see the inflection point. At the moment, presumably a lot of management teams are looking at their 52-week high and saying, we don't want to sell yet, and if we do want to sell, we definitely don't want to sell materially below that 52-week high. Where do you see the sort of tipping point where a lot of these companies say, okay, like enough, we're now willing to go private?
Yeah, it's interesting. I think it's kind of starting to happen now. And what we've seen is, when the correction originally first happened earlier this year, of course there was a lot of, well, is this a blip? Are we going to kind of bounce right back? Looking at the 52-week highs, it's really hard psychologically to move yourself off of that. As we've kind of moved through the year and we've seen, the macroeconomic environment in Europe, the dollar strengthening, obviously everything that's happening with Ukraine, now what seems to be potentially happening in the U.S. from a macro standpoint, Q2 and Q3 bookings, right? That now boards have a full understanding of kind of how that business performance has come in, which really is the leading indicator for how the company's going to perform next year. And on top of all that, I think you've got a budgeting process that's starting at these companies, right? So just like all of our companies, I'm sure all the public companies are now with Q3 behind them, really kind of figuring out, okay, what does our draft budget for 23 look like? What do we just see in Q3 from a momentum standpoint? what about all these potential headwinds, and starting to realize that this doesn't feel like a blip. This feels like this is kind of here to stay. And I think people are now saying, well, could we potentially take a deal at a 40 or 50% premium versus how long is it going to take us over the next 12, 24 months to potentially get to that level in the face of these potential headwinds. So I think those conversations are starting to get a lot more interesting now. But the backdrop of that is capital is a lot scarcer. Cost of capital is going up, and so the question I think is going to be, are the valuations right at this point, to start seeing some of these deals happen? And I think in certain spots they have been, and I think they will probably continue to get better here over the next couple months.
How much are you seeing management teams come to you versus you guys, what we traditionally think of private equity as doing, going out and sort of pounding the pavement and trying to get companies interested in perhaps selling?
Yeah, definitely more inbound, than prior years for sure. And I think part of that too is we spend a lot of our time, like you said, out in the market, building relationships with these companies and these CEOs, even when we know there's not a deal to do, even when they're trading at 20 times revenue, right? Because we want to build that relationship over a long period of time. We want to understand their business and their market as well as we can. And then you find yourself in a market like this. And I think now, fortunately, we've had a good reputation in being able to help these types of companies grow and do it profitably. And so we're getting a lot more inbound calls saying, hey, how would you think about this, and what's happening in the debt markets, and for our business, like how do we continue to grow and get the profits up, and and how would you guys work with us, and how do you work with managers? So there's a lot more of that discussion happening, which is super interesting.
JD, when you at General Atlantic are sort of looking at the opportunity set and perhaps what's coming, whether it's in the first quarter or second quarter of next year, what lessons can you draw from previous crises and try and help identify, like, these are going to be the right kind of targets, and this is going to be the right moment in time to go after them?
That's a great question. I think, I was at Silver Lake for 17 years through the 08, 09, credit crisis, and saw a lot of the buyouts that got done ahead of that era struggle for all kinds of obvious reasons. And I think the lesson, especially as a lot of folks in private equity haven't lived or worked in an environment of the interest rates that Ulrike is talking about, and so thinking about buyouts and thoughtful capital structures and the cost of credit as folks pursue those, I think is going to be really important. And credit agreements are, I think, going to get much more restrictive on what you can do. And I think from my seat at General Atlantic, where we are very much a growth equity, growth-focused shop, we will use leverage to help support an acquisition or an investment. But we're always going to err on the side, I think, of lightly levering our companies. So not pushing leverage, 6, 7, 8 times EBITDA as you've seen, or in some cases, 3, 4 times revenue, I think, over the last 2 years. Because what I find, or what we saw in a downturn, you want to be able to, the best thing you can do is invest aggressively to take market share in that environment. And you don't want to be, have handcuffs behind your back with your leverage thinking, oh, geez, this is running tight, or we might bust a covenant, or geez, we need to do this to the business to make sure we can refi our debt in 12 months. Because once you start making those trade-offs, then you can quickly get in a bind and start destroying equity value. So I think for us, as I try to build out the growth buyout capability within General Atlantic, a big focus will be on using leverage in a very moderate, careful way.
Ulrike, we talked a lot about the, as it were, like the constituents in the market and at these companies not having had experience of anything other than a good market before, but that also applies to a lot of investors. And I wonder if you see, in the public market, if you see broadly that the investor base is going to be supportive of this period of pain and the changes that some of these companies are going to need to institute, or whether they will prefer to see, Bryant and JD and their ilk come in and actually offer a premium, for the day and be done.
That probably depends on the investor. And again, with a long-term horizon, having spent a lot of time with the companies before we invest, having them seen maneuver difficult situations in the private markets, even though capital has been cheap, certain companies have struggled, whether it's with their partnership, whether one of the core partners leaving, but we have seen them overcome challenges in different shapes and forms. So for us, we want these companies to succeed by themselves. We don't want them to be bought out, and we think they have the ability to be the leader in this next age of digital and data, which is our investment thesis, that this next decade will all be about making software intelligent, and our companies are playing a big role there. So from my perspective, I'd like these companies to remain standalone companies. That might mean more downside in the short term, but I think the upside in the long run that these companies will be able to provide to long-term investors is going to be far outweighing these short-term considerations. So I know other investors have said the opposite to their portfolio companies, cut costs, show operating margins right away. But even studying 2008, which was obviously a pretty severe recession, when you study those software companies that have continued to spend on sales and marketing during that period, they have come out much better in 2009. And if you listen to Mark Benioff recapping that period, that was one of his biggest regrets, to actually start cutting sales and marketing actually relatively late 2008, early 2009. And he makes that clear statement that he shouldn't have done that because it took them a lot longer to recover and rebuild the sales organization.
JD, one of the investor groups that I'm sure will find discontent with the way some of these public companies are behaving are the activists. Obviously, they will, I'm sure, sort of licking their lips at the prospects of being able to push some of these companies into the hands of private equity. How important are they going to be in this next piece of the cycle at actually realizing some of those opportunities, or helping private equity realize some of those opportunities?
I think it's a big trend you're seeing with folks like Elliott and Clear Lake. It's not just the type of activist has changed quite a bit, in my observation of the last couple of years, which is you're seeing activists who aren't just sort of hedge funds looking to get a quick 20% pop. There are folks who do have the private equity skills and do the deep fundamental research. Elliott's, I think, a great example. They'll come into a stock, and as they've done with Citrix and others, they'll say, hey, we'll buy the company at a price as well. So they're kind of standing behind the activism, so to speak. And I think that's a clear trend. I think that you're seeing the blurring of the lines. And when a firm shows up with a 10% ownership position in a stock, the board and the management team, and they have to respond. And so I do think it does put a lot of these companies more in play to do something or consider something when that happens, for sure. So it's a big trend. I think it'll continue. And it'll probably be the one thing that tips over a lot of the boards who I think are currently reluctant to engage because they're looking at the 52-week high that you mentioned and saying, man, we're down 50% from where we were a year ago. Is this really a wise time to engage with buyers? But as folks come into their stock and try to push the issue, I think that they have to be responsive.
Right, and boards are obviously also in the mode of sort of self-preservation, and it's perhaps not that easy to find employment as a board member at the moment either. So they are not wanting to do anything that could potentially see them ousted. The activists might offer an opportunity to go a different way. I want to get on to some questions from the audience in a few moments, but just before we do, look, obviously re-educating companies, helping to re-educate investors about the new environment is one thing, but I want to ask each of you all around this panel have seen good markets and bad, but I'm sure all of you have colleagues and subordinates who have not. And I wonder from a practical point of view, how you re-educate your own workforces about the market we're in right now, the environment we're in right now, how to trade it, how to invest in it, and how to sort of get away from the mentality that has been so present for a long time around growth. JD, I'll start with you on that.
Yeah, I'll go back to the question you asked me before, around capital structure. I think this is the biggest one, because in the last decade of private equity investing, roughly, if you borrowed money, the interest rates were very low, the interest cost was very, very low, and because the market had been booming so much for levered credit, if you read one of these credit agreements, the restrictions are extremely light. No covenants, all kinds of flexibility to take cash out of the business, and a lot of folks in our industry haven't really lived in a tight credit environment, and so when you're looking at a buyout and thinking about things like credit statistics and baskets and flexibilities, that legal document I think is going to become much more important. And thinking through the scenarios of, well, if we do go through a recession, what's the probability that I'm going to have a credit problem, and how do I deal with that? So I think that's a skill. I lived through a cycle, and I've seen it, but I think a lot of us have forgotten it because it was so long ago. But I think assuming rates are going to come up, as Ulrike was saying, that's going to be the new world.
Our investment thesis is focused on data and artificial intelligence. So we not only invest in it, we also use it as our own process. We eat our own dog food, I guess, as you may say. So it's all about using data in our investment process and going back and studying those other periods. So even if you haven't lived through them, and we haven't lived through the 70s either, and when we run a model where we're trying to match the current economic conditions to past economic conditions, what's interesting is one period that I lived through that comes up in terms of the closest match with a very simple machine learning algorithm is 2000, 2001. But the other periods that come up is 73 and 78. So where you had these big commodity shocks. So going back and using data analysis in your investment analysis, I think is key. We think it's key for our portfolio companies. We think it's key for our own understanding. And so even earlier in the year, we tried to predict the extent of the recession, also with a simple machine learning model, just looking at macroeconomic indicators. So we can hedge our portfolio, but also share the insights with our portfolio companies. So it's all in data and AI. That's my conclusion.
The other big one, Ed, is which Ulrike reminds me of, is inflation. Because a lot of these business models, folks are used to studying the revenue model and understanding how they work, but some businesses are in a much better position to pass inflation on to their customers, and some are not. And they're all going to experience cost inflation, right? So most folks aren't building, operating models thinking about an inflationary environment and what that can do, to your revenue and costs. And obviously that could have a huge impact. If you're running mid-high single-digit inflation for several years, you can end up with a very different result than you're sort of expecting, penciling out on paper.
Yeah, I think for us, the word that really comes to mind is patience. And I think, if I look back over the last 8 years, there was such a heavy premium placed on speed and ultimately winning the deal, getting your hands on the asset, because there was so much capital chasing, so few companies. And I think now that capital is a lot scarcer, and to JD's point around really having to dig in on these revenue models and the macroeconomic headwinds that we're potentially facing, being patient, grinding the deal out, doing all the work, making sure that you're factoring all those things in, and ultimately getting to a place where you negotiate a really good deal. I think that's kind of where the premium now has shifted. And so I think you're going to see these sales cycles, these deal cycles elongate. And it's going to take longer. They're going to be more heavily negotiated. There's going to be, I think, less capital in some ways chasing some of these things. But there's going to be a huge premium on getting it right. And so that we were just having this discussion internally about almost retraining our teams on, we don't need to go, spend 2 weeks and be done. Let's take our time, take a deep breath, make sure we're not missing anything. So I think that's going to be a bit of a new way of operating, for our firm.
Elongated processes are something all journalists like, because it just means a much higher likelihood of a leak, well, several leaks along the way. So there you go.
Silver lining.
So we have just about 10 minutes to turn over some questions from the audience. There is someone among you with a microphone. There you go at the back. So please, if you have a question for anyone on the panel, or indeed myself, raise your hand and we'll get it answered. Here we go. This gentleman here at the front.
Yeah, thanks for the wonderful insights and also your advice for entrepreneurs at this stage, this era. As an entrepreneur who we Surfin is focused on consumer market, financial technology in emerging markets for 8 countries, 3 continents. So I think the session right now, we talk about growth. I appreciate your advice about profitable growth and also, make a unique economy more sustainable to pass this stage. But I think besides the capital cost and also the financial cost, the other topic probably not addressed yet is the regulatory cost. Because we are AI data-driven consumer, so data localization become a global phenomenon and become a sensitive topic in each country's regulatory environment. So at this stage, as a global startup, penetrating different countries, we have to deal with different countries' regulatory issues. You know, U.S. is just one of the examples, but the emerging market is also sensitive of data privacy, data localization, each country. So I don't know at growth at cost, you know, regulatory cost. I don't know what kind of advice. I don't know if you in any of your portfolio have this global portfolio, has a global market exposure. What kind of advice you give to us like this, and any suggestion for meeting the regulatory demand, especially on data. Data is it's a balance, you know. Data, AI can help people. The previous panel on healthcare, I think the data aggregating is essential for innovation to predict, you know, early treatment, early health care, this kind of. But on the other hand, the data privacy. So how to balance this data aggregating in each country even? So I'm just posing this topic. Thank you.
Yeah, I can maybe share a privately list of our portfolio companies to help with this. But yeah, I think data localization is definitely going to be a big topic over the next decades, frankly, as we are entering this era of deglobalization and now in much more bipolar world where I think data needs to be localized, but also supply chains more broadly are going to be rebalanced. And I think it's something that is going to be a cost. And as an entrepreneur, you have to prioritize that.
Yeah, the only comment I would add is you know, wherever you can, try to make data an asset that's a competitive advantage, as opposed to just, you know, a tax and a cost on your business. And you know, that's where I think you can create the most exciting business models and opportunities, where you create a data moat, you know, and a competitive advantage against new entrants.
Yeah, I guess I would add in some of these like highly regulated end markets, you know, so I think scale is a huge advantage, and the benefit of being able to run your business profitably, you know, is the ability to then leverage your balance sheet to make acquisitions, right, and to grow that way. So, you know, it's just something to think about. You know, that's how we try to operate all of our companies, right? Is you can go try to spend the time and the investment to potentially, you know, grow organically and build products, but you know, if there's another company out there that's doing something that's really strategic to your business that you can acquire, I mean, it's amazing how impactful that model is, right? Being able to supercharge your product roadmap and get scale and do it, you know, profitably, and using your balance sheet where you're not, you know, diluting shareholders. So that's maybe one other thing to add.
Thank you.
Hi. Is it okay? Hi, thank you for this great panel. I have a question on valuation, given this new context. To what extent is EBITDA still the right aggregate, and how do you price, like how do you value using both ARR and EBITDA? Because I understand that from an operational perspective, you're wanting to exit at a greater EBITDA because you're factoring in all those operational improvements. So to what extent are you basically juggling between ARR and EBITDA to have the right valuation at entry? Because EBITDA is the valuation aggregate at exit, I understand.
Sounds like a private equity question. Bryant.
Sure, yeah, happy to take that one. No, it's a really good question. So, yeah, I think from our perspective, you know, even in the companies that we're buying where they don't make money, you know, today, and we're valuing them on an ARR or revenue multiple basis, we are almost exclusively underwriting them on an earnings exit, right? So that EBITDA, you know, like where you think you can get to over a 4 or 5 year period is incredibly important. And how do you operationally make those changes? And like we were talking about before, you know, do you have the right management team to do that? Do you have the right corporate governance structure? And then, you know, do you have the right culture at the company to be able to make these hard decisions and to actually grow profitably? But ultimately, you know, I think in this world especially, everybody is now looking at earnings multiples, I would think, you know, as they think about the future value of these companies. And so, if you were in that spot where you were entering on a revenue multiple basis and thinking maybe I'll exit on a revenue multiple basis or in an IPO, it feels like those days, at least for now, are kind of behind us. So, I think that you're seeing that obviously in the market now, and I think what's really interesting too. I think the market has spoken pretty clearly in terms of how they're valuing these companies. Right? If you look at, we kind of looked at all the public software companies out there, stratified by margin profile. And the companies that basically had 0 to kind of 10 to 15% margins or burning, if you look at kind of how they performed since Jan 1, they're off like 55%. And if you look at the companies that are profitable, 30% plus EBITDA margins, they kind of came down, 20, 25%. And they're still trading at pretty reasonable forward EBITDA multiples. So it seems like the market has spoken pretty clearly on that. And if you're not looking at earnings as your exit, you probably should figure out how you're doing.
JD, I just sort of want to pick up on that question. I mean, when I look at some of these sectors that have been really hammered, and I think of some of the gaming companies, DraftKings and the like, where the business essentially that have very, very high acquisition costs of users, but as yet unprofitable. And I wonder how as private equity, you look at businesses like that or sectors like that. Is there any opportunity there, or are these just going to be sort of completely left alone because they are so hard to look at on a realistic EBITDA multiple?
Those businesses are hard to price for a bunch of sort of obvious reasons, I think. One is a lot of them got a big pandemic bump because there was more activity. There was a lot of cash pushed out to Americans through stimulus, that a lot of which flowed into things like gambling and crypto and meme stock trading. So a lot of those businesses had an operational bump from all that stimulus, and people being at home with a lot of extra time. And and I don't know much about DraftKings or that world, but obviously, there's a big perception that the gambling market is opening up, right? And so I think for the believers, they're thinking, wow, there's this huge TAM here. Maybe I can be in with one of the folks who's going to be a leader. But that's squaring away the risk reward of that investment, I think, is very difficult. There'll be some huge winners, I would imagine. And can you get lucky and pick one? Maybe. In General Atlantic's growth equity business, pre-IPO investments in high growth businesses, we're still looking for high quality businesses with proven unit economics, with big TAMs and good teams, and hoping for those big payoffs. So I think there's will continue to be a healthy growth equity market, but in a lot of cases where these businesses where they're burning money and you're just hoping a huge market comes, the valuations on those businesses just have to come down as the cost of capital goes up.
Do you have any more questions? I can only see half the floor. Okay, so I'm just going to we've got just over 90 seconds left. I'm just going to ask each of you before we go. Look, obviously, at some point we will emerge from this crisis or this downturn. Whether or not we go back to a sort of growth at all cost model or something else, do you each think the lessons of the last few years, the bubble, I think we can call it, will be learned? JD, I'll start with you as you're furthest away.
I'd say yes and no. I mean, Wall Street has a short memory, and anytime there's a new cycle of mania, I think there's a lot of magical thinking that happens. It happened in 2001, as Ulrike was saying. It had happened a little bit in the build-up to the credit crisis. So we'll see. But I do think there are a lot more quality businesses with quality revenue models, pursuing exciting markets. So the world that I spend a lot of my time in, tech businesses with recurring revenues, I think the TAM is getting bigger and bigger and bigger and more exciting. So we're excited for that at General Atlantic.
Yeah, I think the environment was such that you had to invest in growth and had to do all those things because the opportunity costs were so low. So looking forward, if rates are going to be higher, no, I don't think we'll go back to that type of environment. If we think that maybe rates normalize at 3% through cycle, we're probably going to go back to sort of a range of 5 to 10 times ARR multiples exits for high growth, very high quality software companies. So that for me is more the equilibrium assumption. Learnings, I think maybe just to be a little bit more forward looking. Obviously we had a lot of signs that inflation was about to pick up. Watching macroeconomic indicators more carefully. Those are some of the lessons probably to learn from a tech investing perspective.
Yeah, and it seems like I think some of those lessons, we're now seeing very clearly in the market in terms of just how these companies are operating, how they're focusing on profitability. So even in the discussions that we're having with a lot of these companies, you can feel and see that there's been a real kind of paradigm shift in terms of how people think about that. And I think that could potentially be a really positive thing for the industry. And hopefully that lesson learned will be that there is a way to actually run these companies profitably, and that doesn't have to be mutually exclusive from growth. We've certainly seen that in our portfolio, and I think there's no reason why we shouldn't be able to see that more broadly. And we're also here to help for all those companies. So,
thank you.
I'll make one bold prediction, Ed. I don't think the SPAC market is coming back.
Yes, bold indeed. Now we have the clock counting up, not down, so I think it's our time to move on. But guys, thank you so much. Fascinating conversation. Thank you so much for joining us, and thank you all for attending.
Okay, so we're breaking for lunch now. It's the same situation as yesterday, plated lunch that will be brought around. And we'll have our next speaker at 1:20 p.m., which is a conversation on financial literacy moderated by Jim Lockhart. Enjoy your lunch.
to create jobs and support local communities, and partnering with businesses large and small to fund their growth and enable transformation. As we look to new generations, we are committed to making progress and to developing a more sustainable future. As a leading capital provider accelerating the energy transition, from development to production, all the way through to consumption. Building a better future also means expanding opportunity across our ecosystem. It means deepening our relationships, broadening our network, and developing new connections every step of the way to better serve our investors and our communities. Through it all, consistently challenging convention, sparking new ideas, and fueling innovation. At Apollo, we are investing in tomorrow, today.
Surfin with waves of digital financial technologies. With the rapid development of digitalization and globalization of financial markets, Surfin has always been driven by digital technologies to invest globally. Surfin Group specializes on two major areas: digital finance and technology empowerment. Since 2017, Surfin Group has invested across 3 continents, which are Asia, Latin America, and Africa. With 20 million users in 8 countries and a total transaction volume of over $2 billion, Surfin invests digitally. Surfin Group focuses on digital investing to empower financial services and asset management globally. Surfin Group processes and develops tens of terabytes of data, hundreds of big data models, millions of feature vectors, millions of effective product models, and asset allocation portfolios. Surfin has global risk management experience. Surfin Group delivers risk management expertise in global asset allocation and investment. The investment and technology can be efficiently married by individually matching of dynamic asset allocation portfolio based on big data and personalized efficient frontiers, integrated with multi-asset classes, multi-trading frequencies, and multi-strategies through risk parity allocation. Personalized and diversified portfolios can be constructed to provide scalable asset allocations and across various market cycles. Surfin Group also develops a fully functional and convenient digital integrated wealth management platform across borders and different markets, which can provide middle-class customers with digital smart financial services, including news and information, user forums, investor education, investment advisory, and financial planning services to enhance global investment experiences. Surfin Group develops 4 proprietary core technology systems that enables real-time online accessing, multi-ethnic group matching, and global multi-country servicing, intelligent risk appetite system, EKYC system, big data behavior analytics system, AI smart voice system. Surfin Group looks forward to seeking mutual benefit and win-win cooperation with various partners to develop an ecosystem to invest in emerging markets. Surfin Group has always been persevered, persistent, and passionate. Surfin shall stay focused and strive to serve more global investors with digital technologies and making life better with smart, open finance.
Companies of all sizes rely on us for world-class, less-than-truckload freight transportation. We handle our customers' freight as if it were our own, moving it across North America on a coast-to-coast network that covers 99% of all US zip codes. When freight is put in our hands, it gets where it needs to go, safely and on time. Our customers are growing, and we are too, expanding our footprint and fleet and certifying more truck drivers at over 130 XPO driver training schools. And we're constantly enhancing our technology, creating new network efficiencies to ensure a world-class LTL shipping experience from pickup to delivery. With industry know-how, local knowledge, and the hunger to keep improving results, when you ship with XPO, you'll find that our people are committed to your success. XPO, your freight first.
Over 250 million young people are not in education, employment, or training. But how you start in life shouldn't determine what you do in the future. In the last 3 years, Future Makers by Standard Chartered has supported more than 650,000 talented young people from low-income communities, transforming lives by empowering them to learn, earn, and grow. Because where others see problems, we see potential. We're Standard Chartered, and we're here for good.
Fundamental part of your portfolio. In fact, investment professionals recommend allocating at least 20% of your portfolio to alternatives. So how can alts create a more efficient portfolio? Versus traditional investments, alts reduce risk while maintaining your expected returns, or maintain your risk level while potentially improving your expected returns. We talked to actor and former White House staffer Kal Penn to help explain private markets.
If you're watching this video, it means you've been wondering, What are alternative investments? And why are all your savvy investor friends talking about them? Or maybe that's going to be you right after this video. So, alternative investments are basically anything beyond the stock and bond markets. You're probably most familiar with real estate. I know I love places. A beautiful resort. Or maybe just an office far away from your perfectly behaved children. There's also private equity, venture capital, and a few more that aren't as mainstream, like art and crypto. Basically, lots of cool things to discover. When you put alts in your portfolio, you're helping to ensure that you have investments that don't always follow the ups and downs of the stock market. Yup. Here we go again. That, my friends, is called diversification. In addition, people like alternatives because they can generally outperform the stock market. So, how can you get started? Before YieldStreet, you probably would have had to pony up $1 million and tie it up in a single investment. Yikes. But now, the potential of private markets is at your fingertips.
Thanks, Cal. With $3 billion invested on the platform and almost $2 billion in principal and returns paid to investors, and 9.6 realized net annualized returns, isn't it time to diversify away from the stock market? Invest in curated private market alternatives from top managers, all on one easy-to-use platform. Evolve your wealth. YieldStreet, private market investing.
MFA exists to serve and represent the private fund industry, and we do this through advocacy and convening our members to address key business and operational issues.
So the MFA is a phenomenal partner of resources and peer groups and forums that comes together.
And this ability to bring people together is just so important because it just makes me better, it makes my team better.
What the MFA does is the MFA sits firmly in the middle and is ensuring that as they take the inputs from the regulators, take the inputs from the policymakers, and then take the inputs from the manager, that feedback loop that they're bringing is going both ways.
If we have a growing and active membership, that provides MFA in the industry with more resources, more credibility to better advocate for those policy outcomes that support the industry's growth.
So when you join it, you're not joining an association, you're joining a group of peers that have common interests and really want to help you succeed.
There's no downside. It is truly all upside when you become a member of the MFA.
Ensuring a bright, bold future means investing in tomorrow, today. And Apollo is at the forefront. Our capital is helping to solve some of the world's most complex problems by securing retirement for millions of families, building and financing stronger businesses, and driving a more sustainable future for our communities. Bridging our economic present to our future. Empowering people to retire better, from teachers to firefighters and other essential workers, Apollo is creating retirement solutions for millions of families. We're investing across sectors and geographies to create jobs and support local communities, and partnering with businesses large and small to fund their growth and enable transformation. As we look to new generations, we are committed to making progress and to developing a more sustainable future as a leading capital provider accelerating the energy transition, from development to production, all the way through to consumption. Building a better future also means expanding opportunity across our ecosystem. It means deepening our relationships, broadening our network, and developing new connections every step of the way to better serve our investors and our communities. Through it all, consistently challenging convention, sparking new ideas, and fueling innovation. At Apollo, we are investing in tomorrow, today.
Surfin with waves of digital financial technologies. With the rapid development of digitalization and globalization of financial markets, Surfin has always been driven by digital technologies to invest globally. Surfin Group specializes on two major areas: digital finance and technology empowerment. Since 2017, Surfin Group has invested across 3 continents, which are Asia, Latin America, and Africa, with 20 million users in 8 countries and a total transaction volume of over $2 billion. Surfin invests digitally. Surfin Group focuses on digital investing to empower financial services and asset management globally. Surfin Group processes and develops tens of terabytes of data, hundreds of big data models, millions of feature vectors, millions of effective product models, and asset allocation portfolios. Surfin has global risk management experience. Surfin Group delivers risk management expertise in global asset allocation and investment. The investment and technology can be efficiently married by individually matching of dynamic asset allocation portfolio based on big data and personalized efficient frontiers, integrated with multi-asset classes, multi-trading frequencies, and multi-strategies through risk parity allocation. Personalized and diversified portfolios can be constructed to provide scalable asset allocations and across various market cycles. Surfin Group also develops a fully functional and convenient digital integrated wealth management platform across borders and different markets, which can provide middle-class customers with digital smart financial services, including news and information, user forums, investor education, investment advisory, and financial planning services to enhance global investment experiences. Surfin Group develops 4 proprietary core technology systems that enables real-time online accessing, multi-ethnic group matching, and global multi-country servicing. Intelligent Risk Appetite System, EKYC System, Big Data Behavior Analytics System, AI Smart Voice System. Surfin Group looks forward to seeking mutual benefit and win-win cooperation with various partners to develop an ecosystem to invest in emerging markets. Surfin Group has always been persevered, persistent, and passionate. Surfin shall stay focused and strive to serve more global investors with digital technologies and making life better with smart, open finance.
Companies of all sizes rely on us for world-class, less-than-truckload freight transportation. We handle our customers' freight as if it were our own, moving it across North America on a coast-to-coast network that covers 99% of all US zip codes. When freight is put in our hands, it gets where it needs to go, safely and on time. Our customers are growing, and we are too, expanding our footprint and fleet, and certifying more truck drivers at over 130 XPO driver training schools. And we're constantly enhancing our technology, creating new network efficiencies to ensure a world-class LTL shipping experience from pickup to delivery. With industry know-how, local knowledge, and the hunger to keep improving results, when you ship with XPO, you'll find that our people are committed to your success. XPO, your freight first.
Over 250 million young people are not in education, employment, or training. But how you start in life shouldn't determine what you do in the future. In the last 3 years, Future Makers by Standard Chartered has supported more than 650,000 talented young people from low-income communities, transforming lives by empowering them to learn, earn, and grow. Because where others see problems, we see potential. We're Standard Chartered, and we're here for good.
What if you could invest in private equity, real estate, private credit, even art, with clarity, confidence, and help when you need it? Meet Yield Street, the leading platform for private market investing. We believe that private market alternatives like real estate, private credit, and art should be a fundamental part of your portfolio. In fact, investment professionals recommend allocating at least 20% of your portfolio to alternatives. So how can alts create a more efficient portfolio? Versus traditional investments, alts reduce risk while maintaining your expected returns, or maintain your risk level while potentially improving your expected returns. We talked to actor and former White House staffer Kal Penn to help explain private markets.
If you're watching this video, it means you've been wondering, what are alternative investments? And why are all your savvy investor friends talking about them? Or maybe that's going to be you right after this video. So, alternative investments are basically anything beyond the stock and bond markets. You're probably most familiar with real estate. I know I love places. A beautiful resort. Or maybe just an office far away from your perfectly behaved children. There's also private equity, venture capital, and a few more that aren't as mainstream, like art and crypto. Basically, lots of cool things to discover. When you put alts in your portfolio, you're helping to ensure that you have investments that don't always follow the ups and downs of the stock market. Yup. Here we go again. That, my friends, is called diversification. In addition, people like alternatives because they can generally outperform the stock market. So, how can you get started? Before Yield Street, you probably would have had to pony up $1 million and tie it up in a single investment. Yikes. But now, the potential of private markets is at your fingertips.
Thanks, Cal. With $3 billion invested on the platform and almost $2 billion in principal and returns paid to investors, and 9.6 realized net annualized returns, isn't it time to diversify away from the stock market? Invest in curated private market alternatives from top managers, all on one easy-to-use platform. Evolve your wealth. Yield Street, private market investing.
MFA exists to serve and represent the private fund industry, and we do this through advocacy and convening our members to address key business and operational issues.
And so the MFA is a phenomenal partner of resources and peer groups and forums that comes together.
And this ability to bring people together is just so important because it just makes me better, it makes my team better.
What the MFA does is the MFA sits firmly in the middle and is ensuring that as they take the inputs from the regulators, take the inputs from the policymakers, and then take the inputs from the manager, that feedback loop that they're bringing is going both ways.
If we have a growing and active membership, that provides MFA in the industry with more resources, more credibility to better advocate for those policy outcomes that support the industry's growth.
So when you join it, you're not joining an association, you're joining a group of peers that have common interests and really want to help you succeed.
There's no downside. It is truly all upside when you become a member of the MFA.
Ensuring a bright, bold future means investing in tomorrow, today. And Apollo is at the forefront. Our capital is helping to solve some of the world's most complex problems by securing retirement for millions of families, building and financing stronger businesses, and driving a more sustainable future for our communities. Bridging our economic present to our future. Empowering people to retire better, from teachers to firefighters and other essential workers, Apollo is creating retirement solutions for millions of families. We're investing across sectors and geographies to create jobs and support local communities, and partnering with businesses large and small to fund their growth and enable transformation. As we look to new generations, we are committed to making progress and to developing a more sustainable future. As a leading capital provider accelerating the energy transition, from development to production, all the way through to consumption. Building a better future also means expanding opportunity across our ecosystem. It means deepening our relationships, broadening our network, and developing new connections every step of the way to better serve our investors and our communities. Through it all, consistently challenging convention, sparking new ideas, and fueling innovation. At Apollo, we are investing in tomorrow, today.
Surfin with waves of digital financial technologies. With the rapid development of digitalization and globalization of financial markets, Surfin has always been driven by digital technologies to invest globally. Surfin Group specializes on two major areas: digital finance and technology empowerment. Since 2017, Surfin Group has invested across 3 continents, which are Asia, Latin America, and Africa. With 20 million users in 8 countries and a total transaction volume of over $2 billion, Surfin invests digitally. Surfin Group focuses on digital investing to empower financial services and asset management globally. Surfin Group processes and develops tens of terabytes of data, hundreds of big data models, millions of feature vectors, millions of effective product models, and asset allocation portfolios. Surfin has global risk management experience. Surfin Group delivers risk management expertise in global asset allocation and investment. The investment and technology can be efficiently married by individually matching of dynamic asset allocation portfolio based on big data and personalized efficient frontiers, integrated with multi-asset classes, multi-trading frequencies, and multi-strategies through risk parity allocation. Personalized and diversified portfolios can be constructed to provide scalable asset allocations and across various market cycles. Surfin Group also develops a fully functional and convenient digital integrated wealth management platform across borders and different markets, which can provide middle-class customers with digital smart financial services, including news and information, user forums, investor education, investment advisory, and financial planning services to enhance global investment experiences. Surfin Group develops 4 proprietary core technology systems that enables real-time online accessing, multi-ethnic group matching, and global multi-country servicing, intelligent risk appetite system, EKYC system,
Okay, good afternoon, everybody. I'm back here to shush you. I hope you're all enjoying your lunch. Thank you for settling down. We're going to start with the conversation today. Shh. Thank you very much. The shushing works like a charm. Thank you for coming back here. We're about to start the lunch program. It's going to be a conversation today with John Hope Bryant, who is founder, chairman, and CEO of Operation Hope. And the moderator is Jim Lockhart, who is a senior fellow with the Bipartisan Policy Center. They're going to be talking about financial literacy. Thank you for welcoming them.
My pleasure. Thank you very much.
It's great to see you.
Good to be seen.
John Hope Bryant is the leading proponent of financial literacy, having founded Operation Hope 30 years ago. He has a very compelling life story, which we'll get into a little later. I first met John about 20 years ago, almost, when I was Chief Operating Officer of Social Security, and he was President Bush 43's vice chair of his council on financial literacy. And he's been working on those issues ever since, nonstop. Ray Dalio yesterday, I don't know if all of you heard Ray yesterday, but one of his first opening lines was saying he measures things. And that's extremely important when you're looking at issues like financial literacy. He also mentioned really three key issues that he worries about. One was the high levels of debt in this country and around the world. Another was obviously international conflicts. But the third was basically what he called internal conflicts. And of course, that's the politics. But the other thing he talked about was the wealth gap. And we have a very significant wealth gap in this country. And it's not measured as well as it should be. And I think John has done that measuring. He has created something that I think would even surprise Ray, and that is something called the Hope Community Credit Scores. And with that, I'll put up a slide if we could. And I'll have John talk about the slide once it comes up. Hope you can see the numbers there. Can you see the numbers? Okay.
Yep, good enough.
So this is St. Louis, and it's two zip codes right next to each other. And there's some very compelling stories if you would get into it, John.
First of all, good afternoon. Oh, that was pretty weak. I've been to 100 countries. I just got back from Italy 2 days ago, but I'm from the black church, so I'm used to seek and respond. So good afternoon. Yeah, there we go.
Well done.
I just fought traffic from Manhattan to get here, and there was a really bad accident. So I need to make sure that we are all 100% present because I think that love is work. Non-love is laziness, and anti-love is evil. Evil exists, but it's very rare. Most people are just lazy. They just don't want to do the work. And I think a lot of people would have turned around and said, I can't make it. Maybe in your own businesses you wouldn't have leaned in. This data is going to tell you something about leaning in. Before we get to that, I want to commend the organizers of this conference. I want to commend Jim, who is a lifetime public servant. And if we had followed his counsel, we'd have a vision for Social Security which is sustainable. I'd encourage you to go back and look at some of his work during the last crisis we had, where he was in charge of Fannie and Freddie as an oversight regulator. His work with President Bush, where I met him, just an incredible human being. I'm honored to be with you today, Jim.
Honored to be with you.
I want to say thank you also to Aries Management that's here, and to Bill Mendel and Sarah of Mendel Communications, my wife, of course, Shatra, who's here. Now let's get into this data. I like math because it does not have an opinion. That is a very telling and prescient quote. This data screams. This is 10 miles from each other. These zip codes, which are literally parallel, show the story of two Americas. Now, I can't see that. I got a visual. I mean, I know the data off the back of my hand, but I want to be very specific here. You have a high 580s in the inner city credit score, and then you have the mid 750s right in literally a zip code right next to it. Let's just go right to some of the starkest data. Look at violent crimes per 1,000. Can you see that? That is unbelievable. Look at it in comparison to Clayton. Now I want to take you to high school graduation rates. You see that? Basically 100% in the credit score zip code at 745, and you have a high school graduation rate that's anemic in the inner city zip code. Now, here's the jaw dropper. Go to life expectancy. And this is particularly prescient to Jim, because Jim worked on Social Security, and you know, you get Social Security at a certain age. You paid into it your whole life. Imagine you paid into this your whole life, and you die before you get one benefit. But the larger issue here is if you are living in one of these impacted zip codes, you're living to about between 61 and 67 years of age. But if you're living literally 15 minutes away, you're living to 81. 20 years difference. And this data is basically identical across the country. So let me get into some more of this, because I really think we've found another way to measure corner by corner progress or regress in this community, in this country. We've been talking about things like crime. Help me out here. What are some other things that we talk about which I think are symptomatic of our problems? Crime, politics. Remember I'm from the black church. Violence, health issues, race, food insecurity, so food deserts. Somebody said something else? Range anxiety, that was just a joke. Yeah, I had range anxiety on my way here. But the easy ones are things like violent crimes, which is really the tail wagging the dog. The issues of food deserts. I mean, does somebody really not want to feed someone? I mean, so clearly that's not, no one's sitting back and going, ooh, let me restrict the availability of food in this neighborhood. What happens is that developers look at things like credit scores to give an indication of economic viability. And if you have a 750 credit score, you might put a Whole Foods there. If you have a 500 credit score, you might end up with, let me help you out here. Here's what you see, by the way, just to reduce this, remove politics, remove race, remove all these other issues. I want you to challenge me now if you disagree with this. I'm going to say something bold. Whether you're white, struggling, poor, rural, which is most of America, or whether you're black and brown urban, here's what you see. Correct me if I'm wrong. A check casher next to a payday loan lender, next to a dollar store. I don't mind them, but it is a good indication. Rent-to-own store, a title lending store, meaning the title of your automobile, a liquor store, if I didn't say that. You tracking with me so far? Yeah. A pawn shop, and a church down the street, trying to make you feel a little bit better once a week. I call that your community therapist. I'm joking, but I'm serious. Like if you're black, you go to church once a week to hoop and holler and get it all out of your system so you don't go cray-cray. And while blacks and whites, we worship differently, we're still going to church as a way of trying to find a way out of no way because essentially we're depressed. I'm talking about poor white. There's more poor whites in America than poor anybody else, by the way. I don't know if you knew that. By the way, number one group dying in America, random fact, number one group dying in America, high school educated white men on opioid addiction, which is depression. So the average credit score for a neighborhood like this is 750 and above. The average credit score for African Americans, hold on now, 620. Not poor African Americans. Everybody. PhDs, advanced degrees, great jobs, responsible citizens, paying their taxes. And I'm going to give you a reason for why it is in a moment, but if the average credit score for 40 million African Americans as just one group, you have a Latino group, which is a slightly better number than that. Native American Indians are worse than that, but just to give the stark parallels here, if 40 million African Americans have an average credit score below 620, take race out of it for a minute, which is real, take socioeconomic issues, take politics out of it, take all that proximity to jobs, that means that half of African Americans are locked out of the free enterprise system when you wake up in the morning. Are you tracking with me? You can't get a decent mortgage below 680. You can't get a decent car loan below 620. I mean, you can get a Mercedes at 580, but it's not Mercedes, it's Mercedes payments. I'm giving you guys some good stuff. What is wrong with you people? It is okay to be intellectual and laugh at the same time. Are you actually enjoying yourself, or is this Chinese water torture? I mean, come on now. I mean, relax.
So John, with these credit scores, as you pointed out, people can't get on the ladder to the American dream.
Oh,
and you know, home ownership is part of that. It's personal savings, secure retirement. Their kids doing better than they have, and I know it is a tremendous problem that you have been working on for years. And could you give me some idea of what Operation Hope is doing to help in this situation? And all the activities of Hope Inside and other things like that.
Yes, I will, but let me back up 1 second
sorry.
and give one last statistic. You can't get us, I was on the SBA administrator, Guzman, last night. We're having an initiative together across the country to create 1 million new black businesses. But you can't get a small business loan in this country below 700 credit score because it's considered risky credit. So no matter how good your idea, no matter how brilliant you are, and by the way, most people of color don't have relationship capital, which is how most things get done. I mean, no one goes to Harvard just because it's a fantastic school. Am I talking to myself? I mean, real talk, you go to Harvard in large part because it's a club. And the class of 2022 or 2021 will hook each other up for the next 30 years. You know each other, you have a relationship with each other. That's country clubs, it's this group, it's relationship capital. And if you hang around 9 broke people, you'll be the 10th. What is wrong with, I mean, I'm just dropping it, So, oh, no, that's too much, relax. So the reason, and I'm gonna get to the solution you asked me for here in a second, Jim, but let me give a little bit of contextual history. There are 3 groups there are almost 200 ethnic groups in America. This is the most diverse country in the world, inclusive. And by the way, China did a incredible job of bringing 600 million people out of poverty by focusing on economics and the sciences and technology, but mostly economics. There's some other things that the government has done that I criticize, but this piece they got completely right. coming back to the issue of these three groups of 200, poor whites, African Americans, so not Afro-Brazilians, not Afro-Caribbeans, not Afro-Ghanaians, African Americans, the descendants of African American, or the descendants of slavery in this country, enslaved people of color, and Native American Indians are the three groups that never got the memo on capitalism, free enterprise, economics, and ownership. No one taught them how money works. You with me? So it's what you don't know that you don't know that's killing you, but you think you know. And you confuse making money with building wealth. And you build wealth in your sleep. Everybody in here knows you build wealth in your sleep. But everybody where I grew up was obsessed with, and is still obsessed with, making money. Or as we say in our neighborhood, getting paid, getting that dollar, getting that moolah, getting that cash. It's an obsession. But you make money during the day, and it leaves you just as soon as you get it. If you're not building wealth, it is a flow outwards. And on top of that, they have bad debt that they're assuming, Jim, not good debt. So good debt is when you have something that may appreciate. A mortgage on a home. 41% of African Americans own a home, as an example. 41%. And that's the number one way you build wealth in this country. Compared to 73, 74% of our white mainstream counterparts who own a home. So the Freedmen's Bank in 1865 was chartered by Abraham Lincoln after the Civil War to teach freed slaves about money. Unfortunately, he was killed the next month. That was March of 1865. He was killed in April of 1865. And this bank fell into disrepair. And no one ever taught African Americans the language of money, which is one of the reasons I'm so obsessed with financial literacy today. I actually believe this is the civil rights issue of this generation. And I'm not talking about now black people. I'm talking about, with all due respect, your children who say, I can't be broke because daddy still has checks left, or mommy.
I laughed.
Thank you, Jim. No, they shouldn't be laughing. They should be crying.
Okay.
Because everybody today is basically financially illiterate, including Congress. And I'm not picking, the Senate. No one is teaching us the language of money. So one of the things that we're doing in this area of St. Louis, do we have the next
the third
slide?
slide.
Let's go to let's go to the second slide, Jim.
Okay.
I want them to see the infrastructure difference.
Can we do the next slide, please? There, whoops, go back.
Go back one.
There you
Keep
go.
in mind, this is 10 minutes from each other. You swear this is a third world country and a developed country. By the way, the home in 63106 is actually larger. I found this fascinating. It's got more square footage and more bedrooms, all right? But look at the valuation difference. So here's an interesting fact. Am I boring you, by the way? Okay. In the early 20th century, banks have been painted with this brush that banks are racist, discriminatory. Actually, it was not true. It was the government. FHA in the early 20th century refused to provide insurance, mortgage insurance, on homes in black neighborhoods. So where do you think the bankers went to finance homes? These are not trick questions. In white neighborhoods. What value then? So if you're going to finance, if you're going to insure homes, if the government's going to insure homes in white neighborhoods, banks are going to finance homes in white neighborhoods, where are you going to get the value appreciation? These are not trick questions. White neighborhoods. If you can't get finance and you can't get insurance, where is the area that's going to have depressed values? 63106 as an example, which is 10 minutes away. By the way, I don't have to show you this sort of dilapidated thing. I can take you to Atlanta, Georgia, where I have a home in the Cascade area. I don't know if anybody here knows Atlanta, but there's an area called Cascade. You know Atlanta. It's a beautiful area. The home is 8,500 square feet. It's gorgeous behind a gated community. That home in Buckhead would be $3.5 million. It's $800,000 because it's in a black, upscale professional neighborhood. So this still proliferates today. It has nothing to do, I'm talking about a really beautiful home. If I took a photo of it, you'd swear it was Buckhead. So this has, like a flywheel, continue today. Let's go to the next slide. Here's where the magic happens. And this is what Jim wanted me to get to. So my team, I have 200 offices now in 46 states. I'm the largest financial inclusion organization in America. We in this area here raise credit scores. So this person started on an average of 584. We raised credit scores 56 points in 6 months. We reduced client debt for somebody making $40,000, $1,229. We increased their savings to $2,275. This absolutely changes your life. Here's another one. We're moving credit scores 120 points in 24 months. Nothing changes your life more than God or love than moving your credit score 120 points. Hallelujah. Okay, we got some gospel in here. Do you know there's never been a riot in a 700 credit score neighborhood in all of America's history? Of any race, ever. Because 700 credit score neighborhoods don't riot, they go shopping. Only 500 credit, this is a statistic. Everything I'm telling you, please challenge me. These are statistical, mathematical facts with a measure of error of less than 2%. All riots in America are in 500 credit score neighborhoods. All of them. So if you want to stabilize these communities, it's really, by the way, not about the credit score, Jim. The credit score is a trending indicator, a halo effect for hope, well-being, financial literacy, belief, confidence, joy, trust. Why is there a check casher across the street from a bank branch in a black neighborhood? If poverty was rational, poor people wouldn't be poor. Why would you have how does a check casher survive across the street from a bank branch? Because in this example, blacks don't trust banks. And there are reasons for this. I'm giving you sort of a treetop history here, but if you go back and go back to 150 years of American history, anybody in here, if you had the same history of the group I'm talking about, you wouldn't trust them either. So what we are doing is basically taking a group of American untapped human capital. I believe now the color is green. It's no longer black or white or red or blue. It's green. Citigroup report during the pandemic, Jim, showed that discrimination against blacks in the last 20 years alone, so not 100 years, this country is 2/3, if you go to the history of this country, it's 2/3 enslaved, 1/3 free from a time zone. I'm not going back to long history. I don't need to go back to 1800s or 70s. Since 2000, Citigroup report showed that discrimination against blacks alone cost the U.S. economy $16 trillion of GDP. Trillion. And if we knocked it off today, you pick up $1 trillion a year. That's why I believe this is solvable. Because there's actually not today enough college-educated white men to drive GDP growth. This is the first time in history that we actually need each. That happened once in the early 20th century when Henry Ford and all these folks, the immigrants came up. Goldman Sachs was a guy named Goldman. And a guy named Sachs, immigrants came selling financial services door to door. This is a true story. Could not get a job in the skyscrapers. So they created their own little company. There was a surge of immigrant entrepreneurs in the early 20th century that created the big companies that we see today. Those were mostly from Europe. Today you have a different but the same situation where you have growth at the bottom of the economic pyramid. I believe there's 2 to 3% of untapped GDP growth sustained at 50% below 50% of the income level line and below. I could bear you in more statistics, but I think if we made the case, a case you understand for why underserved communities are underserved, or do we need to hammer this some more? Okay.
So you can take the slide down now. See your picture. They want to see your picture.
No, they don't. I guarantee you they don't.
So you've been called the conscience of capitalism, which was quite a phrase. And not only are you doing it at the grassroots level, working with the Hope Inside, where you just talked about raising those credit scores, but you're also trying to work at some of the higher levels. And could you talk a little bit about how you've been working with the capitalists, basically, the Financial Literacy for All group?
Sure. I'd like to start, though. I mentioned Aries earlier, and somebody might wonder why I mentioned them. Michael Arrighetti and Tony Ressler, who's the chairman, and the CEO and the chairman, respectively, of the parent company for Aries, invested in me personally in 2017. I was trying to prove, so Operation Hope is 4 million clients. We've invested $4 billion of private capital in the model I just mentioned to you over 30 years. Those loans are performing. Small business owners, entrepreneurs. The guy who made the suit that I'm wearing and the shirt is one of our success stories. We gave him a $30,000 loan, raised his credit score. He's doing $1.5 million a year in annual revenue for the last 10 years. That's a hand-up philosophy, not a hand-out philosophy. It's scalable because, by the way, 98% of all businesses in this country have 100 employees or less. That's what's actually driving the economy is small business, like the gentleman that we put in business, the suit that I'm wearing. So Tony Ressler and Michael, I was trying to prove that this model we did in financial literacy, somebody couldn't write me off as a do-gooder. I wanted to prove that this worked in hardcore capitalism. So I started a company in 2017 called the Promise Homes Company, which was dedicated to a social justice business model. We did financial literacy for every resident for free. If you raise your credit score as a resident, we did Operation Hope, did the coaching, we paid Operation Hope to do it. If you raise your credit score to 700, we reduced your rent by 10% permanently. Because if your credit score is 550, 610, I'm chasing you for rent. You follow me? Mm-hmm. But if your credit score is 700, you pay like a coupon. So I'm putting less energy into you. I should give you a break. It's not charity. It's not. I think you think the math just works. We also decided to reinvest in minority vendors in the neighborhoods that we invested in. So today, 55% of all our contracts at the Promise Homes Company for plumbing, heating, electrical, landscaping, roofing, painting jobs, et cetera, go to minority and women-owned vendors in the neighborhoods where we own the homes. And we just issued a report that accounted for just under $4 million in contracts in the last 2 years alone. So we don't need the police because our community polices our assets for us, and then we give folks a chance to go from rent to own. I just took that company from zero to $170 million in asset value, did a recap in December, paid off Michael, Tony, and all the banks, 100% of their money plus interest.
Wow. And
now we are growing that company. I believe we'll be at $1 billion in assets before the first quarter of 2023 with a mid to high teen return in all the stuff I just mentioned to you. So you can do well and do good at the same time. The Financial Literacy for All group is co-chaired by me and the CEO of Walmart, Doug McMillon, the #1 Fortune 500 company in America, because he believes that I do that 40 years ago, healthcare was the issue that dominated all of our interests. And 50 years ago, if you said the company should provide healthcare, people would laugh at you as CEOs. Mm-hmm. Today, it's an assumed that employees receive healthcare. We believe financial literacy and wellness coaching is the next new norm. 95% of all employees are stressed out about money on the job, and I think it's hammering away at morale. It's creating churn. It's creating waste, theft. It's creating It's creating a lack of excellence in performance. So we are now the financial coach for Delta Airlines for their employees, for UPS for their employees, KKR, several divisions of KKR, and about 40 banks. And Truist actually has Hope in half of all their bank branches now. Wow. Because we're basically creating customers, getting the bank out of the no business. I'm sorry, your credit score is too low. Your debt's too high. You don't have enough savings. Mm-hmm. And because we know the criteria, we get the person rehabilitated, get them to a point where the bank can say yes. So now we're actually creating new customers on a sustainable basis. I call it emerging markets. Wells Fargo just ordered 123 locations. That's not charity. B of A just ordered 15 locations. That's not charity. First Tennessee Bank has 40 locations in the state of Tennessee alone. That's not charity. I can go, Regions Bank ordered 100 locations. So Financial Literacy for All is designed to embed financial literacy into the business plans of the biggest companies in America. Our goal is 80% of the Fortune 500. Right now we have the CEO of Disney, Delta, PayPal, Nike, Bank of America, Wells Fargo, Blackstone, I believe, and BlackRock, I believe, Hershey's, Nestle. I mean, you can go on the website for Financial Literacy for All, but it is literally like the top 60 of the top 200 Fortune 500 companies at the CEO level, and that's within the last year. So we believe we have enough momentum now to get 80% of the Fortune 500 in the next 18 months. And then we use that as a catalyst to embed that within the workplace and then pivot that into legislation and go back to your friends in Washington and get this embedded so that every kid gets financial literacy in school, K through high school, as a norm.
That would be great. And I know it's been a long struggle, and unfortunately, Department of Education and other people have just not pushed this issue as strong as we'd like, especially for in the schools and even in colleges these days. And there's a lot of people graduating from college that are financially illiterate, unfortunately, and that is a growing problem. So, as you look at these numbers, I think they were startling to me. And certainly the age differential, the home ownership differential was incredible.
Which is an opportunity for banks, by the way, for financiers.
Yeah, and that really is the way to get on, as you mentioned, into the American dream, build net worth. It's hard to build net worth if you have a $90,000 house that's not appreciating.
With no financing.
And unfortunately, in a crisis, those are the ones that tend to have a problem too. So, one of the things that I think is critically important going forward is what you call the civil rights of this generation. And you went through, there was 3 sets of civil rights, if you will.
Yeah. So this country, I'm just president, I'm conscious, I'm not sure we're doing Q&A, but I'm conscious on time. I want to make sure that I don't overstay my welcome or bore you. But this country has gone through, Jim, 2 reconstructions, and I believe we're in our 3rd. The first reconstruction was after the Civil War, and that was freedom. And by the way, an interesting factoid, the word white is a made-up word. There were black members of the royal family in Europe going back centuries. Or more than a century, well, in the 1400s, 1200s. There were people of all races and colors, because it was about power, money, and position in the world. The word white was made up in the United States of America in 1619. You guys want to hear this story? It's fascinating. All of our problems are really silly today. The word, so in 1619, let me answer Jim's question and then come back to this. So first Reconstruction was freedom. Second one was civil rights movement, 1960s. That's access, which included women, by the way, after that. And then the third Reconstruction today, between now and 2020 and 2030, is opportunity. That's what we're talking about now, economic opportunity for all. There's never been a world-leading country. There's never been a superpower in the world that wasn't an economic power, ever. There's never been a superpower that wasn't an economic power. And the minute that Britain lost its economic power, everything else was left. I mean, you can go Britain, it was France, it was Germany, it was Argentina. I don't know if you know that in the early 1900s was the biggest economy in the world. So America has to maintain its economic dominance in the world in order to also be the superpower in the world. And I believe the world needs us at the tip of that spear. It's a whole nother conversation. But we cannot do it unless we are mining all people into this new area of opportunity. So now go back to 1619. This is a fascinating, interesting story. In Jamestown, Virginia, there were 20 indentured servants. 16 were black and 4 were white. Came from Britain. The 4 came from Britain trying to pay themselves off of their voyage. The blacks and whites got along with each other, became friends, ran away from each other. Ran away with each other because they didn't like the overseer, the plantation owner, and how they were being treated. They ran away and they were caught. And the overseers said to their peer group, Jim, we have a problem. They're getting along. They're friends. Listen now. They said, we can have a race riot. We cannot have a class riot. So they told the four poor whites, you ran away, you must pay for this. You have 2 more years of indentured servitude. They then turned to the blacks and said, you're now indentured servants for life. And then turned to the whites and said, now you're in charge of the blacks. By the way, you're white like us. But because the poor whites did not have education, did not have exposure, did not have understanding of how the economy works, they just said yes. But what they should have said is, but I'm sorry, I'm not rich like you. I don't own property like you. I don't have titles like you. I don't have estates like you. They didn't ask the right questions. They just moved on with this ridiculous narrative. That's where all of the silliness that we're now dealing with today came from. Did you follow that? So these are economic issues that we've morphed into other kinds of issues. By the way, the wealthiest asset in 1840 were black slaves, worth double what railroads were worth in 1840. So these are economic issues, and we've used bad economics. I mentioned earlier that if you have an appreciation of a home, a mortgage on a home, that's good debt. You have a loan for a business, hopefully, that's good debt. But if you're financing jewelry, I know that sounds silly, but that happens a lot in these neighborhoods, that's bad debt, things that depreciate. Do you know that people go finance sports tickets? Do you know people are financing 1 Hertz car rental? My man is looking at me like I've just gone to Mars and back. No, this is literally true. I mean, I don't want to name the companies, but you could probably think about who's doing this pay-to-finance business. They're financing vacations, 1 vacation. Everything is now what's the payment, because people are financially illiterate. And so this started as a black issue and then became a poor white issue. I would argue now it's a middle class issue. 1/3 of anybody in today who makes $250,000 a year are living from paycheck to paycheck. 1/3. So we have got to get this under wraps. We got to get our hands around it. Would you mind if I tell my personal story for 2 minutes?
That's what I was about ready to get into.
No, I mean.
No, I think it's great because how you got into this is extremely important.
We wanted to start off with the data and the facts because that's what we thought would hit you where it matters most, which is your business mind. So hopefully we gotten your attention on that. But let me give you the texture of where I think all this comes from for me and why I think this is scalable. I'm gonna give you the short version. We only have a very short period of time. And I don't want to abuse it. Short version, crib notes. My mom and dad, so my dad was a businessman. My father, born in 1871 in Mississippi, was probably a slave, born in 1871, but he was a farmer, sharecropper. He owned a farm worth $700 by 1921. My dad became a businessman. I became an entrepreneur. My mother's mother had a shotgun shack. That means you could take a shotgun, shoot it through the front door, go through the back, never hit anybody. That's what most people lived in the South. My great-grandmother was a slave. So that's the trajectory of our life. My grandmother owned 1 home. My mother owned 7. I owned 700. The trajectory of role modeling. My mom and dad, with a high school education, go into South Central LA. They buy a home, an 8-unit apartment building for $18,000 in South Central LA. They own a nursery business, a cement contracting business. We own a gas station in Vernon, in Normandy. Everybody knows LA. So they became little capitalists. It was a very proud moment. They're building generational wealth. That apartment building, Jim, that we bought for $18,000, payment $237 a month. You could make the mortgage on 2 rents. We lived in the 3rd unit. The rest of the units were producing profit. Unfortunately, my dad could make it but couldn't keep it. He was financially illiterate. We lost that apartment building, which is now worth $6 million today. We bought it for $18,000 because my dad confused making money with building wealth. And he wouldn't listen to my mother, who was a financial genius, and so they got a divorce over money. Number 1 cause of divorce is money. Mom moves with a girlfriend to try to save money to buy her home. Again, long story short, guy saved my life. When I was staying with him, I was swallowing my tongue because I'd fallen backwards. I sat on the porch watching that guy who was trying to make some extra money to keep us in the house. Unfortunately, he sold drugs around the corner. The drug dealers followed him around the corner and killed him in front of me. I'm 7 years old. He was on a bicycle. He was run down with a guy in a truck. I can visualize it now. That was about money. We buy our first home at 15502 South Fraley in Compton, California, single parent. We buy that house. My next door neighbor is Tweet, local drug dealer. And my best friend was George, who was smarter than me, better grades, but he didn't have a mother who told him that he was loved like my mother told me that I was loved. Nothing more powerful than a child being told that they are loved. There's a difference between being broke and being poor. Being broke is economic, but being poor is a disabling frame of mind, a depressed condition of your spirit, and you must vow never, ever, ever to be poor again. My mother told me she loved me every day of my life, so I had self-esteem. And George got murdered with my next door neighbor over drugs when I'm 9. So now that's the third example I have about money. So now I'm focused on a way out of this. I'm looking for the business plan, Jim. Go to school, banker goes, teaches a class at Bank of America called Home Economics. Doesn't exist anymore, unfortunately, in most neighborhoods. Second session, white banker, red tie, white shirt, blue suit, car with a license plate and tags in the parking lot. Okay, you didn't get that. That's called a legal car. He had a business card. He worked on the 16th floor. The only office building in Compton was a courthouse. Everything else was a one-story tilt-up. I couldn't relate to this guy at all. My mother worked an hourly job with 2 15-minute breaks. So he's in the middle of the day. He's got a salary. Excuse me, sir. What do you do for a living, and how did you get rich legally? And I was dead serious because that was not my experience. He said, young man, I'm a banker and I finance entrepreneurs. I'm now 9 years old. I had never heard the word entrepreneur in my entire life. French word, build something out of nothing. I said, sir, I don't know what an entrepreneur is, but if it's legal and you're financing it, I'm going to be one. So I left there, and make a long story short, there was a guy selling candy down the street at a liquor store. I went there, tried to tell him he was selling the wrong kind of candy. He told me he had a college degree. I told him I had cavities. He wouldn't listen to me, so I asked him to hire me as a box boy. I worked for 3 weeks, learned where he got his inventory, quit. By the way, if Aries is in the room, Aries ended up buying Smart and Final, which is the company that sold me my candy. So they sold me some inventory. I on a $40 loan for my mother because she said she had to pay the money back. I made $300 a week, found girls, lost the business till I married my wife. But I made $300 a week, put the liquor store out of the candy business.
Wow.
The light came on in my head, self-esteem came, confidence came, role models came, new focus came on capitalism and free enterprise, and I literally was not stoppable from that moment forward. I was homeless for 6 months of my life when I was 18, but that's because I just ran out of money, not because I had the wrong business plan. But at that point, I could never give up, and now we know the story of where I'm sitting here today. I believe I'm completely scalable. Bless you. I believe my story is America's story. There's nothing a miracle about what I just told you. It's just that the story that I was given of the language of money was a story that Lincoln was trying to do in 1865 with the Freedmen's Bank. And I believe a lot of our political frustrations today with a large group of poor whites, as an example, comes from their economic desperation of feeling they're being left behind in this country. And so now everybody's got a grievance. Most of it is a lack of opportunity for all. And I think financial literacy for all as a gateway, as a starting point, could be a place where all of us join hands and basically acknowledge that we are all in this thing together, and we actually need each other. And we can take no pleasure from the fact there's a hole in my end of our boat. Because if the boat sinks and we're both in it, we're both going down. We need to have a business plan for the future, and not one based on fear and finger pointing and name calling and rock throwing. We need a business plan based on green. And that is why I came here today. Thank you.
Thank you. Thank you. That's an incredibly powerful message. Operation Hope has a website if you want to visit it, and I think there's a lot of statistics there that the world needs to know.
And I want to, again, thank Jim for all of his leadership. I encourage you to do some research on him. He's an extraordinary human being, very humble.
Well.
Every zip code in America is on that website. So you can literally go to, well, just type in Hope Credit Score Index, or just go to operationhope.org, put in your zip code or your city, and you will find incredible revelations about how this country works. And thank you very much for having me.
Thank you.
Thank you, Jim.
Okay, now we have another one-on-one conversation coming up. Greg Lippman, who many of you may know was renowned for having been one of the early people in finance shorting the subprime market, advising his clients to do that. He's going to be in conversation moderated by Russell Sherman, who is my esteemed colleague at Prosec Partners. Welcome to the stage.
Thanks everyone for joining us. Greg, thank you for taking the time. Katie mentioned a little bit, but Greg has founded a firm in 2010 called LiberMax, $8.6 billion in assets under management, specializing in structured credit products and specialty finance, and they invest across residential and commercial assets, ABS and CLOs in both public and private markets. Obviously, Greg is best known for his time at Deutsche Bank and predicting what would happen in the housing market. Was a key subject in Michael Lewis's book, The Big Short, and obviously in the movie by the same name, and he was played by Ryan Gosling. Not too shabby, right? If you got to be played by somebody, that's pretty good. Greg, you graduated Penn in '91, unsure what you wanted to do. Started reading some books, read Liar's Poker by Michael Lewis, thought this could be an interesting profession. One of the key reasons you got interested in Wall Street. Fast forward 17, 18 years, and Michael Lewis is knocking on your door. He wants to write another book. That had to be somewhat surreal.
Yeah, surreal's a word. I mean, it's absolutely, my father was a small-time real estate person, and I thought I would go into real estate also. And '91 was a tough time for real estate coming out of the S&L crisis. There weren't a lot of jobs. And my senior year in college, I read this book, Liar's Poker, and I thought, this sounds amazing. And if you've read the book, it's very entertaining. And said, this sounds amazing. I'd love to do this. So, I eventually got a job. It wasn't that easy, but I got a job on Wall Street. And, fast forward, like you said, and then, Mr. Lewis called me up and he said, I'm writing this book. And I've talked to like 30 people about this whole subprime thing, and like 27 of them talked about you. So you're in the book whether you like it or not, and you could talk to me or not, but right now I have the perspective of 27 other people about you, and I'd love to have the perspective about you, and so I spent some time with him, and yeah, he's a great guy, and he's a good storyteller, and he's good at getting people to tell him their story. So we had a lot of sushi dinners, and he did very little talking. Did a lot of talking. So.
Sign of a good journalist, I guess, right? He let you do most of the talking. When the book came out, what was your reaction? Happy with how you were portrayed? Happy with how the story was told? What's the initial, because there's a lot of uncertainty in terms of when that actually comes out, then you read it and you see it. What were some of your reactions?
Well, I guess, it's not great if you want to be a private person to not be a private person anymore. So I didn't love that about it. I felt that it was a dramatization as opposed to a gross mischaracterization of the person that I am. So I think that he, amplified some of my personality traits and whatnot for the sake of entertainment, but he didn't it wasn't completely wrong, the person that I was at the time. So, I would say my wife, and I looked at it and I said, he doesn't make me seem, I definitely don't seem stupid in the book, and I don't seem dishonest. I might seem, a little, different than most people or what have you, but not really, a jerk or anything. And my wife was very upset about it, and I said, well, I'm not a jerk and I'm not dumb in it, so we can. What do you want to do about it? She was miserable about it, and I sort of said to her, there's a couple ways we could play this theoretically, and I'm going to tell you which ones are not okay with me, and then you could pick the rest. I said we could, we could move to Vermont and change our name and hope that nobody knows who we are. We could get divorced, and you could disavow any knowledge or me or whatever. Notwithstanding this event, I could go on TV all the time and try to be famous. We could grin and bear it, or we could be what you've currently chosen, which is be miserable the whole time about it. And I said, I'm going to eliminate miserable and TV. You pick, grin and bear it, divorce, or Vermont. So she picked, fortunately for me, we'll be married 20 years in 2 months. She picked, grin and bear it, much to her chagrin. She wishes it didn't happen. So look, I'd say, what's awkward or what I don't like about it is I have 4 children, and I meet the parent of one of my children's friends, and they have a preconceived opinion about me, and I don't know anything about them, and so I don't love that. It is kind of fun sometimes being in the airport and I'm checking in, and the person next to me says, "Oh, you the Greg Lippman from The Big Short," and just to get back to the Michael Lewis thing to finish, he wrote, if you read the as I did, the forward of The Big Short, he said, I wrote Liar's Poker to dissuade people from a career in finance, and lots of people chose one of whom was me. And I'm hopeful that The Big Short will, really this time work and dissuade people. And obviously when the book came out and when the movie came out in particular, I got tons of emails from allegedly, college or high school people, who knows, an email person could be anybody. Oh, I want to be you when I grow up. Can I have coffee with you or talk to you on the phone and figure out how to be you? And less so now, but even still, every month or two I'll get one. And so the most interesting of those I forward to Michael Lewis, and I say, you did it again. You wrote a book with a goal to make people not want to work on Wall Street, and you actually made a lot of people work on Wall Street. So, it is what it is.
Your wife had to be a little happier when she realized she was married to Ryan Gosling.
Actually, she said, don't tell anyone that it's an accurate portrayal of you, because he's way cooler than you. And the truth is that when I met Mr. Gosling, we had spoken on the phone a couple times, and that was like a bilateral conversation. And when we met in person, it was just like a laser beam personality suck. He was really locked in on everything I said and all gestures I made. So notwithstanding what my wife said, he was trying to imitate me.
Yeah, interesting. So that was the research. You saw him doing that research on you.
Yeah, I mean, he said, oh, can we meet at midnight at this bar in the East Village? And my wife was like, no way. We're not meeting at midnight at a bar in East Village. So I said, I can't do that. He said, okay, how about 2 p.m. the next day? I said, okay, fine. My wife said fine.
So let's go to the trade and to the activity in 2003, 4, 5, 6 time frame. Talk to us about the first, because everyone here wants to. We're going to go back and then we'll talk a little bit about what you're seeing now. But back then, talk to us about the first cracks that you saw. Maybe it was a statistic. Maybe it was some of the research you had done. Obviously, you were tipped off or introduced to the concept that there was an issue in the housing market. But you did your own research and really went deep into it. Talk to us about those statistics or those first things that you saw that you really were able to see, hey, wait a minute, something might be amiss here.
Sure. It was more first the sort of, the convexity of the trade than the likelihood of it. So I've been involved in mortgage-backed securities since 1991, and while some people call mortgages, a trade, and not an asset class, for me it's been a life of 30 years, and it's all our fund does is structured products. We're specialists. We're not a multi-strat fund that does a little bit of structured products. We just do structured products. But anyway, so I started in 91. I started trading in 94. And they started to create these derivatives in sort of 2004, 2005. So before there were derivatives, you couldn't short them, which basically meant you just had to decide whether you loved them or you liked them. You couldn't dislike them because there was no way to express that view, so it wasn't really worth even thinking about that view because you couldn't do it. So when the derivatives came out in 04, 05, I said, I consider myself an intellectual. Now that you could bet on no, maybe I'd want to bet on no. I'm not sure, but maybe. So I worked with a colleague who was sort of like the number cruncher person. I was the idea person, and I said, tell me in America, let's break America out into quartile and see how these loans actually perform. And what I found, which was really shocking, was that the 25% of America by loan count, in terms of the number of loans, that had the highest home price appreciation, which was places like California and Florida, they had generally larger loan balances. So they were 25% of the number of loans, but they were 62% of the balance of the loans. And housing was going up 12 to 14% a year. And still, of the subprime mortgages, 6% of the people were defaulting. And so this is crazy. Like someone has bought something and it's compounding at a gigantic rate, certainly on a levered basis, and they still are losing the home even though they paid 100 and it's worth 180, which was incredible. But if you looked at the 25% of America that had the lowest home price appreciation, that was still going up 4% a year. And in those places, not 6% of the people were defaulting like in the highest places, but 28% of the people were defaulting. So I said, first of all, housing prices can't go up 12% a year forever in California. Eventually it has to stop. And the way that these bonds worked was, the loans were they were called teaser loans. There were 2 years, loans were very low interest rate, and then the loans went way up. And you would ask the Countrywide and other banks, how are the people ever going to pay the high rate? They can pay the low rate, barely. They can't really pay the high rate. I said, well, we'll always make them a new loan. So what if you can't make them a new loan? Well, we'll always make them a new loan. Rates will never go up, which is a problem today, and B, home prices will never go down. So it'll always be easy to make them a new loan. So what this told me was that in 2 years, the loans they would be D-Day for the loans. Either the loans would be new loans, or the loans would go into default. So when you looked at the structure of these bonds, the triple B slice, basically, if the losses were 8%, it got back 100. If the losses were 9%, it got back 0. So if you assume that you had about a 50% recovery on properties net of expenses, which is about what it was, if 16% of loans defaulted, the bonds were worth 100. And if 18% of loans defaulted, the bonds were worth 0. Now remember, in the lowest quartile in America, 28% of the people were defaulting even when homes were going up 4% a year. So you look at that and you say, well, I can really only lose 4, maybe 6 or 8. I can't lose more than that. It's like not possible because the loans will be made into new loans. And if home prices go up 4% a year, the bonds are worth 0, right? So you're going to lose somewhere between 4 and 8 until home prices go up 4% a year, and then you're going to make 100. So it was just a question of when, right? So when I first did it, I sort of said to the bank, this is maybe a 3-4 to 1 long shot. It's going to pay, 8 to 1, and we've got this giant business here that makes a lot of money and billions of dollars, and my little business makes 200 million. And so if I sort of bet against 1 billion of these, we'd lose 20 million bucks if I was wrong a year, and if I was right, we'd make 500. And I have a business that makes 200 million, so I'm going to turn a $200 million business into a $180 million business if I'm wrong, and into $1 billion business if I'm right. And it seemed to me that someday home prices, I didn't know. So my point is, it wasn't like homes are about to go down. Let's put the short on. It was we put the short on in late 05. Homes didn't start to go down until like 07. So the view was just, this is such an amazing payout. We can afford to be wrong for a while. And I would say, and I try to live my life like this, if all you do is bet on, I said to people, it's not worse than 3 to 1 against me that's going to happen. And if you spend your whole life only making bets that are 3 to 1 against you but pay 9 to 1, usually you walk away from the game without the money you put in. But when you look in your pocket, it's really full, right? Because you make $9 1 out of every 3 times, and you lose $1 the other 2 times, right? And that's a great game to play. The other guy feels happy because 2 out of 3 times they win. But when you win way more than you lose, right? So we put it on not knowing when, but having a lot of confidence. It was just a matter of when, not a matter of if.
But how hard was it to maintain that conviction? And also, you guys were selling the product to other people, right? And there was pressure from them as well. How hard was it to maintain the conviction? You put the trade on and it's a year before it actually, you start to say that this is actually going to be right. Is that a lonely time on the trading floor?
Well, Chicken Little, Bubble Boy were names thrown at me, among other things. So, look, people like betting on yes, And there's a phrase in bond world called positive carry, which is that you buy things and they earn interest, right? So you're making a little bit of money every day. And the opposite of positive carry is obviously negative carry, right? Which is that you lose a little bit of money every day. So my position was a negative carry position, right? Was we lost money every day in the theory that someday we would make a giant amount of money versus somebody who makes a little bit of money every day but someday might lose a giant amount of money, right? So I thought we were in a good place, particularly considering how much the rest of the bank was betting on the opposite, right? But maybe 6 months in, there was a lot of pressure of like, well, how much have you lost, and what's the exit strategy? And so, well, the exit strategy is like, I think things are going, like, it was a 3-to-1 long shot that paid 8-to-1. Now it's like a 2.5-to-1 long shot because there's a little bit of cracks that pays like 12-to-1 because the price has gone against me, And so they said, well, so says you. So figure out, find somebody else who believes this besides you. So that's really what ultimately causes the book, The Big Short, to be written, which is that the pressure internally was find other people that believe this, right? So I wrote a book that had different slides in it, and that book was went to the world. And I started with the people in my own business, and they all, they didn't want to hear that because positive carry is a lot more fun than negative carry. So it became quickly clear that not that I was deceiving anyone, but I had spirited debates with people in the mortgage business, most of whom said, you're nuts. So I would go to the various departments of the bank and say, the high yield department, emerging markets, equities. If you have a client that has an open mind, I want to explain to the client why, as part of their big high yield portfolio that they're making 18% a year on, if they just spent like 2% on my thing, they're going to turn their 18 into 16 if I'm wrong. And if my thing blows up and it doesn't affect their thing, they're going to turn their 18 into 118. And if my thing blows up the world, it's going to turn their 18 into 12 instead of minus 40, which is what it would have been. And so I pitched it to about 250 hedge funds, and about 75 of them did it. And and as I did that, my own position grew because I got more confident in it, and eventually, my short was a lot bigger than the 1 billion.
As you look at the world today and see where we're going and do the evaluation that you did now, what are the markets that you look at and think that, where are you focused? Where's the next opportunity in terms of the landscape we're in today?
Look, I think there's a bunch of different ways to answer that. I mean, the opportunity, I think that actually structured products is a great place to be in right now. I think the opportunity for it is great. Our book yield, for example, in our master fund, January 1st was a 9% book yield with 5 to 10% of our portfolio investment grade. Today, the portfolio is 30% investment grade, and our book yield is close to 12.5%. So we able, and the fund is up. I don't want to get in trouble with the SEC, whatever. But the fund's up this year, even as things have gone down because of hedging. It's made money. So when I look out, I think there's a great opportunity, in securitized products because they trade at a higher yield than corporate bonds for complexity and liquidity. And they afford now enough yield to actually prudently invest in hedging in a way that, say, 2-3 years ago, there wasn't enough yield. So I'm really excited, and we could talk about, the relative, why I'm excited about structured products relative to corporates in a second. But to answer the other side of the question, I think, people always said to me, where's the next bubble? Or people say, you must know.
Us, right.
Or
no
tell
trip,
us, or
no,
the next
no
time. I know that like you came to my office back, and I'll see people like in a restaurant, because I don't remember them. I pitched 250 people. The 170 who said no, I remember maybe 5 of them. And the 75 who said yes, I probably remember 65 of them. But the people that met me that said no, they remember me, right? Because like I went in their office and I said, this is the greatest trade ever, and they said no, and then turned out it was. So when these people see me in a restaurant or whatever downtown, they say, well, next time you have a great idea, you let me know. I'll be the first one to tell you. So I think that if the question is where's the next bubble or whatever, I think that we've had low interest rates for a very long time, arguably really since 1982, but certainly since the last 5-10 years. And I think a lot of investments were made predicated on short rates not going above 2.5%. And the 10-year Treasury not going above 3.25%. And so the question would be, what of those investments are not viable at, high, if rates stay higher for longer, which of those investments? And then just at a very common sense level, you have for levered companies, interest rates are, if you borrow money floating, your floating rate is going up, and the Federal Reserve has said we want to slow the economy down, right? So like it's almost like, it could have had a V8 or whatever, right? It's like, okay, high yield company, their interest charge is going up and their revenue is going down, right? Because the government has said we want to slow the economy, right? And maybe that we're going to have a gentle slowing and a Goldilocks slowing. Maybe we're going to have a hard landing. But like, no one is saying that the economy's not going to slow, right? That's like for sure. So the revenue of the company is going down and the interest expense of the company is going up. Like, it just seems like kind of obvious that the high yield market or the private credit market or what have you is going to struggle.
You talk about 3 scenarios that you could see sort of playing out as it relates to interest rates in the economy. Take us through those.
Sure. I think the biggest question is how intractable is inflation, right? And where is inflation going? And one thing that's tricky for people that are cautious is as inflation moderates from 8.5 downward, the bulls who say, oh, it's going back to 2.5, and the bears who say it's going to stick at 4, which I would put myself in that category. When it goes from 8.5 to 6, they're both right? Because I say it's going to 4, and the other person says it's going to 2.5. And so it will be a tug of war, and you've seen this last Monday, Tuesday, the market went up a lot on like some marginally benign inflation data, right? There's going to be this tug of war over the next months and maybe even years of like, what's the path of inflation, right? So when I think about our portfolio, like I said, it's a 12+ yield. We have hedging on it. And if the bulls are right and we're going back to what some call the normalized environment of 09 to 21, which I actually think, notwithstanding it's the environment that many of us only know. Anyone who's 38 or younger only knows 09 to 21. I'm older than 38, unfortunately. So I know a little bit more than that. But for those people, that's normalized environment. If inflation's about to go down, that environment is coming back. And the S&P is going to go up 30% or more. And my 12% yielding portfolio will rally a lot. I'll lose money on my hedge, but we'll probably end up with a reasonable positive return, paltry compared to the S&P's 30%. Scenario 2 would be that we've had this sort of correction of the froth and we're going to kind of bounce around for a number of years. And Stanley Druckenmiller says 10 years from now the S&P will be where it is today with a lot of different trading opportunities between now and then. But if that's the case, my 12% yielding portfolio is going to yield 12%. My hedge is going to make or lose a little bit of money, and we're going to end up somewhere a little bit less plus 12% on a gross basis. And then scenario 3, which I think is also quite likely, is that we are in the very beginnings of a 2000 to 2002 type of scenario where the market decline that we've had so far is really more the beginning than the end. In that case, our 12% yielding portfolio is definitely going to get marked down, as it has gotten marked down this year. I think by less than corporate stuff, which we'll talk about in a second. But we hopefully, like we did in the first half of this year, the first 9 months of this year, make a lot of money on our hedging to sort of balance out. And this, like I said, we're up this year. So we've made more money on the hedge than we've lost. And what makes me really excited in general is I think that government policy is in the process of changing in a big way. And if you think really since 1987 when Alan Greenspan saved the stock market, and then I think in 04 or 08, the Committee to Save the World, there was like a big Time magazine picture, and really since 09, which has been lower interest rates, make the stock market go up. Hopefully it helps regular people. And there was a lot of banks got bailed out, we got sold out, right? And then the government said, listen, we understand that regular people are not doing great, but trust us, if we hadn't bailed out these banks and insurance companies, it would be much worse for you. And it's hard to know the counterfactual. And as long as interest rates, as long as inflation stayed low, you had a boom in financial markets and a meh in real markets. But people were doing okay. And now in an era where we have inflation, sort of say, well, these policies were amazing for the NASDAQ, and they were not, and they're actually bad for regular people because inflation is much worse for a regular person than ARK. I don't know if anybody here owns ARK, but then ARK going up, tripling or whatever. So I think, and they've broken the seal on this, which is that in 2020, they gave people cash, right? They never did that before. And they said, oh, we're going to have gasoline tax holiday. You don't have to pay your student loans. And it is my view that on a going forward basis, the policies enacted from the government, instead of lowering interest rates, which are definitely great for the NASDAQ and unclear how great they are for regular people, the new policies are going to be, spending more money from the government fiscal policy as opposed to monetary policy. And that's an environment where, if lower interest rates is great for the NASDAQ and it's unclear how it is for regular people, giving people cash or telling people they don't have to pay their gasoline tax or sales tax, that's great for regular people, unclear how good it is for the NASDAQ. So I think we're coming out of a period of time that was a great time for the stock market and into a period of time that's going to be, like again, 09 to 21, amazing time for the stock market, time for regular people. 2000 to 2002, horrible time for the stock market. The 2001 recession was very, very minor, on a relative basis. So I think that, we're going to be in a place where the real economy is going to do better than the financial economy, which is very different than the last 12 years.
Interesting. Greg Zuckerman is here, he reporter for the Wall Street Journal. He wrote a book called The Greatest Trade Ever, which you were also featured in. Around that same time, I said, Greg, what should I be asking Greg Lippman? He said, what's going to break in the bond or credit market as rates rise? Where's that crack coming as rates continue to rise?
Yeah, I mean, sort of mentioned a little bit before, and just to go back to the day, like Deutsche Bank would get calls like, we heard that Lippman's behind the collapse of the Malaysian ringgit, or we heard Lippman made tons of money on the merger between some Swedish and Norwegian, high yield company. I'm not Kaiser Soze, right? So I don't really know. I'm not behind everything, know everything. I did get one thing, kind of right. And I try to look at things with maybe like a more of an open mind in terms of yes or no than some people, which is maybe a strength. But listen, I sort of alluded to it before, which is that there's been a period of time where rates were very low for a very long period of time. There's been a tremendous amount of money that's gone into private credit, and the view about private credit was it doesn't get mark to market, so you don't have to worry about this pesky hedging thing that always loses money, or at least it did lose money for most of the last 12 years before this one. And so there was a giant amount of money went into private credit, and some of those businesses are viable only if rates stay very low. So you still have a lot, and it hasn't broken yet because rates have only been high for a few months, right? Mm-hmm. And there's a lot of people, and they may be right, that say that the forward curve says the Fed's going to ease next year, right? So there's a lot of people that think that this high interest rate environment is like a very, very short-term thing. So if that's the case, then nothing's going to break. But if rates are going to need to stay higher, and I think that between, you look at like the Russia situation. I mean, some of the people in the room are my age, it looks like, and others are younger. But when the Berlin Wall fell, they had something called the peace dividend, which is basically the U.S. government went from spending 5.5% of our GDP on the military to 2%. Right, so our deficit went down. We spent more money on things, and so the peace dividend, that was a good thing, right? And part of a lot of reasons, but one of the reasons there was this giant boom during the 90s was the peace dividend. And I would argue today we're having what they call the war tax, which is that we're going to take our percentage of the money that we spend on our military is going up. Germany, which was spending 25, 50 basis points on their military, is going to, and they, by law, they were supposed to spend 2, which they weren't. They're going to 2%, like toot sweet, right? So that's a reason that inflation is going to be higher. All the reshoring, is inflation is going to be higher. I would say that, a lot of the sort of drive for social justice and unionization, all the Starbuckses that are getting unionized, all of those things are inflationary. So if we're entering into a more inflationary time, we're going to enter into a period of time where interest rates are generally going to be higher, not than they've ever been, but just than they've been since like the mid-90s. So like on a historical basis, short rates being 4% is not crazy at all. It's just crazy based on what anyone 40 and younger knows about. So where do I think things break? I think, levered things that were, and like I mentioned before, the economy is slowing. So the revenue that's going to companies is going down, and their expense, at least their interest expense, is going up. And I think their payroll expense is going up. So, highly levered companies, I think, are going to have trouble.
So policies for regular people as opposed to necessarily assets, lots of trading opportunities in the next several years. Final question, I know you've talked about a dislocation fund and sort of what that can look like and why something like that might be very opportunistic. What's your mindset around that as you sort of look to allocate capital in the coming year? Thank you.
Yeah. So look, I'm really excited about the master fund. I made the case for that before, but we're marketing a dislocation fund for basically the thought is a couple things. One, because of the regulations after the GFC, Dodd-Frank, the Volcker Rule, capital charges, it's very onerous for banks to hold securitized products, more onerous than it is for corporates, which is another example of fighting the last war, right? Structured products blew up in 2008, so let's make it really hard for banks to own structured products. So the result of that is that liquidity is ephemeral in the space, and when they're selling, because either there's redemptions out of a big mutual fund or there's downgrades, these bonds tend to sort of collapse down, which is what happened in 2020, but things go from 100 cents to 28 cents in 2 weeks. So when things blow up and you say to people, hey, we want to raise a special fund that's going to buy all these things that were 100 cents and they're now 50 cents, when things are blowing up, people are scared, which is a natural human response, right? And they say, well, I want to wait. First of all, they're 50 cents. Maybe they'll be 40 cents next week. Or B, I'm losing so much money on my Tesla stock, I can't put money in this thing, and I'm scared. So we have begun the process, and we've raised about $75 million so far for a fund that we can only ask for the money if things blow up. And so if they never blow up, we don't ask for the money. But they're pretty close, I think. And it would be basically targeting structured products that would, where we think we can get, very high returns on sort of a hold to maturity basis, no hedging. You can't take your money back once you give it to us, so we don't have to worry about the month-to-month things that the hedging helps out with. And we believe, like I said, that the fundamentals of the U.S. consumer are much better than corporates. If you look at, and if you want the book, we're happy to send it to you, and there's all kinds of charts in it which show that the average loan-to-value ratio of a home in America today is the lowest like it's ever been. It's even lower than it was in 2000, and the 2000 time was a great time to buy our stuff. And corporate sector is among the most levered it's ever been. And like I said before, the government policy, I believe, is going to help regular people more. And so we kind of marry the fact that we think the intermediate term fundamentals of the product are relatively good with the thinly traded nature of the product, which means that things are going to get oversold. With a team I'm doing this over 30 years, and people on the team, I think the average time is 15 years. People who've been looking at these, underwriting the securities and not just buying them blindly, but having a specialized team that just looks at this and sifting the wheat from the chaff, and being able to have patient capital that can be called in times of duress. The issue with the hedge fund is you're always invested, right? And so sometimes our hedge fund is 140% invested, sometimes it's 80% invested, but it's never 0% invested, right? So when things go wrong, you have to say, okay, do I want to take on more leverage, or do I want to take on less leverage because things are going wrong? Do I want to, et cetera, et cetera? But you have a drawdown dislocation fund, until we're fully tapped out. When things go awry, you'd be like, well, we're calling that capital today, right? So like, it's sort of forced savings that you can then deploy, which is difficult for an evergreen fund to do.
We will leave it at that. We just scratched the surface with Greg. There's a fantastic podcast with our friend Ted Seides, Capital Allocators, where he interviews Greg and all about this and a whole lot more. So if you're interested. But Greg, thank you for taking the time. It was a great conversation. Appreciate it.
Okay, so we're moving now to the next conversation. This is going to be moderated by the one and only Brooke Masters, U.S. Investment and Industry Editor from the Financial Times. Come on up. Yep. I'll let her introduce the rest of the panel, but they're going to be talking about accelerating economic inclusion through alternative investing. Thank you, and welcome to the panel.
Hi, everybody. I'm sorry that we're competing with the sun. It looks really nice out there. We have a really interesting panel with Pam Chan, the CIO and Global Head of Alternative Solutions Group at BlackRock, and Ryan Williams, Founder and Executive Chairman of Cadre. We thought we'd define for you, first of all, what we are talking about when we say economic inclusion. And there are sort of three facets. One is that we want to open access to investment and investment products to a wider range of customers. Another is to recruit, retain, and empower a more diverse set of financial professionals. And thirdly, the goal is to channel investment to a broader set of companies and communities. To that end, Ryan is actually living this. And so I thought I would ask him just to explain what Cadre does, because it really is an alternative investment that broadens inclusion. So give us a little quick.
Yeah, definitely. I founded Cadre to level the investing playing field between individuals and institutions and alternatives more broadly, but really starting with real estate. So we are a next generation real estate investment platform. It's all about access for us. It's all about ensuring that individuals can have an equal allocation to alts as institutions. And through technology, we're able to reach more people and give them the ability to efficiently directly invest in real estate. So when you talk about inclusion, access is really, I think, what underpins a lot of what we do and what drives us.
And Pam, at BlackRock, you all have been working with Cadre, and you have a broader program. So can you explain how you guys ended up working together and what you're trying to accomplish?
Absolutely. Thank you, Brooke. And it's amazing to sit beside Ryan because we've developed also a friendship in addition to the business partnership to increase inclusion. So I'm the CIO for the BlackRock Impact Opportunities Fund, which is a market rate, return-seeking, billion-dollar fund focused on accelerating positive economic outcomes for Black and Brown communities across the U.S. So we've now looked at over 400 deals. We have done 6, of which 1 is with Ryan, and really looking to create collective wealth both for our clients as well as those communities in which we invest. So we take a multi-alt approach, so totally asset class agnostic on the private side, and thinking about how we really direct capital into, frankly, what we've deemed to be undercapitalized communities, and really unlock that growth.
So basically what we're talking about is the challenge about making alternatives less alternative. And to that end, it's worth talking about why is it that people, other than just out of the goodness of their heart, which is charity, to be honest, ought to be giving money to investment professionals like Ryan and to the various other deals that you've done. What is the alpha case?
So I can start. I guess for me there are 3 things, and really as an investor, it's not about philanthropy at all. Because frankly, if it was about philanthropy, it shouldn't be coming to Ryan and me, right? There are other people who are much better versed in philanthropy. But from an investment thesis perspective, I think there's a couple things. One is that there's a sheer shortcoming from a capital markets perspective, just inefficiency, whether that's from conscious or unconscious bias, history, legislative structures, all these things. And so what we're trying to do in all of the investing that we do is seek out these inefficiencies and capture that value, which I think many of you in the room do in your day-to-day as well. 2 is just the sheer size, right? If you think about the Latino population, for instance, in the U.S., if they were a standalone nation, that would be a top 10 GDP country, right? And then look at the demographics. So for us, that's really exciting. And then lastly, which then I'll hand it over to you, Ryan, is I think there's a positive selection bias as well, right? Given the low number of diverse business leaders relative to population, diverse owned and led enterprises, I think there's like a grit factor. And for us, those are the management teams that we want to back.
Yeah, I mean, from our perspective, I agree with everything Pam said, clearly, because we're partners and we're really honored and grateful to be partners with Pam and the BlackRock team. We've always been unconventional and we've always done things differently. That starts with my own journey and just seeing how homogenous real estate and alts as a space were. And our view is in order to generate unconventional outcomes, you need to do things in a more innovative and differentiated way and back people who are taking differentiated approaches, who have had unique journeys. And so when we're thinking about where we invest and how we invest and who we invest with, it's always through the lens of, what's the differentiation here? Is it an exceptional management team that's had to overcome a lot and prosper in the face of adversity? And despite the macro challenges, there's always micro opportunities with great leadership teams. Is it the communities we're investing in that maybe have been underinvested in or undercapitalized? So there's an opportunity to drive alpha by bringing capital to bear, which is the foundation of our partnership. Is it the sector? Is this a sector that has not attracted institutional capital for whatever reason? So differentiation, we think, in many ways comes from people who see the world in unique ways, and in our case, we're proud of the returns we've been able to generate as a result of doing things differently.
I think it might be helpful to people if each of you could give a really concrete example, like here is something we backed that really worked, and here's why we think it worked and why it had to do with being inclusive.
You want to talk about Harvest?
Yeah, sure. So we partnered on a transaction where I didn't know the numbers. Where our conversion was part of that big subset. I feel really proud now, even more so. But we were really grateful to partner on a transaction that was a multifamily investment in a market that actually happened to be in one of our top 15. We call it the cadre MVP. Most valuable places in terms of affordability and growth. We backed an operator that was African American woman who was one of the key principals, owned, led. She and her team had done a lot of multifamily investing out in the West Coast, but also in this part of the country. And
can you tell us where it is?
It was in Salt Lake City, Utah. So it was a market that we had invested in previously, actually, but brought together an operating partner who had really excelled despite a lot of odds against her. And it's a great investment, and we feel very good about the long-term growth of this asset and this management team as well. But that was just one example, again, of a unique operator who is delivering exceptional returns.
Yeah. And Ryan doesn't talk about some of the great work that his team does, which is that it was also financed by a minority depository institution. We're looking at kind of the supply chain for the asset, right? So how do cash flows flow to all the different parties, not just the initial investment in the asset. So
yep.
it's been great to see.
For the families that backed this, did they ask for reports beyond, obviously they want great returns, and I'm sure you've promised them something which hopefully you'll deliver, but did they ask for did they set other targets for this? Because it is it's sort of impacty as well as trying to make money.
Yeah, I mean, in terms of the investors on our end, they're focused on returns, and really we have to make the case as to, why, as Pam alluded to, it's not philanthropy that you can do well and do good, that can be positively reinforcing. And in this deal specifically, I mean, so much of it is about execution of the business plan, and we have conviction that we pick the right operators and sponsors who have demonstrated ability to generate value through different market cycles and the like, that we'll be able to actually fulfill the returns. So we do highlight the operators we work with and the sponsors and developers and their track record and what they've been able to execute on. And that's what our clients and investors are focused on, is how did you pick this operator? Why do you have conviction? In this case, we just think it's an exceptional group that is clearly, to Pam's point on selection bias, sort of navigated a lot of other uncharted territories to get to where they are. So our investors aren't really focused on anything except returns, but also returns over longer term horizons. And we think, again, by investing in these communities and bringing diverse vendors and partners to the table, you can create a lot more inclusion and sort of lift all boats.
Yeah, I wanted to pick up on one of the things that Ryan said, which is that the economic thesis for why we invest is actually part and parcel the same as the impact thesis. And so when I think about, across the 6 investments that we've made, we're tracking 65 KPIs, key performance indicators. Our underlying institutional clients in the fund, whether they're families or they are insurers or pensions, they haven't actually told us, here are the KPIs that you need to measure. But what they have said is, tell us about your framework. What is the rigor of that framework? And so we're leaning on the impact management projects framework as we think about kind of very granular KPIs. So whether it is % of spend with minority vendors for a particular asset, it's the creation of quality jobs, and also asking ourselves the question, but for our investment, what would have been the scenario? Right? And I think that's very true with Ethos, our partner in Salt Lake City, for whom this is, I think, the first institutional investment. And really, I mean, she has the track record to show for it, right? But not the capital. I also think that, thinking beyond real estate is one example for you all. We invested in a company called Tricolor, which is diverse owned, but also serves a Hispanic community in Texas and California. And one of the things we've been doing over the last few decades, or a couple decades, sorry, is developing AI to make the unscored, like those without credit scores, scoreable. And that has really been interesting to see, because they are offering kind of better quality cars, right? So they are auto retailer lender, better quality cars with lower rates of financing for a market demographically that is incredible, is growing just like it always exceeds the budget insofar as growth. And so those are things that we're really focused on, but I think it comes back to the thing that Ryan said, which is that they actually need to be together. It's not that impact is kind of on the side.
I'm interested in you say that what would they do if we weren't here? I mean, what's the how do you measure it? Like, is it that they wouldn't exist if you weren't here, or they would have to pay much? You know, they'd be doing it. This woman would be doing it on her credit cards. I mean, what do you sort of think about as your KPI?
Yeah, I think sadly, Brooke, I think yes, for some folks they never get to scale, but for the capital, right? And the proof is, frankly, in all the statistics of how many diverse owned enterprises there are of scale, how many assets are owned and led by diverse leaders, what does the trajectory of those jobs look like. And so I think for us it is understanding that counterfactual. We can never be perfect on a counterfactual, but also saying that here are some of the things that we want to work with you as the asset owner, you as the company, to create these new outcomes. And we're actually going to articulate them. Like, here's what we expect your board to look like, et cetera, as we go. And I think that also helps so that it's not a path of randomness, you know.
Yeah. You mentioned as we were talking the importance of time horizons, and I'd be interested in both of you sort of explain that. Clearly, one of the advantages of alternative investing is that you don't have to show a return in a quarter. And these are often projects that are difficult. Can you talk about how do you view your time horizons? What's reasonable, particularly if you're going to bring in retail, which presumably often has shorter time horizons, even though they shouldn't?
Yeah, I did just really want to quickly piggyback on points Pam raised, and then I'll get to the question. So. To the point of what happens if there aren't institutions like BlackRock who step up, and I think that there will be a whole generation of exceptional managers, operators across alternatives that don't ever reach scale. And I can personally attest to that because I got my first loan in multifamily from a minority depository institution after I got turned down by 10 other banks, despite having a ton of institutional LPs behind me and having closed a ton of, and I probably wouldn't have been here having founded Cadre, closed $5 billion plus of real estate, had it not been for that bank, which is actually the bank, one of the banks that we brought into this partnership, Citizens Trust Bank. So I do think there's a huge opportunity cost without the leadership from institutions like BlackRock and individuals like Pam. In terms of time horizons, for us, you know, we educate our investors because we actually do have a relatively large individual investor base, 40,000 plus investor accounts on our platform, and we're about to announce the launch of our first ever retail fund for non-accredited investors called the Horizon Fund. But we call it the Horizon Fund because we're guiding investors to think about investing over 7, 8, 9, 10-year time frames. And you know, we think alternatives are alternative for a lot of people because they aren't necessarily able to have assets that in many cases should sort of be a liquid through market cycles. And so we guide individuals and try to explain why it's important to think long-term about investing in this space and why this is not a sector you're trading in and out of frequently. But I think that there's a lack of sort of financial wherewithal from a lot of individuals to be able to actually stomach that lack of liquidity and then adverse selection as well. So I do think to the extent you can kind of democratize insights around owning over longer periods of time, you can build wealth as well for folks. But that's sort of been an institutional game historically, and that's why we think you see that big divide today.
I think from my end, if I think about the underlying assets that we invest in and the question of time horizon, I think there's a couple things. One is engagement, right? Active engagement at the community level. So we will be investing through mid-2027. That is a long time, right? So right now in a lot of the communities that we're investing in, we're learning, right? We're learning from those people that actually live there so they can tell us kind of what their community needs and what would unlock that human capital and that growth. And I think that's really important. That takes a lot of time. Also, trust needs to be built, right? It's not just learning, but trust needs to be built, and that takes time. And so I think for us, it is actually, it starts with that first dialogue. And the reason why we have our fund that is cross-asset class is actually so that we can meet everybody where they are, right? Because we don't know what the answer will be. What is the best way for capital to flow for that business owner or that community? We just don't know, right? So I think bringing the full toolkit is what we need to do, and I think that starts with engagement and acknowledging what we don't know. Two, I think there's also an element of partnering with other types of institutions. So we partnered, for instance, with a foundation on one of our deals. They have a much longer time horizon than we do, right? Ours is a typical close-end fund with like a 3 to 7 year hold, right, for each investment that we make. They have a much longer horizon, and so actually as we've invested in education, they were actually a shareholder in that company well before that company was profitable, right? And so I think about the different public, private, or nonprofit profit partnerships that can be built to actually get to that much longer time horizon. So those are some of the things that we think about.
In terms of designing alternative products that work, you obviously are both trying to serve a really wide range of investors. When you think about the design products, how do you make sure that they are, both good products and aren't too high fee, but also, obviously make some money for you or it doesn't work, and also fair and provide the results that the communities need?
You want to start?
Yeah, sure. So in our case, it's all about transparency, and I say oftentimes maybe we're too transparent and open, so every investor on our platform gets what in my past life when I worked at Blackstone we would call our kind of internal investment committee memo, and can see everything from return horizons to sensitivities to the communities that we're investing in and the impact that we foresee our investment having there. And so, we think that transparency and openness is really the foundation to ensuring that people understand exactly what they're investing in and the impact that it's having, and almost forces, just by nature, people to be very honest about every dimension to their investment. So through technology, we're able to give people as much information and insight as they'd ever want, and it also serves as a check as well on what we say we're doing versus what people actually see.
I think from our perspective, you highlighted liquidity a couple times, Brooke, right? Because obviously the smaller the investor, the more prized the liquidity is. And I think one of the things that we have been working on from a research perspective across the firm, so not just my team, but across the firm, is how we think about liquidity budgeting and building a holistic portfolio that has that liquidity to be able to meet the needs of the underlying investors. I think we're still on a journey, though, admittedly, right? And working in various regulatory regimes by jurisdiction. But I think, for instance, like the LTIFs in Europe are an interesting development, right? And so we are kind of studying those, trying to match that with portfolio construction research so that we always have the right liquidity. I think insofar as delivering on the outcomes, for us, it's always been kind of a client-driven product development. And so even as I think about the Impact Opportunities Fund that we were just talking about, it was out of conversations with some of those foundations and other, frankly, corporations that wanted to do more as they think about inclusion and their underlying consumers, their employees, all their stakeholders, and the diversity thereof. And so for us, it's actually the co-creation of these products that then allow them to be successful, right?
You mentioned regulatory.
Mm-hmm.
I mean, we're a regulated industry.
Yes.
Are there, at this point, have you run into barriers that are making it harder to do as you need, or are there regulatory opportunities that you see coming?
So I guess on my end, as a cross-asset class investor within private markets, I think we still have a ways to go. Probably real estate is actually where most of the kind of advancement has been. But I think actually the UK and Europe have different structures that actually make it more possible for underlying investors that are smaller, putting private markets into defined contribution, right? So that people can save this way and actually generate that growth. But I think we still have a long way, right? Even if you think about the Department of Labor put out something, I guess it was over a year ago, on private equity in some of the retirement funds. We're not there yet. So, but we're actively engaged.
Yeah, I mean, regulation made it possible for Cadre to exist. This is the 2012 Jobs Act that allowed individuals to invest in private placements in a much more broad and expansive way. I think out of that, there were a lot of sort of irresponsible actors who came to bear, a lot of adverse selection, and then, you know, SEC and FINRA really started to clamp down on, you know, what you could actually offer and how you framed it and disclosed. And so we've always been laser focused on making sure that everything we did was you know, more than above board in terms of disclosures and even just the evolution of our investor base. We started with ultra high net worth investors and institutions, and broadly have been, or methodically have been broadening access. And so I do think regulation was an enabler, but I think that without guardrails and without good actors can become you know, dangerous for individuals unless they understand exactly what they're getting into.
Super. I think we have time for one question. There is a microphone. Please wait for it to come to you if you want to ask. Question? Or shall I make up a question? Oh, come on, guys. Wow. Okay. Well, I will ask more questions because I, of course, have more. If you had to pick a sort of one big opportunity that you see that you haven't yet gotten to discuss, and one big scary thing that everyone should be worried about in your area, what would it be? I didn't prep these guys on this one.
Insofar as opportunity, I actually think where we are really nascent is kind of the overlap of environmental and social. And actually, Ryan and I have spent some time talking about this. Is how we think about whether it's community, solar, like other things that are going to bring undercapitalized communities along for the journey. I don't think there's actually, we're not there yet insofar as a clear and easy answer. A lot of work is being done on that, but I feel like more work needs to be done there, and I think it's going to be huge, right? If I just think about the two market opportunities colliding. So that's one thing I would say opportunity-wise.
Yeah, opportunity, I mean, it's core to what we're doing. It's really, you know, the democratization of real estate and other alternative assets, but more specifically allowing people to actually own their communities. So if you're an individual and you know, you're from a place like I'm from, Baton Rouge, Louisiana, it's really tough and challenging, you know, to build wealth through equity. But you know, there are platforms like ours where you could own a fractional stake, you know, of your apartment building or community for a relatively low minimum. I mean, I think it can be incredibly powerful and empowering as well for folks. And you know, Pam talked about community and just the empowerment there. And so that's what we're excited about, moving towards a model where, you know, the entry point is so low that anybody can actually choose to own, you know, their actual community. We think that'll create more alignment and ultimately, you know, good and well as well. So that's what we're excited. I think the risk quickly is there's a lot of platforms out that don't do the diligence, the underwriting, the vetting that are trying to democratize access. And I think, you know, we're going to see over the next year to 2 years many of these platforms die because they didn't put the right guardrails in place.
I'm scared about many things, Brooke, in this crazy world that we live in. But the three that come to mind very quickly is, one, I feel like the conversation that we're having today, I fear sometimes that it loses momentum because the world, there's so many headlines, everything has a half-life of a millisecond, et cetera. And this is work that is really a labor of love, right? It needs to be done incrementally over time, consistently, to build that trust and engagement. So I worry about that. I worry about us losing focus. I also worry that in a ever inflationary world and a more disparate world, we end up being more divisive and polarized than unified, right? And I think even when I think about our fund just focus on the US, whether it's Puerto Rico or Utah or Long Island, right? We actually really need to be introspective and think about how we can drive growth, right, in a low growth world. And I think we're going to have to be more innovative. So in some sense, I'm scared of the momentous activation energy that will require, but at the same time excited about that. So those are a couple things.
I think that's a great way to end, which is that clearly this is going to be challenging, but you guys are clearly trying some really interesting stuff, and I hope others pick up on the ideas. Thank you so much to our panelists.
Thank you.
Okay, now we're going to welcome back Gregory Zuckerman, special writer with the Wall Street Journal, to moderate us the next session on, investing in healthcare trailblazers amid a market reset. Thanks so much, Greg.
Testing. Sounds like it's on. People can hear us, it sounds like. Nice to see everybody once again. I'm back with a different group of interesting investors. Greg Zuckerman here. And for the next 30 minutes or so, we're going to talk to a different group of investors, larger types of companies, talk about public markets, talk about some of their approaches. And instead of me introducing and describing what they do, I thought I'd ask each of you to just spend a minute or two talking about what you focus on, telling a little bit about your firm, and then we'll dive into some questions. And if we could maybe ask somebody to close that door if we could, I appreciate it. Thank you so much. I'm sorry. Let's start with Robert.
All right, great. Hi, everybody. Robert Boroff with General Atlantic. I lead the global healthcare efforts at GA. General Atlantic's been around a long time, 42 years. It was founded back in 1980. We are a global growth equity firm, so we focus on high-growth companies, a lot of flexibility in the investment mandate. We're investing around the world, 15 offices around the world. And we'll do anything from selective company formation to Series B minority growth investing to minority or control recaps, assuming that they're higher growth opportunities. Healthcare is one of 6 sectors in the firm, and I've led that for the last 9 years.
Thank you. Alex?
Rob. Is this on? Yep. Great. Alex Albert, one of the founding partners of Patient Square Capital. I kind of joke we're a new firm, but long-standing market participants. We're based in Menlo Park, and we're a dedicated healthcare firm. So along with my partner, Jim, who ran KKR's healthcare practice for over a decade, we all came together, having worked together in the past, in the belief of specialization. We invest broadly in healthcare, so we do both biopharma devices, diagnostics, life sciences, as well as healthcare services and tech-enabled services, and also a fairly flexible mandate. So we do both growth equity, so earlier stage companies, as well as large traditional buyouts.
Thank you. So the market is down, and healthcare is really down, especially some things like biotech, but other areas as well. Give us a sense, kind of, you're not stock strategists, but maybe a broad sense for why things are down that much. Is it surprising in any way? Sometimes in the past, in downturns, healthcare has been a safe haven for investors, more reliable potentially. I'm not sure that's the case this time. Give us maybe your sense from what you're seeing out there. Start with Robert.
So, look, the public healthcare landscape has changed a lot in the last few years. And the really big companies, the managed care companies in particular, have actually held up really well. What's changed so much about the landscape is you had an enormous number of new companies that went public over the last 2 years. And so, you had 10, 20 public names that were earlier stage, higher growth. That number is up 3-4x. Many of those companies have really faced challenges, and that's where you've seen the greatest declines. And one of the interesting things about Alex and our business is that we're seeing a lot of these companies when they're growing before they access the public markets. And so you have the benefit of understanding the strategy, understanding the business models, and then tracking them as they're publicly traded. Certainly there's been a pullback in the markets, and so they're as exposed to changes in interest rate environment just like all companies. Those that are newer and higher growth have logically more exposure to that.
And less in the way of earnings, current earnings.
And they're earlier companies, so they're not as insulated from a maturity from a financial standpoint. But the demand side is generally very resilient. It's one of the great things about the healthcare space. I think what's changed for some of those companies is those that went public via SPACs are facing real technical challenges in their investor base. And you've had a lot of companies that went public on very similar storylines, but you've had real divergence in the quality of the execution. And as some of those, the challenges inherent in some of those business models have become more apparent to the market, I think you're starting to see a real divergence in the valuation levels, even within that new comp group.
I'll ask Alex in a second, but does that give you guys opportunities in that the market has pushed a lot of these companies down, and they need capital. They may be more quality than the investors might think. Is that something you guys look as an opportunity, or no, it's too early, we're not even close to the end of this downturn, economic downturn, and now's not the time to allocate capital?
I'm sure there are a lot of those public companies that have seen their stock prices decline that are thinking very creatively, all options on the table around how are we going to capitalize our business going forward. And in many cases, like happens in a lot of bull markets, you probably had certain companies that went public that weren't ready, and they were trying to take advantage of a really favorable market environment. But right now it's a bit of a special situation market. It doesn't matter whether they're private companies or they're public companies. It's just as it's hard for the investment community to try and predict where will valuations settle out, what are going to be the long-term unit economics in these companies. The entrepreneurs and the executives that are leading those companies similarly are dealing with max levels of uncertainty from a capital raising standpoint, which means they're having lots of conversations trying to understand what's on the table.
With people like you guys.
Yeah,
which gives more opportunities, I would think, for you guys.
Yeah, I kind of characterize it as we're in a period of kind of thematic exuberance where the large, stable, growing, recession-resilient end markets continue to be the case. But to Rob's point, a lot of companies went public really on the promise of large addressable market and some profit pool that will be accessed at some period of time without much discretion around whether the business models actually were going to get to profitability or had a unit economic model that was solving a situation or creating value for the healthcare system. And so those companies pretty rapidly shifted from growth at all costs into show me a path to profitability. Where does that create opportunity? We're a multi-billion-dollar first-time fund. Of the 7 healthcare take privates that transacted last year, we did 3 of them because we did see a real downturn in the markets, probably an overselling, fallen SPACs, and an opportunity to actually invest in great businesses with great long-term opportunities, but just that the markets either didn't understand or lost patience with the value that was going to be created. And if I think about our pipeline today, and because we do both growth equity and primary capital into companies looking to grow as well as larger buyouts, it's now less than a third of it is what I call control buyout, and most of it is around pipes for public companies that need to finance growth. It's growth equity, structured equity, and some rescue capital. But a little bit to Rob's point, what you're finding is like the constituents. You have management teams that are desperate for capital because they want to grow. You have boards that aren't quite sure what to do and where the markets are going to be, and the company was fortunate enough to raise capital in a really positive market environment. They don't need the capital. And frankly, you have sponsors that aren't quite ready to accept the marks that might be required in a flat or a down round relative to what they were marked publicly or privately previously. So we're kind of in that lag in the private markets from where the public markets have been. But I think we'll find some companies now and in the next 6 to 12 months that ultimately need to continue to raise capital to go after the type of growth. But you got to focus on whether the business model has durability.
I'm getting the sense, Alex, that it's not yet at the point where you're getting calls and desperation and we need capital. Are we at that point yet?
This is markets that I think Rob and I love, in that it's much more relationship driven. So the boards are looking for safe pairs of hands, trusted people they've known for a long time. A lot of the conversations now are like, here's the runway, here's what we're focused on, here's what we need to accomplish. And so even though volumes are way down, certainly in the buyout market because it's largely tied to the financing markets, which are effectively shut for the most part or prohibitively expensive, public markets are shut for a lot of these firms, and so they're coming to private market solutions. So I think in this environment, reputation, relationships, and frankly having fresh capital to help solve and give solutions to the board and the management team and the existing sponsors, a lot of those conversations are ongoing, but I'd say the recognition of where values might sit today hasn't quite caught up to where the public markets are.
Which is kind of usually the case, I guess.
Yeah.
This is a dumb question, but how do privates get marked in your world? In other words, does it have to be, you can keep it at the previous valuation until there's a new round of funding, or accounting rules suggest even private companies have to be marked down regularly? How does that work?
I think it's fair to say there's more latitude certainly in the private markets and how that's done. And I'm sure it varies by stage of investor and by just each individual investment organization. One of the differences obviously in valuing private companies, the public markets, it every day and it's out there and it's generally trading a common equity. In the private markets, a lot of people are investing into securities. It might be a preferred security or have some other downside protection. You may have obviously months, if not years, in between financing rounds. So there's a lot of judgment involved in figuring out what's the right valuation for that mark. I know from a GA standpoint, we're doing it quarterly. there's an independent group within the organization that establishes that value. They're discussing it with the deal teams, and we're using a lot of publicly available data and other analysis to support it. And so when we have a correction in the public markets, if 2 years prior I told that valuation group, these are the public comparables for this portfolio company, and now those public comparables are meaningfully down, that is going to drive a reduction in the mark for that privately held
So
position.
you have a valuation group. Most medium-sized and smaller firms probably don't, or what would you think?
I don't know if they'd have a separate group. That may be something that's unique or just more common within firms that are of a similar scale for General Atlantic. I know there has been, across the industry, more rigor put into that process as I speak to friends at other firms. But I think some of the more public-oriented investors, I have some questions around some of the more public-oriented investors that do a very small amount of private investing. Are they going through a similar process or not?
I mean, it's all a very rigorous process, I'm sure, for each firm, but the difference is just there's not a daily mark on it. So it's a question of, is this the right time? Do we need the capital? What valuation is the right capital relative to prior rounds? And then a judgment call on exactly what you think the exit valuation is going to be. And that kind of determines if you back into either DCFs or public markets, or you pick your valuation metric. But I think what we are seeing is that valuation multiples are coming down across the board. It's just, when does a company actually need liquidity? And then therefore, what is the mark in a private transaction?
Do you get suggestions from LPs not to mark so rapidly? Hey, we don't mind you keeping these marks where they are.
It's a pretty robust, rigorous process.
Okay.
I do think it's interesting, just back to the structure point, let's say valuations have come down in a sector. There are more degrees of latitude for a privately held company to the extent those investors want to try and maintain a mark. So Alex and I, that are doing larger, later stage deals, are seeing a lot of earlier stage companies that raise money at really big values the last couple of years. And they're really reticent to do a down round. And so we're seeing a lot more openness to more heavily structured investments, providing more downside protection in the security, just to try and preserve maybe staying flat to that last round. And that's not frankly, I think more of a market correction is going to be healthy and will allow more free-flowing investment activity and people to navigate through it, but we're in the very early phases of that.
Where was the froth, or where still is the froth? In other words, you talked about some of the SPACs potentially. Is there a sector where you thought there was just too much capital came in there and now it's not there anymore? Do you see you were scratching your head the last couple of years, why are these valuations where they are? Was there kind of areas of concern that you had in this world?
Yeah, I'd say probably the top example would be like the virtual care space. So we go into the pandemic environment, everybody is fearful about going into traditional care settings, understandably, and it drove enormous increase in awareness and adoption of virtual care delivery models. That was great for that industry. It accelerated it 5 to 10 years. But it wasn't reasonable to assume that artificially stimulated level of utilization of that as a modality of care was going to be durable as we get back to a more normalized work environment.
Sort of like the Zoom and those kind of shares were overstated for a little while.
Yeah, very similar.
Yeah, I'd just say something similar, whereas there was a thematic exuberance, but not a real understanding of where each of those folks that claimed to be in this certain space actually had a durable shareholder model. I'll give you an example. I mean, telemedicine was obviously a huge theme. Anything that had touched telemedicine traded up meaningfully. One of the companies we actually took private, SOC Telemed, although it is quote-unquote virtual healthcare, it actually has a physician base that has monitors within a hospital system that allows for remote access for physicians in an acute care setting. Very differently painted with a brush with something like a teledoc, which is quite low barriers to entry and more of a consumer-oriented approach. And so those themes are still durable, but it's like exactly how are you exposed to those themes that winds up getting uncovered in the context of a down market.
Well, one of the themes that emerged from the earlier panel, which I found interesting and educational, was the importance of home health and how that's grown a lot. Home hospice, home other kind of areas, even rolling back to the era when the doctors came to visit. Are you guys investing a lot in that area as well?
We are and have been. And I want to build on something Alex just said. So one of the really interesting things about the pandemic is it drove, I think, a greater alignment across what are going to be the defining themes for the U.S. healthcare system. And so unfortunately, that drives a huge amount of investment activity. Probably more companies well-positioned against those themes were created or financed than should have been. And there generally isn't, even within the investment community, as informed or nuanced of an understanding of the different business models. And Alex did a good job explaining some of the differences which are critical to their long-term economics and viability within the virtual care space. Same case in home care. So these are big trends that have not been invalidated in spite of the correction in some of the public market valuations. I think the investment community is just starting to understand these are going to be big trends that are going to define the market, but there is a huge difference in the viability and attractiveness of the different business models across every aspect.
I think we saw a significant rotation, not just in public markets, but in our world of fundraising, to technology, to healthcare. And I think, you know, we kind of sometimes joke, but we're like unabashedly not thematic, as in we live and breathe healthcare. We're a dedicated healthcare fund. We all know the themes and know where the puck is going, but I think the public markets will kind of invest in a basket of ideas versus real understanding of durability, to Rob's point. And so I think what we're now seeing is, like, home health's a great example. Home health's been around forever. It's a lower cost side of care. Patients, i.e. consumers, prefer home care. Things have been moving outside of an acute care hospital system setting for a very, very long time. But then it's just a matter of what exactly they do, how do they interact with the patients, and how do they deliver value in a pretty complex healthcare ecosystem, and does the valuation in which they are garnering make sense given their profit margins and the durability of what they're providing.
And is there innovation there? Is there innovation? Is there something you can point to, a company, I don't know, startup that you're involved in or not involved in the home health area that is exciting, is new?
Yeah, I mean, look, what's interesting about it is you used to have, you know, skilled home care businesses or private duty businesses. Those are fee for service, and as Alex said, have been around a long time. Now you're having sort of the combination of the shift into the home, but also a real change in the revenue model. So a lot of people in our sector are talking about value-based care. So that's shifting reimbursement from fee for service based on unit of care to actually being paid for the outcome. And if you deliver better outcomes and keep those patients healthier, you're creating savings for the system, better clinical outcomes, and these models are contracting in a way where they can participate in that savings. Now you have just totally changed the financial opportunity for those companies, and they can afford to build more robust, innovative care delivery models, many of which are designed to deliver care into the home. So it's a much, where there used to be two types of home care companies, now there's probably 40.
That's a meaningful secular shift in that previously, because it was all fee for service, and now payers are understanding that by addressing in this particular way, they're saving downstream costs, and you can now structure contracts in a way that actually compensate you for some of the total cost of care savings. That's something that'll be durable and persistent.
That sounds healthy. Is there any downside to that? Is there some risk, danger for society, for the system?
For home care?
Yeah, no, in terms of the value-based, getting paid not on services provided, but on results.
It puts a much higher focus on quality, compliance, and outcomes. Because the only way you're able to achieve those economics is if you can demonstrate outcomes, track quality, and show. And so for some companies that don't quite have the sophistication, either the analytics or, frankly, the ability to track, manage, and monitor that, then you can find yourself not realizing the economics that you thought you were signing up for. And I think what we're seeing is in the early stages, and this is driving tech enablement, this is driving analytics, this is driving a whole new area of healthcare to actually monitor that efficiency, get paid for it, and then be able to, in an analytical way, show it.
That's really interesting. Another really hot area is behavioral health. I've written a story, a lot of people have written a story. We all are aware of the mental health challenges in our society broadly. Tell us about whether there's too much capital in that area, not enough. Are you excited about it? Are there ways to make money in that world, in that space?
I think it's still a really exciting area, and frankly, it's one of the best applications of virtual access, just given the ability to enable much easier access, including asynchronous access, but you know, enabling a longitudinal relationship between a provider of care and a patient, in many cases in a much more convenient format for the patient. And so
the patient hasn't been reluctant to use their own couch and sit back and talk virtually?
No, they seem to prefer it, which is great. But there's huge supply-demand imbalances across the bricks and mortar care delivery infrastructure for behavioral health generally across the U.S. You've seen a lot of easing of the regulations as part of the pandemic environment. You saw a huge amount of investment into virtual care delivery models. I think it's going to be one of the showcase opportunities for how care models changed and leveraging that, that virtual delivery model.
I agree with Rob, and actually one of the investments we did make was in a facilities-based behavioral healthcare business. And what's fascinating is you can draw a long-term trend over 30 years, not just on reimbursement, but on demand for mental health facilities, whether substance use disorder, acute psych, which now following pandemic continues to kind of exponentially accelerate, but a complete lag in supply of beds to actually take care of those patients that are seeking mental health needs. There's not just a a growing demand, but there's also an awareness, and I think, to your point, a social acceptability of seeking out some of these treatment. And so those supply-demand imbalances have persisted and are now accelerating in a space where there's a vulnerable patient population that desperately needs access, whether it's through telemedicine, whether it's through facilities, and increasingly covered under health insurance to be able to address.
So the pandemic has created a lasting effect in that regard. Patients have changed in terms of their behavior.
Accelerated a long-term trend for sure.
Big time.
Interesting. People always talk about dry powder in this industry. There's always a lot of dry powder. Ever since I've started writing about it, people talk about how much dry powder, but it does seem like there's a lot of dry powder. Tell us a little bit about that, and also tell us just about how you have changed, or you're going to have to change in any way as the macro environment becomes a little more challenging. How do firms like your own adjust?
I'll try and hit on that. So obviously a lot of firms enjoyed really robust returns over the last few years, just given the rising market environment. A lot of companies raised money arguably at unsustainable values, but haven't yet burned through those dollars. And I think I don't see or hear about any sort of pressure from the investment community feeling like I've got a huge amount of committed capital, I gotta find something to invest in. In fact, I think the pendulum has swung the other way, where the investment community is being much more discerning around quality of the business model, unit economics, durable competitive advantage, all the things that frankly are healthy for a functioning market, and will help get the entrepreneurs and the executives leading these companies focused on the right things to optimize the chance of their success in building great companies that are hopefully solving big problems.
Yeah. And healthcare has been one of the top performing sectors of the last 10 years. But a lot of that, if you dissect the returns, have come from just low interest rate environment and multiple expansion. And so you're able to ultimately buy something and sell it for a lot more, but given that rise. And I think that playbook that's worked perhaps in the last 10 years is not the environment we find ourselves in today. So a little bit to Rob's point, you have to be pretty flexible, which we find ourselves, given we do multiple sectors, we kind of naturally gravitate towards the best risk return profile. We're not dependent on just buyouts to having access to capital from the financing markets or the debt capital markets. But that does mean that you have to sort of find those businesses in markets that are growing with great management teams that you know that are able to take advantage of and grow and generate returns through growth versus counting on multiple expansion as the cure for all ills that happened over the last 10 years.
Cure for all ills, that's a good phrase to use on this panel. I'm going to leave a few minutes for questions soon, but I was curious what advice you're giving your portfolio companies, what guidance, what pressure, what are they reluctant to do given this macro backdrop? Maybe, hey guys, you need to be doing X, Y, Z as interest rates go higher, as the market has difficulties, and again, what are they open to doing? What do you have to kind of encourage them a little bit more, persuade them about?
Look, how persuasive we can be probably varies a little bit based on the ownership stake in the business, which varies for us across each deal. But I'm confident both of us have been giving advice to our portfolio company teams to be more prudent on pace of investment, to focus even more on unit economics, to remember growth is not the primary driver of value creation. It is not the end-all be-all, and I think many people unfortunately fell into that as a trap over the last couple of years. But to really be focused on the unit economics. And you hear a lot of people in the technology community talk about the rule of 40, and it's if you have an option to grow the business at 60% and make no money, or grow the business at 30% and be profitable, we're certainly in an environment where the latter profile is going to get much more well rewarded than the former.
Which is new, which is different.
Yeah, very.
And I echo exactly that. And I'd say, obviously we're in a high labor inflationary environment, persistent throughout the economy. I think specifically in healthcare and healthcare services, that means that the management teams and with our support are very focused on funding technology solutions, ways that have a mission-centric organization that's able to retain and recruit and train employees so that we can continue to sort of have a labor cost structure that's able to either mitigate or find ways to avoid some of the persistent inflation we're seeing endemic within the healthcare system. And I think frankly there's also just some smart financial of our we have north of $1 billion of debt that we've hedged from floating to fixed, trying to make sure that we generate our returns through growth and aren't taking risk around Fed movements and interest rate inflation. And then more importantly, finding the teams that can actually have controllable levers for growth. I mean, there's a maniacal focus back on ROI. If you have sufficient access to capital and you have businesses that can access that, what are the levers you can do now that actually have return opportunity versus perhaps investing for things that are less identifiable. And so the companies that we tend to find are ones that don't just have one way to create returns, but have multiple ways to win. And you can allocate capital efficiently, whether it's building de novos, whether it's investing in technology, whether it's entering new addressable markets, or frankly, with capital taking advantage of depressed valuations to expand addressable market through M&A. All those are board discussions that we're having pretty actively.
Yeah, that was one I was going to add to it. I'm glad Alex hit it. There is a huge amount of discussion around strategic M&A activity. So with the value creation, with the pending shakeout in a lot of these areas, but with, I think, increased alignment and conviction around the right themes, the right business models to be successful long term. If your portfolio, like most of ours are, in a relative position of strength, now is an environment to go play offense, and we're trying to help them do that.
And strategics are interested in writing checks and opening up the vaults for deals?
Yeah, you've certainly seen an increase in that activity in the healthcare space.
Yeah, I agree. You kind of put three flavors on it. I mean, obviously, payers have always been vertically integrating, and they have significant access to capital, and I think have been doing that for a number of years, and we're just seeing more payers trying to find ways to access and control the cost of the patient that ultimately winds up being a member of theirs. Secondly, I'd call it more traditional bricks and mortar or retail-oriented strategics that are now looking for ways to add stickiness to their customers and add ways to get them either in the physical retail location or just frankly have a way of increased connectivity. I think what we found really interesting is obviously quote-unquote big tech. They're just at a size and a scale now where the only market that's large enough to actually move the needle on their opportunity for growth and addressability for an Amazon, for these, is to find ways to access healthcare. And they tend to focus on pharmaceutical distribution, which is a huge market and highly inefficient, or primary care, where you can actually access the patient and find ways to attach on other services. But I think that's probably the newest and frankly likely to be a more durable way of strategics coming into a market which has meaningful inefficiencies, with the one asterisk being it's a hell of a lot more complex, and some of the things that have worked in those end markets aren't necessarily going to work in the healthcare market, which is hyper-localized, has sort of entrenched ways of doing things, and the pace of innovation in healthcare has always been lagged behind other sectors. So you have to kind of be thoughtful exactly how they're going to enter, and then the durability of those. I keep using the word durability, but it's a pretty important word. How those models are actually going to be able to be utilized to feed and help the totality of what they're trying to accomplish.
What's the one big tech that you would bet on in terms of getting it right when it comes to healthcare? Is it Amazon? Is it Apple? Is there somebody that we're not even thinking about that you've been impressed by? You know what? I've talked to the people there. They know what they're doing. They're focused. I don't know. They're going to create some solutions. Is there anybody that comes to mind? You can say it.
I'm not going to call the shot. I've been asked this question each of the last 4 years, and the answer I would have given has changed each year.
Really?
So
what did you use?
I'm predicting that next year I will have a different perspective.
Who did you use to bet on? Who did you before? And then
He's dodging that. Don't add.
Yeah.
I would say I won't pick a name, but I would say remote patient monitoring, telemedicine, allowing consumers, i.e. patients, to access care where they want to access care with data and analytics that helps them make more informed decisions, especially in an environment where the financial burden is being more and more on the patient. Those are the types of investments, and I think technology companies that can help accelerate and arm patients to act as consumers in a healthcare ecosystem that's highly opaque are the types of firms that are going to wind up having an opportunity to actually be successful.
Okay. Normally I need an example, but we'll let it pass. Maybe someone else can force them to give an example. Anybody have any questions before we end the panel in 2 minutes and 26 seconds? And going once, going twice. Okay, so good. So I get to ask one more last question. In terms of staffing and hiring, there have been all kinds of concerns in all kinds of industries, but especially in healthcare. How difficult is it in your portfolio companies? How much kind of in the way of complaints and frustrations are you hearing, and are there any really good solutions you're hearing or you're providing your portfolio companies?
Look, a lot of these trends are hugely impactful to the functioning of the broader market, but you have a lot of unfortunate areas where there is growing demand and there's a real shortage of qualified, credentialed providers of care. And by the way, those providers have had a brutal last 2 years. And so compensation levels are going up there, but it's not just a compensation or cost, it's actually creation of capacity for delivery. And so a lot of the models that we're looking at are thinking about how are you leveraging lower level clinicians for technology to try and enable the clinicians you do have to operate at the top of their license.
Like physician assistants as opposed to physicians?
Exactly. So you're getting more productivity out of the same care team. Now, what you have to watch there very closely is the quality of the care that's being delivered. But I think you're going to have that kind of innovation and business model in order to address the supply-demand challenges that the whole system's going to face.
I think one of the wonderful things of being a healthcare investor, which Rob and I talk about frequently, is that it is a mission-centric approach to investing. As in, you can even say, why do we name ourselves Patient Square Capital? We're not an impact fund, we're a mission-oriented firm. We invest in companies we think are improving the health, well-being, and lives of patients. I think and so the types of companies we invest in, you have to have a mission-centric organization where employees are drawn towards actually solving problems in the system and doing so in a high-quality, clinically compliant, great outcomes way. And I think where we're seeing folks able to retain and recruit, that becomes even more important in a market environment like this, where it's not just a hope of high stock market valuation, or this is a cool idea, or this executive from a different industry is now in healthcare, we're going to do something different. It's that fundamental concept of mission orientation, I think, that allows companies we invest in at least to have a durability, again, of having actually recruiting and retaining the types of employees that you want.
Interesting. Yeah, it's a fascinating environment we're in. We're on the one hand, people talk about the need for labor and productivity, and where do you get employees that are valued and productive. On the other hand, we're going into a downturn usually in employment is easy to find. Employers are easier to find. So it's a unique environment for you guys. Thank you on behalf of everybody. Thank you, Rob and Alex, for your time.
Thank you.
Thanks.
Okay, so we're going into our last panel before the break, and then we're closing with, I think most of you know, Andrew Yang, who'll be speaking a little bit later today. I had the pleasure of seeing him for the first time in person at a conference a couple months ago, and he is not to be missed. But I'll introduce right now the panel on Institutional Investor Perspectives Day 2. So we obviously talked a bit about this yesterday, and I'm going to turn it over to the moderator, Daniel Adamson, who is Senior Managing Director with WAFRA. Thank you.
It's a pleasure to be here. Yesterday's panel on institutional perspectives was really top-down, taking a macro thematic view from the perspective of large allocators. Before introducing our esteemed panelists, I wanted to say a word about what we're looking to accomplish with this panel. So one of the challenges of being a large asset owner, a universal owner, if you will, is that by the time you enter a space, there's usually lots of other capital there with you, and that can lead to, cap rate compression, multiple expansion, whatever you want to say, but often the scalable niche opportunities that might have been most attractive in a particular sector or region have already been scooped up by more nimble investors who aren't investing with multi-billion-dollar balance sheets. So we're going to talk today about how institutional investors can overcome that and actually access scalable niche opportunities. And with that, you'll see why it's so relevant to have our two panelists, Pratik and Kevin, here with us. I'm going to ask each to introduce themselves and their organizations. Pratik, if you wouldn't mind.
Great, good to be with you all. Pratik Patel. I work with WAFRA. WAFRA is a New York headquartered investment management firm focused on alternatives. Today we manage $33 billion in total capital. I lead a business we call alternative real estate. WAFRA's been in the real estate business for over 30 years, but about 7 years ago we launched a business called alternative real estate to focus on niche real estate asset classes. We define that as anything that's not your traditional retail, hotel, office, or multifamily within real estate. So over the years we've invested in data centers, marinas, car washes, medical office, single family rental, and are looking at dozens of other asset classes.
Whoa, it's quite loud. Hi everyone, Kevin Davis. I'm a managing partner and co-founder of Post Road Group. We are a Stamford, Connecticut-based diversified investment manager. We invest across 3 strategies. One is a private equity focus on the corporate space, investing both equity and credit in the digital infrastructure, TMT, and business services sector. Second strategy of ours is a real estate lending business, our real estate credit business, where we provide what we call stretch senior financing to owners and developers in the real estate space. So that's higher leverage, call it 85% of cost type financing, typically translating to 65% of ultimate completed value. And then we have a real estate equity business where we are very focused almost exclusively on multifamily, where we own, operate, and develop from the ground up apartments across the country.
Thanks, Pratik and Kevin. I'll introduce myself briefly as well. So, Daniel Adamson, this is my third year being part of this forum, and it's a pleasure to be back. I'm a member of the management committee of WAFRA, where I'm a colleague of Pratik's. I'm also the president of Capital Constellation, which is a consortium, a joint venture between about a dozen of the largest asset owners in the world. So our members include New York State Common Retirement Fund here in the Northeast, also Canada Public Pension, the Alaska Permanent Fund, the Swedish National Pension System, the Kuwait Investment Authority, and others. So I'm really going to put their perspective on as I'm asking questions of Pratik and Kevin about how to get the sorts of opportunities that they unearth to be scalable and therefore needle moving at the level of a large asset allocator. So Pratik, first question for you. You know, we're talking about alternative real estate, and in particular, finding those niches that are ahead of the cap rate compression curve, that haven't been flooded with capital. How do you think about how do you discover them?
Yeah, I think there's two ways we go about it. One is a thematic approach where we're looking at macro trends, we're looking at real estate trends, and we're targeting different asset classes because of those. So marinas is a space where we thought that was an interesting mispriced asset class. We've invested in that space for over 7 years, where we were able to buy marinas at 8 to 10 caps back in the day, and we looked at that risk profile versus parking or self-storage that was trading at 5 caps as not too dissimilar. So in many ways we're trying to look at sort of themes that we're seeing in the market and tackling those. The other way is just reactive. In many ways people come to us with deals. We've been on the market for a number of years trying to find off-the-run real estate. Now when people don't know who to call about a real estate deal, they usually call us because it doesn't fit. In many ways, if you think about a marina 7 years ago, when we first got into that, we didn't know if it was real estate, infrastructure, hospitality, is it a private equity business? We sort of parsed through all that, figured it out. When we went to sell the business last year, we had real estate funds, private equity funds, hospitality groups, and infrastructure funds looking at it, right? So like that's a good example of how we try to get into these asset classes that are maybe early, become institutional, and then sell it to the broader market.
Pratik, just a follow-up question on that. So taking the marinas example or others that you guys have built out, whether that be the car washes or in iOS, how do you make that transition from highly fragmented mom and pop type franchise businesses into something that is a bankable asset? Is there are there consistent patterns in how you need to manage and professionalize those to, again, from the institution's perspective, to get them to the stage where they're really investable by large pensions and sovereigns?
Yeah, I mean, there's an education process. We have to do it ourselves in many cases, and we create internal white papers and research projects. We use outside consultants to help on that process at various times. But we have a whole team that helps research as well. And in many ways, like for the marinas deal, when we went to go finance that, we started with one marina. We bought almost 45 marinas in that platform and probably 35 different transactions. And when we got to scale, we wanted to be more efficient in our financing. Over those years, we were doing one-off loans with local banks. So we had to educate the large regional lenders and mega institutions about marinas. So Bank of America was our lead lender. It took us months to educate them about the marina space, that this is not too dissimilar risk than other real estate asset classes. I think that was one. And the other thing we were very successful in was in educating the tax regime. So we were the first business to get a private letter ruling from the IRS to qualify the income from a marina as a REIT-eligible income stream. Right? That took almost 3 years of dealing with the IRS and educating them on the cash flow streams, which effectively is just parking revenue. Right? So that creates more liquidity, that creates more institutionality from the outside investor market. And so these are all the things that we try to do as we get into these businesses.
Thank you. Kevin, a question for you about digital infrastructure. I know this is an area that is on the tip of everyone's tongue, part of what we might call 21st century infrastructure, 21st century real estate, but yet it can be very difficult for institutions to access. How do you define, maybe you could help us by starting with just a definition of what is digital infrastructure, and then how do you differentiate within Post Road Group and package that for institutions?
Sure. So just very simply, digital infrastructure is everything digital. It's the transmission, storage, and access to data. And it's an industry that if you look at our entire business, we're focused on right now digital infrastructure and multifamily real estate is the predominant focus for our investment activities today. They're both industries that have massive, massive tailwinds. Everybody in here, I assume, has a cell phone in their pocket. You're transmitting data every 2 seconds. If you look at human use of data, it's gone up 40 times from 2010 to 2020, and it's continuing to grow at a massively accelerated rate. So what we focus on is number one, just the macro trends around that are incredible. The growth is absolutely tremendous, and what we focus on are really what we like to find investment opportunities that are below the radar of the major institutions in particular segments within, right now, the digital infrastructure space that are largely overlooked and we think mispriced. And oftentimes that means partnering with smaller operating businesses that have really strong teams and have a really fantastic business plan, and they just need the right type of capital and the right partner to grow. Oftentimes, like for example, data centers is one form of digital infrastructure. We're not super active in the data center space now. We were many years ago, but as that became much more of an institutional asset class, we saw pricing slip away from us, and we started to say, okay, well, let's pivot and find other opportunities. So we're very focused on, right now, fiber to the home, and so we're investing in businesses that are literally rolling out fiber to private homes. In the United States right now, only 30% of the country has access to high-speed fiber internet. Only 17% of households in the country have direct fiber coming into their home right now. Those are statistically almost unbelievable numbers when you think about every single person that you know has a cell phone, every single person that you know, for the most part, I think maybe my grandmother is an example of one that doesn't, has internet in their home and accesses the internet on a daily basis. That's a tremendous opportunity set. And it's an opportunity set that isn't right now accessed in massive, massive ways by large industries. And so it's the regional fiber networks are being built by regional players. And so we find those regional players, we partner with them, and we put together an aggregation plan where they're either building their own fiber networks or they're acquiring other local operators, and we're building a larger business together with them. And that's one of the ways that we take what is a very niche-y and very local-based and kind of a micro-market focused opportunity and roll it into something that, through its growth plan becomes an institutional asset.
And then institutions can partner with you on that, presumably either through a diversified fund, or can they come directly into that strategy?
So on the corporate private equity side of our business, we have funds raised. So typically, we're raising capital from investors who are investing into discretionary funds. So occasionally we have co-investment opportunities and things like that. So on the digital infrastructure side of things, we actually just recently raised $350 million to partner with 2 operating businesses, basically to do just what I explained before and build these fiber networks across the country.
Yeah, that's one of the interesting things about these types of plays is that I think we're accustomed to thinking in a venture capital type model where the riskiest dollar is the first, and then as the businesses grow, they de-risk. But in something like this, the 100 millionth dollar may have the same return potential without necessarily greater risk or reduced risk. The more you develop the pipeline, the better the risk-adjusted economics are.
Yeah, and the further diversified these businesses become, so the more stable they are, they spread their geographic region, and it becomes a much more attractive and stable overall business. We have a little bit of operational risk early on when the companies are smaller, But our investment team is very seasoned in the operating space, and we understand exactly how to grow these businesses and how to work with the management teams to make them successful.
Yeah, and a lot of these asset classes are just very scalable. And I think as you in many cases, we put in an initial management team, we're scaling these, there's opportunities to raise capital alongside these vehicles. What we found is you get real portfolio premiums when you go to exit. There's not many groups that want to be that first 100 or 200 million of capital. They want to be, maybe they want to buy a business that's already $1 billion in total value, right? And so we've seen that time and time again. And then the teams that you build around these businesses and these platforms become very valuable as well. How do you take a $1 billion business to a $5 billion business? When we go to sell these businesses, oftentimes our teams are attached to the platform on a go-forward basis, so the new buyer, new investors know that they have the same team in place that can grow this beyond what we can.
I think you were being modest, Pratik, when I asked you about how do you find these opportunities that are ahead of the cap rate compression curve, and you talked about, well, many of them just come to us. I think it takes a lot of insight to see something like marinas as an example and recognize it as a potential institutional asset class ahead of time. After the fact, yes, it can be obvious, but another example of that, and I like these examples because I think if we asked everyone in this room to shut their eyes and think about what innovation looks like, almost all of you would think of something technological in nature. But most innovation, I would posit, is structural or conceptual in nature. Here we are sitting in a room talking about alternatives, private equity, hedge funds, et cetera. When many of us were born, those industries didn't even exist. And so that's an example of structural innovation, conceptual innovation. Within alternative real estate, I think there are examples like this. Pratik has taught me a lot about single family to rent. Blackstone was a real innovator there with what you might call SFR 1.0, single family to rent 1.0. How do you see that space, which is very much in the news these days, evolving? Is there a 2.0 version there that also represents an innovation?
Yeah, I mean, we've been active in the development side of single-family rental communities for about 5 years now, and so our thesis is this is how people want to live and where they want to live. This is a pre-COVID view that we had. It's been very much accelerated by COVID with the movement to the Sun Belt, the need for that extra home office or the preference not to share as many walls. And so we've been active developers of single-family rental communities. We buy land, we do the horizontal infrastructure, we talk to groups like Kevin may know to bring fiber into these communities, and then we do the vertical construction, 250 homes, all for rent. And there's an amenity center in the middle with a pool, a garage, a leasing office, a gym, all the things you would get in a Class A multifamily project. In many ways, we call this horizontal multifamily. But you get a house, you get a yard, you get a garage, you can get 2, 3, 4 bedrooms, and you're in a self-contained community. You're not part of a master plan, you're not scattered. I think Daniel refers to SFR 1.0. We view the post-GFC SFR play of buying foreclosed homes and leasing those as SFR 1.0, and that's had a great run over the last 12 to 14 years. But when we look ahead over the next 15 years, we think this 2.0 version of purpose-built SFR has staying power. We're generating better margins. We're brand new build homes. It's purpose-built for rental. The homes that were bought out of the global financial crisis were never built to be rentals. They were built to be for-sale homes and forever homes for people. And so they have dining rooms. We don't build dining rooms in our product because people don't really, in a rental, want a dining room. So these are the types of things we think that we're focused on. We're very focused on how the layout of the units, where we're building in Myrtle Beach, Charlotte, North Carolina, Savannah, Georgia, Jacksonville, Florida, the path of growth, and we're really excited about this theme, and we believe it's still the first or second inning of that model.
One of the questions that I often get from our institutional asset owner partners in Constellation, and it's hard when you're a $500 billion pension like the Kuwait Investment Authority or New York Common or CPP to use the rudder on such a huge ship. to make subtle changes in the context of current market conditions, if that's an inflationary environment, et cetera. Kevin, as you think about what institutions are looking for from the asset classes that you play in, it strikes me that by virtue of sitting on both the credit side and the equity side, on digital infrastructure and real estate, that you guys have a unique perspective on which aspects of those markets are being challenged by today's market environment, or maybe actually enjoying some tailwinds as a result.
Yeah, I'll say from an on the real estate equity side of our business, I'll say what we try to do is avoid where the institutional capital is, in a sense. We try to find opportunities where the capital isn't flowing into heavily, but where we think it will eventually flow into. I think, again, I'll speak specifically about multifamily because, like Pratik said, we're huge believers in multifamily, both SFR and we invest in and build more traditional, kind of call it vertical multifamily across the country. But what we saw is when we historically had a large focus on workforce housing. The bottom line in the United States is that we are dramatically underhoused. There are about 4+ million housing units short. Housing's unaffordable, especially now. Mortgage rates are almost double what they were 12 months ago. So that's going to force more and more people to stay in the rental market versus being afforded the opportunity to go and buy a home. So for the SFR business, that's going to be a tremendous opportunity. Where we've done really well and have had great success and achieved what I'll call outsized returns is by finding opportunities with these strong fundamentals supporting them, but in areas where the institutional investor audience was kind of overlooking them. And so workforce housing is a great example of that. We bought a portfolio of about 3,100 apartments, 12 different assets from 2015 to 2018. We were able to buy those at an average cap rate of about 6%. We were competing against almost nobody at that point in time. We were scratching our heads why this wasn't a space that was more active with institutional investors. The institutional investors that we would talk to would say, that sounds great, but it's 60s, 70s, 80s product. We like to be 2000 or newer product. It doesn't check the box. It's in a location that's not the primary growth like Nashville's of the United States. And we said, well, but you still have really strong fundamentals here. And we're buying this at a price point where we can achieve double-digit total returns just through pure cash flow, even if we sold the asset at what we bought the asset for. And clearly, over time, you hope that you'd have asset value appreciation. So in our mind, it made complete sense. It wasn't resonating at the time with the institutional audience, though. But guess what? Cap rates went in those asset classes from 6% down to 4%, and all of a sudden we found ourselves, when we were trying to buy these, competing with other institutional investors. And all of a sudden, by the way, guess what? We decided to pivot out and sell our entire portfolio because we couldn't make heads or tails out of how people were paying these high prices. So we look for these opportunities, and what we did do is we pivoted into urban core in the middle of COVID, when institutional investors were telling us nobody's ever going to come back into the city, nobody ever wants to live in a high-rise apartment building again. Well, guess what? We found tremendous opportunities to buy fantastically located urban core CBD development sites where we could build that outside, what we believed at the time was going to be, and has played out to be true, outsized development yields. And all of a sudden now the institutional audience is coming back and saying, okay, yes, people do want to be back in the cities. So there's a lot of, there are many opportunities, even within the multifamily space, which is a well-trafficked space by institutional investors, to find these niches and these moments of opportunity to enter in and exit out of investments. And that's really how we, and we do that on the digital infrastructure and TMT side as well. We look for these opportunities within our industries where, for whatever reason, there's just a bit of a constraint on capital flow, but there are strong fundamentals and reasons why the institutions should be there.
One of the ways that we use the institutional investor network that we've built, this constellation of asset owners, is as kind of a hive mind of CIOs, and it often gives us some sense of where I won't say where the world's heading, but at least where the institutional dollar is heading. And if I had to categorize the concerns that those CIOs have into two buckets, One, which we've already discussed, is kind of rising rates, inflation, cooling economy, cooling corporate earnings, et cetera. The second category is geopolitical and onshoring of supply chains, et cetera. And Pratik, as a question for you, that's all good and well as a newspaper headline. But when the rubber meets the road and you're thinking about the impact of supply chains on physical assets, on how goods move from port to home through the real economy, does that influence thematically where you're looking for opportunities?
Yeah, absolutely. I mean, we've seen a huge bull run in industrial real estate driven by the growth of e-commerce over the last decade, right? And so, but there's other niches within the industrial market that we think are interesting. And what informs that? Actually, Wafra has a pretty sizable infrastructure business where we own shipping assets. We own the 5th largest container leasing business in the world. We own truck and trailer leasing businesses, aviation assets. So we're very much doing a lot in the transportation infrastructure space. So what we found from that team is there are certain ports that we think are very high growth, and one of those is Savannah, Georgia. And that's one of the places we're building single-family rental in real scale, but we're also doing a lot with industrial outdoor storage. So this is a venture we've recently launched. Industrial outdoor storage we define as commercial parking for trucks and containers and commercial equipment. So where all those Amazon Prime trucks need to park, or where all those containers that can't get out of the port or onto a truck or onto a ship, where they're stored. And so there's it's really actually just parking for goods and services related to the industrial market. And there's a real dearth of that. And why is that? This is one of the few real estate asset classes that are actually probably less supply coming, and supply is actually going down because municipalities don't love these asset classes. It creates traffic. They're not real tax generators. They can be unsightly. It's really a parking lot with barbed wire fencing around it and some lighting. And so most people, if they buy an industrial outdoor storage facility, they're trying to build a warehouse on it or build new industrial. But there are pockets where you can buy it right and keep it as a parking facility. And so we're rolling up these assets. Some of these deals can be $4, $5 million purchase price deals, so pretty small deals. But we think that is the opportunity, buying in a fragmented asset class. It's a lot of mom and pop ownership, non-institutional ownership, and if you buy 50 of those, then you've got a real platform, some real scale, some diversity that we think is pretty powerful. So that's something how we're playing the supply chain is, and the industrial market is an offshoot of that.
I was thinking as I was listening to some of the speakers yesterday that if you're in public markets, if you're a hedge fund investor, if you're Ray Dalio, probably the truest path to creating alpha over the last 30 years has been to find an office in the woods and have deep and original thoughts that are not correlated with what's happening elsewhere in the world. If you're in the private market side, as all three of us are, it's really critical to have an ecosystem of partners. And Kevin, you mentioned as you were introducing Post Road that you guys often partner with underlying operators, which is going to be something that from the perspective of a large asset owner is rare and maybe even impossible in niche asset classes. So if you're a large Canadian pension, you can probably build a property management affiliate, but you're not going to be able to build an affiliate with a regional fiber to the home provider in the way that you guys could. So, I'd love to hear how you think about structuring those partnerships to create alignment. And then I'm going to follow up with some questions about how to structure partnerships between GPs and LPs to create alignment. But first, just as we think about that value chain, that sort of vertical connection between capital all the way to the actual operating talent, a key link in that chain is between you all as the discretionary shepherds of institutional capital and your partners who are laying the fiber in this case. How do you structure those for mutual benefit?
Well, I think one of the things that differentiates us from a lot of traditional private equity firms and capital providers. And in a sense, we're a capital provider and we're a capital solicitor as well, because we're raising institutional capitals and then capital, and then we're turning around and providing them to these operating businesses in a partnership. One of the things that differentiates us, both on the multifamily, the real estate side, the real estate lending side, and our private equity side, is our investment team has significant experience on the operating side of each of these businesses. So we understand our partners, what they're going through, the troubles that they're facing as they grow their business. We've been there. We've worked with operating businesses. We operate our own real estate. Our team has operated within operating businesses in the digital infrastructure and TMT space. So we can very much relate to the operating companies operating partners that we're teaming up with. And one thing that we look for is, and so we speak the same language in many ways, and one thing that we look for is we like to partner with firms where the original founding members of the firm are still heavily invested and still heavily active in the day-to-day business. We don't provide cash-out capital. We don't like to cash out operators and say, hey, now we're the new owner and we're coming in providing 90% and you're monetizing your position. We'll do that a little bit every now and then, but the vast majority of what we do is just providing pure growth capital. And what we do is we work very closely with the team to understand what they're looking to achieve with their growth plan. Are they looking to take this business from where it is today to grow it up, per their business plan and then exit the investment? Or are they looking to stay on board for a long period of time? Are they looking to do a management transition where the founding partners may say, this is my last hurrah, I'm going to grow the business and then I want to transition it to the existing management team? We'll work very closely with them to customize a solution that gets them and their team to where they need to be, and where there's a very clear alignment of interest, where our capital is coming in purely for growth, and if the business performs well, we perform well. If the business performs poorly, we obviously will suffer that investment also, but the management team is going to suffer just as much, if not more. And if things go really well, we'll do very well, and the management teams will do even better. And so we look for that alignment of interest. Again, we never want to be in positions where we're cashing out operating partners in our team. That generally does not create a great alignment of interest at all.
A similar question for you, Pratik. As you think about one of these niche areas that has the potential to expand into an institutional asset class, and let's take another one that I know you've got great experience in, car washes. Which, by the way, was fascinating for me to learn about and read about, because I never would have thought of car washes as a covered land play, but of course they are, and quite an interesting one. As you're thinking about the partnership with a team that could institutionalize that asset class, what are some of the tricks? Are you looking for somebody with experience in that space? Are you open to taking industry experts from another area? How do you flow incentives all the way down to the guys that are working at the individual locations?
Yeah, it's all of that. We do everything that Kevin mentioned. I think the other piece is we make sure that the alignment, the co-investment from partners is meaningful. In some cases, that could be they're putting in 20% into the deal alongside of us. Sometimes that could be 2%, but 2% can be meaningful to some of our partners, and so that's a big focus. And I think in the car wash space, we met a team that candidly did not have a long track record, if really much of a track record in the car wash space, but they had an interesting seed portfolio. They had great DNA to operate, we thought, from their prior backgrounds. But we actually went on an exercise to go see if we should find other talent. So we went to the National Car Wash Convention. We went to meet every broker and owner and operator that we could find in the car wash space. And what we found is it was made up of dentists, cardiologists, pilots, former brokers. There weren't experts, if you will, like you find in multifamily or you find in industrial today. So we had to effectively create the expertise in-house. We backed the two individuals to launch the platform, but our team was very involved. We had 3 board seats. We were hands-on, and as far as what pricing are we going to set for the car washes, how do we make this business more less risky. I think the biggest risk in a car wash business is weather. If it rains for a week, no one comes to wash the car. So how do we protect against that? And by the way, most of our washes, all our washes were in South Florida, where it can rain for a week. And so we sold subscription service. $30, come as much as you want, wash your car. When we bought this business, we had a couple hundred members. When we sold it, we had 120,000 members. And about 70% of our revenue was subscription-based. So we turned it into a gym. In many ways, I call it a gym, right? Where you come 5 times, then 4 times, and 3 times a month. Our average was like 2.8. And so, like these are the things that we work with our management team. We also bring in new talent. As we went from 4 washes to 20 to 40, then you need a CMO, then you need maybe a more established CFO, and you kind of augment the team. Our team drops in. One of my colleagues was effectively the CFO of the business for a couple months when we got a loan done on the platform. So, we do all these things both hands-on internally and try to augment the expertise or lack thereof, maybe, of our management teams. And in places like car washes, we found that you just have to do it yourself in many ways.
Sorry, one of the things that I love about my particular job is that I get to learn about car washes, and I also get to talk to CIOs about sort of the macroeconomy. And I think that's a great part of this industry that we're all in, is that you can see the whole world from your desk. On that, and I'll open it up to everyone for questions in a moment, so if you have any, please stand at the ready. But a quick question for you both. As many of the folks in this audience and online are likely institutional investors, you've talked about how you look for alignment with operating talent and what you look for in operating talent. But from your perspective, Kevin and Pratik, what makes for the best sort of institutional partner? Obviously, they have to be smart enough and creative enough to see the themes that you guys are seeing. But once they're in the door, how can they work with you to maximize shared outcomes?
Well, so one thing that we really like to see with our institutional investor relationships is a collaborative dynamic where we have regular conversations with our investors, and there's a nice back and forth sharing of information. We like that. We're very much a relationship-driven firm. Culture is massively important to us, and it's something that we spend an inordinate amount of time focusing on, and so we like to share that culture with our investors. So, a lot of times, not only are our investors investors that are also over time have become friends, and we establish a nice relationship. So I think just getting along well is hugely important, and there's a massive trust factor when you're investing with somebody or somebody's investing with you, and I think establishing that trust is hugely important. As we grew our business, when we started Post Road originally, we wanted to start the business as a diversified investment management firm, and starting a business and saying you're a diversified investment manager, people kind of look at you a little bit sideways and they say, well, hold on. How are you going to be diversified? Usually firms start with a single focus and grow from there. Well, we knew that we wanted to start out by building a diversified business. We wanted to create a stable business that, to the extent where look, we invest in the credit aspect, the credit side of the table, or equity side of the table. We have different duration investments. We have different investor profiles that invest with us. We wanted to create a very stable business that, through various points in the cycles, ups and downs in different industries, would allow us to keep our team together, to keep the organization stable, and in turn that provides insurance to our investors. And what we've been able to do, and I'll say, last year we announced Capital Constellation came in as a partner in Post Road Group, and as Daniel mentioned, Capital Constellation represents 12 of the largest institutional investors in the world, among 12 of the largest institutional investors in the world, and that is something where we have that partnership provides us a fantastic dynamic where Daniel, his team, Pratik, we have access to both Wafra's internal team. Wafra manages Capital Constellation, as well as the Capital Constellation relationships. And it's a dynamic that is very much symbiotic in many ways. Culture-wise, we're a very good fit for them. They're a very good fit for us. We get along really well. It's an opportunity where we saw a tremendous growth, a tremendous line of growth in partnering with Capital Constellation. And so that's the dynamics of that relationship are something that we look for in all of our relationships.
I like the simplicity of how you put that, of just being in conversation. The three of us were all together this past summer in Stockholm, along with those 12 investors hosted by the Swedish National Pension System. And in these days, you can get trillions of dollars of AUM to sit in a single room. I'm sure that's happened today, right, here at the Greenwich Economic Forum. And the question is, how do those investors access opportunities through partnerships? And really, at the end of the day, it's not more complicated than, most people, the first question they ask is, what should I buy? And the second question they ask is, how much should I pay for it? I think the first question that you should usually ask is, who can I trust? And if you get that one right, the other two follow suit. So I agree with just communication as a key. Let me just, speaking of communication, if there are any questions, yes, sir.
We've obviously had a golden period of capital, right? Low rates, lots of excess capital in the system. And normally the capital would spread out to the fringes into your areas, right? And I don't want to sound negative in the question here, because I think there's as much risk in the core as there is in the fringes, arguably. But if you, for example, had a strategy which was just dealing in land, you get a lot of volatility in the pricing through cycles because there's lots of optionality. In your strategies, do you warn institutions about the volatility and valuations through the cycle because of the nature of what you're doing? And there's a sort of sub-question of that, which is, what do you say no to? Because that seems like one of the most important things in the spaces you're working on. Could you just give us one example, something where you just walked away and said, I'm getting out of this, and it might give us a sense for the way the cycle's played out in your areas? Thanks.
Yeah. We talked a little bit about macro trends, and so one of the trends we've followed is on the last question there on the aging population in this country, and how does that impact real estate? It's been a common theme that senior living is a great. I think the prior panel was about healthcare, right? But the senior living is a great way to play that trend. That's something where we've actually said no to. I've probably looked at 40 different deals in senior living, from the active adult plays through skilled nursing facilities and everything in between. But why do we say no? There's a lot of labor issues in that market and have been. By the way, this is pre-COVID. COVID obviously created complications, but pre-COVID we were no, because of labor, regulatory overlays. There was a lot of supply, easy to build in this market. But the macro trend is still there, right? There's still very much an aging population in this country. The baby boomers need care. So how do we play that? We went and partnered in the medical office space with one of the largest public healthcare REITs, and bought medical office. We had a view that we wanted to be in a medical office. The delivery of healthcare is less in core centralized hospitals and now a hub and spoke model. We can get investment grade tenants, great health systems that are very well capitalized. And oh, by the way, to your first point, 99% of all medical office tenants paid through COVID. It's essential real estate. You look at the traditional office space, there are buildings where 0% of the tenants paid during COVID. And so you look at all medical office, and why is that? It's essential real estate. People have to get care, especially if you buy the medical office, you want to buy the medical office buildings that are also, that have MRI machines, that are specially fit out, there's a lot of capital that's been invested, versus the medical office that I call more retail-like, the city MDs of the world, where, or the doctor's offices where there's lower switching costs. So even when you get into it, you want to buy right, but there is ways to play these trends. And I think across everything, we've mentioned car washes, data centers, medical office, kind of sounds like a pretty wide funnel, but I think through all that, we view these to be recessionary resistant asset classes. You look at SFR over 3 decades, it's never had a down year in rent growth over multiple cycles. And so, so I think across this, it's essential real estate, it's recessionary resistant in many cases. Self-storage is another example, right, that in downturns does really well. And so, we think that there are common themes that we target, and the themes may tell us no to some asset classes, but yes to others.
I think we have time for just one more question. Yes, sir.
So I love your strategy. Obviously, you can buy at a high cap rate and then flip to institutions at a lower cap rate and make an attractive return in the meantime. Is there an issue, as you're looking for niche strategies, is there an issue with size. I mean, a lot of these institutions that you mentioned are looking for large tickets as opposed to, you know, a startup that might be, you know, car washes. Your first investment might be just, I don't know what, $100 million. How do larger institutions actually participate in what's a smaller niche play?
Yeah, I can speak to that briefly from the perspective of institutional allocators and the groups that we partner with, who then in turn make allocations to these strategies, and then we'll say thank you and exit stage left here for the next panel. I think the key is that many of these strategies, while they might start off as just the grain of sand around which a pearl forms, have the potential to grow very large. So if you look at what Blackstone did in SFR 1.0, you know, it's a $10 billion market cap strategy across 4 of their funds. No reason to expect that many of these asset classes can't grow to be truly institutional and become what data centers were 10, 15 years ago, what senior living was, become a new institutional asset class that has to be held. And so I think the challenge from an institution standpoint is, you know, where is it necessary to partner with talent, and where can you do it alone? I think uncovering niche opportunities before the flood of capital turns them into truly institutional opportunities is a way for institutions to differentiate. But to do that, you have to go on that value chain between capital and talent. You have to figure out ways of partnering. And I think that's something we've strived to do with Kevin and his team, with Pratik and his team, in terms of directing institutional capital into aligned partnerships with talent and then ultimately with underlying operators. So, with that, thank you so much for at the end of our time, but I really enjoyed this, and always great to be back at the Greenwich Economic Forum.
Thank you.
We're going to take about a 30-minute break. Please come back by 4:40. We have Andrew Yang coming to present, so be sure to get here on time to hear our 2020 presidential candidate. Thanks so much.
Ensuring a bright, bold future means investing in tomorrow, today. And Apollo is at the forefront. Our capital is helping to solve some of the world's most complex problems by securing retirement for millions of families, building and financing stronger businesses, and driving a more sustainable future for our communities. Bridging our economic present to our future. Empowering people to retire better, from teachers to firefighters and other essential workers, Apollo is creating retirement solutions for millions of families. We're investing across sectors and geographies to create jobs and support local communities, and partnering with businesses large and small to fund their growth and enable transformation. As we look to new generations, we are committed to making progress and to developing a more sustainable future as a leading capital provider accelerating the energy transition, from development to production, all the way through to consumption. Building a better future also means expanding opportunity across our ecosystem. It means deepening our relationships, broadening our network, and developing new connections every step of the way to better serve our investors and our communities. Through it all, consistently challenging convention, sparking new ideas, and fueling innovation. At Apollo, we are investing in tomorrow, today.
Empowerment. Since 2017, Surfin Group has invested across 3 continents, which are Asia, Latin America, and Africa, with 20 million users in 8 countries and a total transaction volume of over $2 billion. Surfin invests digitally. Surfin Group focuses on digital investing to empower financial services and asset management globally. Surfin Group processes and develops tens of terabytes of data, hundreds of big data models, millions of feature vectors, millions of effective product models, and asset allocation portfolios. Surfin has global risk management experience. Surfin Group delivers risk management expertise in global asset allocation and investment. The investment and technology can be efficiently married by individually matching of dynamic asset allocation portfolio based on big data and personalized efficient frontiers, integrated with multi-asset classes, multi-trading frequencies, and multi-strategies through risk parity allocation. Personalized and diversified portfolios can be constructed to provide scalable asset allocations and across various market cycles. Surfin Group also develops a fully functional and convenient digital integrated wealth management platform across borders and different markets, which can provide middle-class customers with digital smart financial services, including news and information, user forums, investor education, investment advisory, and financial planning services to enhance global investment experiences. Surfin Group develops 4 proprietary core technology systems that enables real-time online accessing, multi-ethnic group matching, and global multi-country servicing. Intelligent Risk Appetite System, EKYC System, Big Data Behavior Analytics System, AI Smart Voice System. Surfin Group looks forward to seeking mutual benefit and win-win cooperation with various partners to develop an ecosystem to invest in emerging markets. Surfin Group has always been persevered, persistent, and passionate. Surfin shall stay focused and strive to serve more global investors with digital technologies and making life better with smart, open finance.
Companies of all sizes rely on us for world-class, less-than-truckload freight transportation. We handle our customers' freight as if it were our own, moving it across North America on a coast-to-coast network that covers 99% of all U.S. zip codes. When freight is put in our hands, it gets where it needs to go, safely and on time. Our customers are growing, and we are too, expanding our footprint and fleet and certifying more truck drivers at over 130 XPO driver training schools. And we're constantly enhancing our technology, creating new network efficiencies to ensure a world-class LTL shipping experience from pickup to delivery. With industry know-how, local knowledge, and the hunger to keep improving results, when you ship with XPO, you'll find that our people are committed to your success. XPO, your freight first.
Over 250 million young people are not in education, employment, or training. But how you start in life shouldn't determine what you do in the future. In the last 3 years, Future Makers by Standard Chartered has supported more than 650,000 talented young people from low-income communities, transforming lives by empowering them to learn, earn, and grow. Because where others see problems, we see potential. We're Standard Chartered, and we're here for good.
What if you could invest in private equity, real estate, private credit, even art, with clarity, confidence, and help when you need it? Meet YieldStreet, the leading platform for private market investing. We believe that private market alternatives like real estate, private credit, and art should be a fundamental part of your portfolio. In fact, investment professionals recommend allocating at least 20% of your portfolio to alternatives. So how can alts create a more efficient portfolio? Versus traditional investments, alts reduce risk while maintaining your expected returns, or maintain your risk level while potentially improving your expected returns. We talked to actor and former White House staffer Kal Penn to help explain private markets.
If you're watching this video, it means you've been wondering, what are alternative investments? And why are all your savvy investor friends talking about them? Or maybe that's going to be you right after this video. So, alternative investments are basically anything beyond the stock and bond markets. You're probably most familiar with real estate. I know I love places. A beautiful resort. Or maybe just an office far away from your perfectly behaved children. There's also private equity, venture capital, and a few more that aren't as mainstream, like art and crypto. Basically, lots of cool things to discover. When you put alts in your portfolio, you're helping to ensure that you have investments that don't always follow the ups and downs of the stock market. Yup. Here we go again. That, my friends, is called diversification. In addition, people like alternatives because they can generally outperform the stock market. So, how can you get started? Before YieldStreet, you probably would have had to pony up $1 million and tie it up in a single investment. Yikes. But now, the potential of private markets is at your fingertips.
Thanks, Cal. With $3 billion invested on the platform and almost $2 billion in principal and returns paid to investors, and 9.6 realized net annualized returns, isn't it time to diversify away from the stock market? Invest in curated private market alternatives from top managers, all on one easy-to-use platform. Evolve your wealth. YieldStreet, private market investing.
MFA exists to serve and represent the private fund industry, and we do this through advocacy and convening our members to address key business and operational issues.
And so the MFA is a phenomenal partner of resources and peer groups and forums that comes together.
And this ability to bring people together is just so important because it just makes me better, it makes my team better.
What the MFA does is the MFA sits firmly in the middle and is ensuring that as they take the inputs from the regulators, take the inputs from the policymakers, and then take the inputs from the manager, that feedback loop that they're bringing is going both ways.
If we have a growing and active membership, that provides MFA in the industry with more resources, more credibility to better advocate for those policy outcomes that support the industry's growth.
So when you join it, you're not joining an association, you're joining a group of peers that have common interests and really want to help you succeed.
There's no downside. It is truly all upside when you become a member of the MFA.
Surfin with waves of digital financial technologies. With the rapid development of digitalization and globalization of financial markets, Surfin has always been driven by digital technologies to invest globally. Surfin Group specializes on two major areas: digital finance and technology empowerment. Since 2017, Surfin Group has invested across 3 continents, which are Asia, Latin America, and Africa, with 20 million users in 8 countries and a total transaction volume of over $2 billion US. Surfin invests digitally. Surfin Group focuses on digital investing to empower financial services and asset management globally. Surfin Group processes and develops tens of terabytes of data, hundreds of big data models, millions of feature vectors, millions of effective product models, and asset allocation portfolios. Surfin has global risk management experience. Surfin Group delivers risk management expertise in global asset allocation and investment. The investment and technology can be efficiently married by individually matching of dynamic asset allocation portfolio based on big data and personalized efficient frontiers, integrated with multi-asset classes, multi-trading frequencies, and multi-strategies through risk parity allocation. Personalized and diversified portfolios can be constructed to provide scalable asset allocations and across various market cycles. Surfin Group also develops a fully functional and convenient digital integrated wealth management platform across borders and different markets, which can provide middle-class customers with digital smart financial services, including news and information, user forums, investor education, investment advisory, and financial planning services to enhance global investment experiences. Surfin Group develops 4 proprietary core technology systems that enables real-time online accessing, multi-ethnic group matching, and global multi-country servicing. Intelligent Risk Appetite System, EKYC System, Big Data Behavior Analytics System, AI Smart Voice System. Surfin Group looks forward to seeking mutual benefit and win-win cooperation with various partners to develop an ecosystem to invest in emerging markets. Surfin Group has always been persevered, persistent, and passionate. Surfin shall stay focused and strive to serve more global investors with digital technologies and making life better with smart, open finance.
Ensuring a bright, bold future means investing in tomorrow, today. And Apollo is at the forefront. Our capital is helping to solve some of the world's most complex problems by securing retirement for millions of families, building and financing stronger businesses, and driving a more sustainable future for our communities. Bridging our economic present to our future. Empowering people to retire better, from teachers to firefighters and other essential workers, Apollo is creating retirement solutions for millions of families. We're investing across sectors and geographies to create jobs and support local communities, and partnering with businesses large and small to fund their growth and enable transformation. As we look to new generations, we are committed to making progress and to developing a more sustainable future as a leading capital provider accelerating the energy transition, from development to production, all the way through to consumption. Building a better future also means expanding opportunity across our ecosystem. It means deepening our relationships, broadening our network, and developing new connections every step of the way to better serve our investors and our communities. Through it all, consistently challenging convention, sparking new ideas, and fueling innovation. At Apollo, we are investing in tomorrow, today.
Surfin with waves of digital financial technologies. With the rapid development of digitalization and globalization of financial markets, Surfin has always been driven by digital technologies to invest globally. Surfin Group specializes on two major areas: digital finance and technology empowerment. Since 2017, Surfin Group has invested across 3 continents.
Do you know where? Okay, get everyone's attention. Coming out from the beautiful weather today to have one more session. It's someone who actually needs no introduction, but I'll do it anyway. It's Andrew Yang, the 2020 presidential candidate and founder of the Forward Party. Andrew, welcome.
Hey, Greenwich, what's going on? How are you? Oh, look at this. I don't even need the podium. Hey, everyone. Great to be here in beautiful Greenwich, Connecticut. I brought the good weather. So I grew up not that far from here in Westchester County. How many of you did that too? I bet there's some Westchester folks here. Yes. So growing up in Westchester, my parents were never like, you're going to run for president someday. In case you hadn't noticed, I am Asian. So it was more like, clean your room, get good grades, try to get a good job. So I did some of those things. I went to law school in New York City at Columbia, not that far from here. Then I did a bunch of things in the startup sector before starting a nonprofit called Venture for America in 2011. How many of you volunteer or work at a nonprofit? Or donate to a nonprofit? Let's try that. So that's, are you a good person? So you really should just pretend and raise your hand to that one. So but please do take note of the people that didn't raise their hands. I mean, like, are we not at the Greenwich Economic Forum? Is this not like the enlightened group of investors? So nonprofits run on two things, passion and money. And running that nonprofit for those 6 years was an incredible growth experience. And during that time, I traveled the Midwest and the South, parts of the US I had not been to a whole lot at all. How many of you actually grew up in the Midwest? The South? West Coast? Tri-state area like me, or like the East Coast, yeah. So I had not been to Missouri, Alabama, Louisiana, Ohio, a bunch of places that, frankly, have been suffering over this last number of years from a number of economic forces, primarily automation and globalization. So I saw the aftermath of the automation of millions of manufacturing jobs during those years, and I was stunned. But I was still even more stunned when Donald Trump became our president in 2016. You all remember that night? You were like, but all the smart people I subscribed to, all the data said Hillary was going to win, and then Trump won. And having spent all those years in the Midwest and the South, I thought I had some insight as to why Trump won. It is that we had eliminated those 4 million manufacturing jobs that were primarily concentrated where? Michigan, Ohio, Wisconsin, Pennsylvania, all the swing states that Donald Trump needed to win and did win. And those of you who work in investments or tech know that what we did to manufacturing jobs, we are largely going to do to a number of other job sectors throughout the US economy. All right, pop quiz. What percentage of Americans graduate from college? Somewhere in the middle of these guesses. It's about 35%, so 1 in 3. What are the 5 most common job categories in the US? I wish it were a teacher. So in terms of industry, so just that, truck driver is number 4. Trucking and transportation is number 4. Remember, we're a country that's 2/3 high school grads. So think, what are high school grads doing? Retail is number 2. Clerical. Your kids believe that to be true, unfortunately. Mine too. So number 1 is clerical and administrative, which includes call centers. Number 2 is retail. Number 3 is food service and food preparation. Number 4 is trucking and transportation. And number 5, believe it or not, is still manufacturing. What proportion of American jobs falls in one of those 5 sectors? About half. 49% of American jobs fall in one of those 5 sectors. And you know that we're going to be reducing the workforces in all of those sectors over time. How long do you think it's going to be before Google's AI can do the work of call center workers? 4 days. Whoever said 5 years, I don't know about that one. I mean, I think 4 days is closer to the mark. There are about 2.5 million Americans right now who work in call centers making on average $16 an hour. So let's say Google's AI comes online, starts doing that work, what jobs do they do? So that's an obvious one, but there are dozens of inobvious ones that are ripping through various organizations, including financial services, where if you rewind a number of years, what were there? Trading desks, people yelling, screaming. What is it now? Server rooms, hums, techies administering to it. And these are high-end jobs in the financial services industry. So the economy is transforming in various ways that are putting more and more people, particularly men, on the sidelines. And those are some of the forces that got Donald Trump elected in 2016. Those forces are getting stronger, more powerful. So this is what I saw and unpacked during 2017. And that's when I decided to run for president. And when I decided to run for president, my friends and colleagues said, because it was a very unlikely endeavor at the time. It said the United States of America, of course. And then proceeded to make 7 debate stages, raised $40 million, became a media figure on CNN and other places. So we achieved a level of success in terms of trying to mainstream some of the big ideas around automation and the fourth industrial revolution. But when I came off the campaign trail in 2020, I did not feel victorious, in part because I didn't win. Though I will confess to you all, I didn't actually believe I was going to be president of the United States, like that. But though when the reporters asked, it's like, are you serious? And you have to be like, So I felt dejected and despondent about the trajectory of American politics, which I suspect is the way many of you feel. Is that correct? Yes, right? So I'm going to guess that most of you we're going to call business people. and business people tend to be very despondent about the direction of American politics. Why? Because it doesn't make sense the way your businesses make sense. Like, I've run a private company. That's what I did before I started this wholesome nonprofit, by the way. I ran a private education company that became #1 in the US and was bought by a public company. And I still fondly remember those days running that business because everything made sense. You know what I mean? Like, when you're in that business corporate setting, the numbers have to match up, you need to make a certain amount, and then if something doesn't make sense, you end up reducing and getting rid of it over time. Our politics now do not make sense unless you understand just how deeply dysfunctional our incentives are. So here's where I get some more numbers into what I figured out in 2020 after I came off the trail, why we all feel so negatively about the nature of our politics. What is the approval rate for US Congress right now as we're here together? I'm anchoring you low. It's pretty low. What do you guys think? Between 20 and 28%. So let's say 25%, 3 out of 4 Americans don't like what's going on in Congress. What is the re-election rate for individual members of Congress? 94%. For you sports fans, it's a better win rate than the Jordan-era Chicago Bulls. And the challengers are, let's say, the New York Knicks. I'm a former Knicks fan. So let's imagine you were running a business and 3 out of 4 of your customers were unhappy, but nothing changed. Like what would happen over time? The customers would start freaking out. They'd be like, why the heck isn't anything changing? Now, why do you have such a high re-election rate for individual members if people are so ticked off? The answer is that 90% of the congressional districts around the country, including, I'm sure, the one you live in, or there's a 9 out of 10 chance this is true, is uncompetitive in the general election because it's been drawn to be uncompetitive. It's either blue or red. Raise your hand if you live in one of these districts where you know it's going to be a Democrat or Republican that represents you. That's most of us. For most of us, it's foreordained which party wins. So if that individual legislator is going to lose their seat, how are they going to lose their seat? They're going to get primaried from within their party. They can't lose to the other party because the district's non-competitive for in the general. So the only way they can lose is if the people in their own party decide to kick them out via primary. Now I want you to imagine who the most hyper, extreme, rabid partisans are on each side of the aisle. If you've got, you know what I mean? So that is who you're answering to in order to ensure your job security. This system will actually make it so that a reasonable person gets unreasonable pretty quick. Because if the only way you keep your job is by placating and pleasing the 10% most extreme folks in your district, then you start acting irrational or unreasonable to the most of us. To the rational business person, you're like, what the heck is going on? Until you realize that the system is setting us up this way. So you have their re-election reliant upon what only the 10% most extreme want, and then you have our media organizations separating us into ideological tribes. How many of you don't know where to turn for news nowadays? You're laughing because it's true. Because now, at this point, each media outlet is chosen a side. By the way, that's now their business model. And then you have social media pouring gasoline on the whole thing. So in this system, are things going to get more polarized or less polarized? Of course, they're going to get more polarized, and where's it going to end? Civil war, genuinely. Bloodshed, strife, ruin, dysfunction. A senator said to me that An issue is worth more to us unaddressed than addressed. Think about that for a sec. If it's unaddressed, then they can say, hey, it's their fault. They can get money. They can get energy. They can get votes. If they reach across the aisle and try and compromise, what happens to them? They get shivved and challenged from within their own party as ideologically impure and willing to work with the other side, and then they lose their seat. Of the 10 Republican House members who voted to impeach Donald Trump, how many of them made it through the primary? 2. You know, do you think the other members didn't notice that? So this is how we're being set up. We're being set up to fail, and it's not going to change unless you can actually realign the incentives. Now, I'm happy to say, Greenwich, there's a real-life way to fix the incentives. You know, like I could not come here without an actual solution. So raise your hand if you have heard of Senator Lisa Murkowski in Alaska. Raise your hand on that one. Raise your hand if you've heard of Sarah Palin. All right. So what happened last month to Lisa Murkowski and Sarah Palin was a product of a new process they adopted in Alaska in 2020, where they did away with party primaries and said anyone can vote for anyone of any party, and then the winners get chosen through something called ranked choice voting. Now, what this does is this makes it so that whoever wins doesn't just have to get through their party primary and make the 10% happy. They actually have to appeal to the general population and get 51% of voters. How many of you think that that would actually dramatically change the incentives of the legislators, right? And you saw it, Lisa Murkowski, only Republican senator who voted to impeach Donald Trump, who is up for re-election this fall. Her approval rating among Alaskan Republicans went down to 6%. They really don't like it when someone turns on Trump. But she made it through her primary because there was no Republican primary. It was just essentially a general election and ranked choice voting. So the goal is to try and change the incentives around the country the same way they did in Alaska, so that instead of having to hew to the most unreasonable 10%, they have to make 51% of Americans happy. What do you all think, Greenwich? Now, this is not my idea. This was originated by a guy named Michael Porter and a woman named Catherine Gale at a Harvard Business School in a book called The Politics Industry, where they said, why is politics so broken? And they said it's so broken by design. It's designed to break us. And the only way to fix it is to fix the design. The Alaska shift to nonpartisan open primaries and ranked choice voting cost $6 million. I'm going to suggest to you all that's a steal of a deal. You know what I mean? The same ballot initiative is right now on the ballot in Nevada. And that one, where we, the global we, are putting in $17 million to make the same switch. Now, Nevada right now is run by Democrats. How do you think the Democrats in Nevada are reacting to try and do away with a closed party primary and replace it with open primaries and ranked choice voting? They love it. No, of course they don't like it. Pretty much whoever right now is in charge of a particular area won't like it. Why? It loosens their control. It makes it so that new entrants can actually emerge. It makes it so that they're actually accountable to voters, which they never wanted. Like right now they have it figured out. It's like, look, I just keep you happy. The Democrats, the teachers unions, Republicans, it's different people. And as long as I keep you happy, I'm in office forever. Now this new loosening up changes those incentives and it unsettles them. So the Democrats in Nevada are saying, no, 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 can't do this. And you know what their argument is? It'll be too confusing for voters. No? I don't know about you all, but I've got 2 kids, 9 and 7, and they can count 1, 2, 3. They can like rag things in order of their preference. So the Forward Party, which you've probably seen some news about, is a new third-party effort to try and restore the incentives in our political system to line up with what most of us want, which is leaders who are actually rewarded for getting things done and compromising. But the way to do that is to not only back reasonable candidates from within the parties, but to change the incentives state by state, district by district, so that legislators actually get rewarded for doing the right thing as opposed to the right thing by only the most rabid or extreme 10%. Greenwich, things will just continue to spiral out of control unless we fix the underlying structural deformities that are turning us against each other. That is the only way out. So we started the Forward Party about a year ago, and I'm happy to say that as I'm addressing you today, We are already the third biggest party in the country by resources. What do you all say? You know? And we've already grown to this level, in part because tens of millions of Americans want this. They want the tribe of reason and pragmatism and problem solving, but it's also because business leaders like yourselves get it. You get that you would never let your companies and organizations run on this bizarre set of incentives that ensure division and polarization and conflict, and that we are going to have to stand up, invest time and energy and resources, gather our people together, our tribe, and make this case to the American people. So this is the work I've been doing over this past year. I'm happy to say that we're getting world-class investors like yourselves, including some people who are speaking here at the Greenwich Economic Forum, on board, and we may be in position to have an impact on national policy as early as January of next year. We've endorsed 30 candidates around the country. This Nevada ballot initiative is a very big deal and would absolutely love your help in getting this country we love back on the right track. And now I'm going to take some questions from you all. What do you all think? John Bellomini, what's up? Not a plant, though he's about to ask me how I became so smart and handsome. Go ahead, John.
What I will say how do you deal with the 51% issue, the 51% not being influenced by the media, which you just called corrupt? So if you take away those structures, then the media will then just tell the people what to do, and then they'll just vote. How do you fix that?
Yes. So one of the things we have to do, in my opinion, is invest in and build more independent media sources that are non-ideological and willing to play it straight. Some of you are thinking of particular media sources that you trust. Actually, let me poll you all. Like, what are sources that you do trust? Or I'm going to take it a step further, individual journalists that you trust. You willing to share? CNBC, I think, plays it pretty straight. You know who else I think plays it pretty straight? Bloomberg. Bloomberg is pretty up the middle. NPR, some would agree with you, for sure. I like The Atlantic. There are various independent journalists. I like Barry Weiss, I'll say that too. So what we have to do is build a constellation of nonpartisan independent voices that actually can fill that gap and that role. The fun thing about building this new party is that you wind up having to build each element of it. So you start with, let's say, a volunteer base of tens of thousands in all 50 states, which we have. And then you have candidates, and then you need media outlets, you need influencers, you need celebrities. Like pretty much all the things that the traditional parties have, like we're now filling in. I'd say it's one of the most fun entrepreneurial challenges anyone can be associated with. Yeah, like I'm with you, John, that you need some kind of media voices to augment the narratives. Thank you.
Great job.
Thanks, man.
Curious about what do you think the influence Elon Musk will be on Twitter if he actually closes the deal?
So everything Elon has said is that he's going to err on the side of free speech and freedom of expression, which probably means letting Trump back on. It probably means different standards for what gets you suspended on Twitter. So that's the expectation. I would take Elon at his word and expect that that's probably where he's going to go. We're going to all find out together how that impacts Twitter as a business. I do think that Twitter is going to change a lot of its tools to resemble TikTok and some other places that have a higher level of stickiness and virality for advertisers. So that's going to be a mixed bag, in my opinion, as someone who unfortunately has a TikTok account. Don't judge. I'm a public figure. Your kids like me. Sir.
So under this new regime, if it, say a lot of states adopt it, right? how important is party affiliation at that point?
What do you all think the ideal number of political parties is in the United States of America? So John just shouted out 5. So some would say 0, but 0 is not feasible or practical because you need some kind of organizing structures. I'm going to suggest that 1 is out. you don't want 1. If you look at the founding fathers, they were anti-partisan. George Washington warned against them during his farewell address. John Adams called them an evil across the land. James Madison said you need factions that shift and flow as opposed to ones that will just clash and clash. So in my mind, if you rule out 1 and 0, 2 is pretty much the third worst number you can be at, which is like the clashing polarization. Right now, 42% of Democrats think that Republicans are morally corrupt and a threat to the country. And guess what? It's the same percentage in reverse. The same percentage of Republicans think Democrats are morally corrupt and a threat to the country. It's tearing apart families, friendships. One comparison I make is that imagine a sports league where there were only 2 teams. How would the fan bases feel about each other over time? You know, you'd like really hate that other team. So in an ideal world, Pavel, in my view, the current Democratic Party is 2 parties. You kind of know what they are. Then the current Republican Party is 2 parties. You kind of know what they are. And then maybe you have a 5th party in the middle. Let's call it Forward. And then you could argue for a 6th party on one side or the other. And in that system, you'd have a lot more rational incentives because instead of just blaming the other side, you'd actually have to say, look, I have to work with someone to produce something. It also makes you much more resilient to authoritarianism because this 2-party system is very susceptible to authoritarianism. On either side, if one party gets control, then everyone's incentives are to fall in line, and then before you know it, there you are. Whereas if you have even 3 parties, then that gets much, much tougher. So the question really is how the heck do we get off of this dysfunctional 2-party system? We're starting with a 3rd party to try and create these open primaries and everything else. But if you had a truly open dynamic system, ideally you'd wind up with, in my view, 5 parties or more. Sir.
Hey Andrew, big fan. Thank you so much for being here. My name is Partop, also from Westchester, also went to Brown, also work in tech. I'm curious, like, I was really rooting for you, and I'm wondering, how can you get American voters to embrace diversity, given that historically they haven't been so welcoming in diversity?
It's a great question. Thank you for the support. I spent a lot of time in the Midwest and New England. I actually also went to high school in New Hampshire at Phillips Exeter Academy. And when I was on the East Coast, people would ask me all the time, it's like, hey, did you experience a lot of racism in other parts of the country, Midwest, South, where I traveled and worked for, at this point, 8 or 9 years? And I would say, honestly, I experienced little to no racism in those parts of the country. And that's surprising to some. But if you've been through those parts of those country yourselves, like you might be able to relate and understand. There's, right now, one of the dividing lines in American life is whether you view our plurality as something that's intrinsically American or whether that, like, we're emphasizing other parts of your identity above your quote-unquote Americanness. And I think that in a healthy society, you can respect each other's differences and embrace and be proud of your own heritage while also saying, look, we have to make common cause around things that we might not agree with on one front, but then we can start working together on these other things. I still very much believe in Americans' ability to embrace people, leaders, representatives from different cultures and backgrounds, in part because I've lived it. My campaigns haven't been particularly focused on the fact that I'm Asian American. And it could be because, like, I'm thinking about some of these bigger structural issues. But I think it's pretty obvious I'm Asian. You know what I mean? So I remain optimistic myself on that front, in part because you really don't have a choice. Like, if you don't lean into that optimism, then where do you land? I'm going to share a joke. How many of you guys know the comedian Ronnie Chang? Some of you do. So his joke is that Asian Americans have to be the referees in the race war in America because we can't make either team. So that's, that's a joke, but there was an element to it that I think is actually playing out with Forward, where when you think about people that are pragmatic, moderate, rational, data-oriented and whatnot, I think that overlaps with business leaders, with techies like ourselves, but I do think that actually overlaps with Asian Americans pretty heavily. So I think there is this really important role for our community to play. Yes, sir. Is this not fun? Are we saving the country? Have we fixed democracy yet?
This is a lot of fun. This is a lot of fun. What you say makes a lot of sense. I mean, we're all rational thinkers in this room, and it just makes absolute sense. The question I have is, given the inertia in the institutions in each state and around the country, can this change happen fast enough to address what we've been hearing about for the last 2 days, the $31 trillion of debt that the country has put on, and no one in the current structure can really address? Can this happen fast enough?
All right. How many of you have heard of a Senate candidate named Evan McMullin? All right, this is going to be good fun. Check it out. Evan McMullin was a CIA operative for 11 years in the Middle East. Comes back, goes to Wharton Business School, works in business, and then sees that Donald Trump becomes a Republican nominee and is like, oh no, this is terrible. Goes around trying to recruit someone to run for president as an independent against Donald Trump. Cannot find anyone, and then people say to him, Evan, you should run, and he's like, oh no, am I going to have to do this? So he decides to run for president as an independent and gets 21% in his native Utah. He's Mormon, and he's from Utah. He starts an organization called Renew America that merges with the Forward Party this summer, but during that time, he became a US Senate candidate in the state of Utah for this cycle in November. Running as an independent, says he will not caucus with either party. So you're like, okay, mildly interesting. Why is Yang spending so much time on this? He manages to talk the Democratic Party of Utah into not running a candidate. This is a state that Trump won by 21 points. If the Democrat runs, the Democrat will lose assuredly. If the Democrat and the independent run, they both lose assuredly. But the Democrats decided not to run a candidate. So now the bet is the 39% of Utahns who voted for Joe Biden, are they going to vote for the independent Evan McMullin or the Trump-endorsed incumbent Mike Lee, who was texting with Mark Meadows on January 6th being like, how can I help? How can I help? So let's say the 39% of Utahns who went for Biden decide to go with McMullin. The question is, can Evan McMullin peel off 12 of the 59% who voted for Trump? And the biggest signal is that Mitt Romney, who sits next to Mike Lee in the US Senate, has said, I like them both. I am not going to endorse. Thus giving permission to all of the Romney moderate Mormon Republicans of Utah to back Evan McMullin. And the latest poll came out saying that Evan McMullin is up by 1. Mike Lee is freaking out enough where he's like enlisting Ted Cruz and the rest of it, and they're raising millions to fight off a challenger in a state that Trump won by 21 points. So let's say that Evan McMullin edges out this race. And if you're interested in this, please do donate to Evan McMullin. I am heading to Utah this weekend to campaign for Evan. Let's say Evan McMullin wins his race and he becomes a US Senator in January. How many US Senators does it take to impact or influence or even control US policy? Maybe just 1, right? You know the Joe Manchin effect? They couldn't do anything and Joe Manchin's like, hey, what are you gonna do? Let's say Evan McMullin is vote number 50 on one side or the other, and they're like, hey, we want to get this done. Evan can be staying there. Let's say Evan McMullin is joined by 1 other senator. You could have 2 centrist independent senators control all of US policy, which could include trying to get our mega debt under control, not in some far off future, but January of next year. So this stuff is on the table right now. People are like, oh, third party, pie in the sky, Ralph Nader, blah, blah, blah. Like, no, you gotta like look at the actual races and the facts. And when you dig in, you see that we could be in position not just to be the third biggest party in the country by January, but in the driver's seat. What do y'all think? Yeah, well, so one thing you probably sensed about me, given that I ran for president, but I'm not exactly like a super patient guy. You know what I mean? I mean, like the country's on fire. Like, you know, let's go get the fire extinguisher. Anyway. I could do this all day. Doug. Oh, I got to go do Bloomberg interview? Oh, sorry, whatever. No, Doug, let's do it. Then I gotta get out of here.
Okay, thank you. We'll just be quick. You touch upon a very important element for any well-functioning democracy, and that's education. What are your views on the current state of education here in the United States, and is there anything that you would be doing about that?
So, Doug, this speaks to the dysfunction of the two-party system. Right now, we're about 30th in the world in public education, and declining. And so you say, like, well, how can that be? And the fact is, in the vast majority of our communities, there is no meaningful political competition. Let's say you live in New York, where I do, Democrats run things, your schools underperform, it's like, what are you gonna do? You know, the same is true in like, the rest, oh, it's true. So the two parties have essentially carved up the country and said, you take that, we take this, and then locked down any competition. So if something's working or not working for our kids, our communities, like whether or not they have good outcomes, it's irrelevant to our political leaders. That's what you need the Forward Party to help change, where if in New York, where I live, being a Republican is a non-starter. But if you were to do the Evan McMullin play in reverse and you had like a moderate centrist figure, the Republicans don't run someone, then can they contend and win? Or at the minimum, put pressure on the incumbent party to actually have to do something? Yes. So if you're disappointed in the state of American education, which I am too, this is how we change it. If you all want to help, please go to forwardparty.com. You can check out Evan McMullin. My email address is andrewyang@gmail.com. Feel free to reach out to me, but let's build a future we'll actually be proud to leave to our kids. It's up to us. Thank you all so much.
Well, if that isn't inspirational, I don't know what is. There's a hope for our country, I think, with people like Andrew. So we are 3 minutes away from cocktails. I'm always in the place of between cocktails and a speech, so I will keep it short. But we want to hear very quickly from Glenn from Huawei. We did a fascinating conference, a sub-forum on globalization at the Harvard Club in New York City a few months ago. And Glenn and his team did a wonderful job of really helping us set the stage of what's going on geopolitically, what's going on between the different countries in the world, and how we can deglobalize in a way that's actually meaningful, and will actually put the world in a better place. Glenn just wants to say a few words, and then we'll go to cocktails. So Glenn? Huawei is our cocktail sponsor, so this is why he gets this spot.
Thanks very much, Jim. It's a great honor for Huawei to be associated with this event. Thank you. Thank you very much. We recognize Greenwich Economic Forum as a very important body and voice for the investment industry. Investment makes possible so many achievements and progress in society and around the world, including the magic and marvel that digital communication brings to us. So Huawei, if you haven't heard about us, we're a company which connects people with technology. We operate in 170 countries around the world, and our networks serve more than 1/3 of the world's population. What keeps us moving forward is not just a collective instinct to keep the company going and surviving, but never giving up. What keeps us going really is the power of connectivity. To connect people and places digitally so that lives can be better, more prosperous and better informed. So thank you, Greenwich Economic Forum, for allowing us to connect here with your members and delegates. And thank you for hosting this forum or event, which really enables the sharing of insights, wisdom, and ongoing prosperity. Thank you.
Thank you, Glenn. And just two more quick comments, and then you're free to go. One is we have a day 3, an international digital day tomorrow that will be about 3 or 4 hours. It's only digital, so you'd have to go on. We have a link that you can click. We have Alan Greenspan speaking. You know, he's 96 years old and has some very strong views on what's going on in the world. We'd love to have you listen to Alan's latest thoughts, particularly given inflation and what's the dramatic geopolitical events of today. Always interesting to get his perspectives. We have Nobel laureate Michael Spence of Stanford giving his thoughts on a new economic model. And we also have a very distinguished panel of investment professionals talking about what's going on in Asia Pac. So it's just a few hours, but we'd love to have you tune in. Secondly, our next event is going to be in Miami. We started off this year with our first sort of winter GEF event. It was back in March. It was a great success. We want to do it again, and we'd love to have you become a corporate partner or become a member to join us in Miami. It's going to be in Coconut Grove. It's going to be on February 27th, and we'd love to see you all there. So thanks again for coming, and we look forward to having some cocktails with you outside. Thanks so much.